there, and I'll know that's a sell, Romeo. But there are just some incredible praises here for Fisker. A little bit, not as much as I was hoping for what they call the biotech, which is QS, QuantumScape. Don't you love it, David? The biotech of the group.
Yes.
The $27 price target for Fisker, I think, is well reasoned. He's got a bear case of, this is not unusual for him. Remember, he's got the bear case of 9. But what they're really talking about, Carl, is the idea that this is the legit one because of its relationship with Magna, which is such an amazing company. They make cars for Daimler, for Benz, Toyota, so it's part of the mix. They've got a bull case in terms of 550,000 units by 2030. That would be rather amazing. I became a believer in this when Bill McDermott, my friend at ServiceNow, and I do call him my friend because I know him outside of work for many, many years, joined the board September 29th. Bill McDermott is an amazing executive. We all know him for what he did at SAP, and now look what he's done at ServiceNow. And he said, Jim, I'm a believer. And he has the Ocean. The Ocean is a gorgeous car. David, I think that Fisker is, when we look at all these different companies that we talk about that are just excitement,
yes,
there may be some stake here with sizzle.
There might be. And the question is where it's going, who's going to sizzle and who's going to fizzle.
Well, geez.
Like that?
Oh, my God.
Clyde's got nothing on me. But whooping and swooping. But it's good to get research like this because we need more of it. Jonas is a pretty rigorous guy, right, Jim?
I love this piece.
And it's a long piece. And, you know, as more and more of these companies come to the public markets, as we've said, oftentimes through mergers with SPACs, we need to try to understand the competitive relevance that they have and what they're facing.
Right.
And he's doing this matrix for each of them, sort of that he's calling a key consideration matrix, which may be helpful.
Well,
but, you know, not everybody has the most efficient battery. Not everybody is going to be able to scale. Not everybody is going to be number one, and yet they all claim to be. And so that's what people are trying to figure out. Interesting. I don't believe Kathy Wood's ARC has bought QuantumScape, even though it's been interested in this area, and I believe a buyer of some other names.
Check her enough at 6 o'clock every night.
Yeah, everybody's got to check that email.
Yeah, it's pretty great.
Or that what they communicate in terms of their trades at ARC.
No, you're absolutely. She calls them out in DraftKings. She calls bottom in Snap. She Virgin Galactic. She's been dumping splumps.
Did you see the SPACs from earlier this week? CMLF.
Yes.
The data, healthcare, AI, genomics. She bought that. That's going to be up 20%.
I know she was nice profit. What in Pacific Bio?
Yeah.
She nailed that one.
So my point was on QuantumScape. Interesting, it hasn't been there, I don't think, in her portfolio.
No, but I want to talk for a second about your Jagdeep Singh interview.
Yeah,
because
yes, CEO of QuantumScape.
Because that is what can move the needle. And Adam identifies it as the biotech, but we need faster charging and we need lighter batteries.
Right.
But remember what Elon Musk said, and we never go away from him. You know, he always is talking about it's easy to build a prototype. Making a prototype is easy. Scaling production is very hard. And the reason why Fisker can be at the top is they are able to scale production.
Meanwhile, Jim,
what?
Hydrogen with the trucks. What we had Hyzon earlier this week. They came public through a SPAC with they're the truck battery, right?
Right. But remember, I mean, Westport was for natural gas. The one thing you have to know
no, I'm just trying to understand, Jim, this world that is becoming, the transformation that's going to take place over the next 10 years.
Right.
In the electric power grid, in the number of stations you're going to need to be able to charge these vehicles, and just everything that's going to have to occur for this EV revolution to really succeed is enormous.
Yes, because, again, you're talking about, Carl, a very small number of cars that are EV. I mean, Fisker, Adam would be happy if they got a couple of %. Adam Jonas with that great piece of Morgan Stanley. But one of the things, Carl, that I think David is right is that there's this vast panoply of how things are going to change. But much of it is uneconomic. Right now, when you get the special green hydrogen, it is uneconomic. But it may move faster than we think. And I keep pointing out that the two most important companies in this industry are Walmart, big analyst meeting, and Amazon, because they are driving it to get it so that we have zero emissions. It's the customer that is pushing the truck. Mary Barr will make it very clear that it's really truck when you talk about hydrogen. But Royal Dutch yesterday basically saying oil has peaked. Still, they always come up with that caveat, yeah. Don't worry about it. In the 2030s, oil will still be here. When I look at the amount of money that's coming into this group and the funding, and Carl David mentioned it yesterday, the funding is so munificent that it's entirely possible that I think they can pull this off faster than people realize.
Yeah, to your point about legacy oil, S&P did downgrade some of the oil majors on credit yesterday. Pretty sweeping downgrade given what's happening on both ends of this candle, guys.
I'm so glad you
take a quick
mentioned
break here. Opening bell in less than 10 minutes. Be back in a moment.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Breaking news on what has turned into the soap opera, and that is GameStop.
We watch the internet now, thanks to the rise of social media, bring a bottom-up revolution. And now it is happening to finance. And I really do think this is really the start of a new era.
These kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect, but I think it takes an enormous amount of faith in the system to be that transparent, and then for each individual to make their own mind up, whether it's to buy and to sell.
We've gotten a lot of criticism that, maybe there should be more restrictions. So it pains us to have had to impose these restrictions, and we're going to do what we can.
This is why we need an SEC that has clear rules about market manipulation and then has the backbone to go in and enforce those rules.
The system is broken right now for certain stocks, for the heavily shorted stocks. And people are thinking somehow, well, this is a home run. Take the home run. Don't go for the grand slam. You've won the game.
Down about 1%. Wolf Research cuts it to peer perform. As they say, at a certain point, the valuation becomes too much and too hard to justify, and the current level is that point for us. Shares already up 48% for the year so far. Squawk on the Streets back in a minute.
If you can keep your head up. IG it.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
right, let's get to a mad dash. 3 minutes before we get started for the final day here. Don't forget, we got Monday off, Jim, as well. Alphabet is the name you want to talk about.
Yeah, this morning Citi cools on it. This is Jason Bazinet, very good, very rigorous analyst. He's saying Alphabet is no longer our top pick. Believes March expansion a bit too high. The street is being too aggressive. Street estimates are too rosy. David, I think, is dead wrong.
Really?
Yes, because he's really focused on the fact that cloud losses were far larger than we expected. They expect those losses to moderate, but the rapid growth, continued investment, that's exactly the future. It's Thomas Kurian. He's remarkable. I think that the cloud business is a must. There's so much to do. Look at Azure, how they ramped that from, what, $18 billion a quarter, $18 billion a year. Remember when he first said he was going to do $18 billion a year and then went to $18 billion a quarter? Look at what's going on with AWS and Andrew Jassy. Google has no choice but to spend like mad and give Kurian every resource he can have in order to become really back to a big three. I think this piece is wrong. I think the stock is cheap. I think travel advertising coming back. And I think that Jason should say, you know what? It is my top pick again. I've rethought it for what Jim Cramer said.
To be fair, the stock is up more, I think, this year already than it was all of last year.
It's been the worst of FANG for ages.
Yeah. It was $1,400 back in September. It's over $2,000 now.
Ruth Pora had a great call. She really broke out everything. I think that the time to cool on Alphabet is when it gets considerably higher than where it is now.
Okay.
It's not an Airbnb-like situation, what I'm saying.
And you don't think investors, they'll welcome any spending that comes for the cloud? That will not be frowned upon?
That's the way you feel. I mean, IBM, I think, feels the same way, but Arvind feels the same way. Arvind Krishna, what?
Just IBM, like...
Oh, don't do that.
All right, I won't.
Don't be meanie.
I'm not going to be mean. I'm just...
But Thomas Kurian, I've met Thomas Kurian. I went into a meeting. I mistakenly once called him Tom. That'll never happen again.
Got it.
And he's one of the most impressive executives I've ever met. And he's got he has a plan. And it is going to work.
It's a pretty competitive area, though. I mean,
Mr. Kurian
Andy Jassy is not exactly somebody to mess with. And the guys over at, Azure is a very significant competitor as well.
All I can tell you is that they've got the war chest. They've got the war chest.
No doubt.
Those who have war chest can win.
That core business generates an awful lot of cash. And by the way, I mean, the stock is up since they reported earnings.
But remember, look, cloud is still early on. As I mentioned, Bill McDermott, the second time service now, or Mark Benioff would tell you, look, everyone would tell you. I mean, everyone would tell you.
Is the chip shortage going to bleed into cloud?
No, not really. And by the way, we need to speak to Lisa Su. I'll be speaking to Jensen Huang soon, NVIDIA.
Yes, I know.
They're okay. A lot of it's custom. Remember, it's the commodity auto chip, chip that's really the shortage, because the Chinese triple order.
There's the opening bell, guys, in the S&P at the bottom of your screen. We'll see if we get any more movement as the S&P, thanks Ryan Detrick, has moved basically 20 basis points a day for the past 3 days. Haven't really seen that since 2019. Jim, you mentioned the chip shortage, and it looks like we are going to get some kind of executive order from the White House in the coming weeks. This letter from the industry to the White House signed by Lisa Su and Intel and Micron and Qualcomm, pointing out that, the U.S. share of manufacturing and chips has gone from the high 30s to the teens in about 20 years, 30 years.
Yeah, look, you'll see, again, Lam, KLA 10 Core, Applied Materials reports next week. They'll be running because of this. Lisa Su, remarkable job. We recommend the stock at 5 for AMD. When she told me that I didn't know what I was talking about, I always love that, especially when they're right. But you look at these companies, a lot of these companies are indeed hostage. I always like to point out Skyworks Solutions, not hostage. Why? Because they felt that they should be foundry heavy, not foundry light. Intel used to be foundry heavy. When Intel decided to go to President Trump last year, they went kind of on their own saying, listen, we want to do this, and it's defense. And it was an ill-advised way to do it. They should have done it in a group, and they've got a real champion here in Gina Raimondo. She's not approved yet. That's the problem. She's the Commerce Secretary. She, I think, is going along, David, I know you're not going to hear this, with my 50-year chip bond, and I'm not talking Dorito partner.
Listen, again, I don't know that you're going to ever get your 50-year bond as much as you want it, but maybe it will happen.
Free money.
But I think more importantly, the focus, and there was press on this yesterday, as we're pointing out,
I've been
on
pushing
having
hard.
some sort of national strategy for chip. Yes, it will come back to you. Don't worry. We will all...
It's always about me. That's what my wife explained to me a long time ago.
We will all be very thankful for you.
It's all about me.
When we all have chips everywhere. I like Doritos personally, but I'll take anything.
I got the new spicy ranch. They're unbelievable. I sent it to my house last time.
Yeah, and you can't have more. You got to have more than one. I mean, once you have one, you're done. But yeah, back to the actual chips we're talking about. This is really important, and a lot of people actually are still focused on Intel, strangely enough, Jim. I know you're not a big fan, even now.
We have Gelser.
But being a beneficiary of what could end up being some sort of national strategy here, given it is still the leader by far in manufacturing chips in this country.
Right. But we have to get it
and will there be money behind it from the U.S. government?
Well, that's why you need the bond, because otherwise, no. Now, by the way, the semiconductor companies, I want to make this really clear, Carl. The semiconductor companies, yes, they're saying good things, but they like to make things where things are cheaper. And we're an expensive country to do business in.
These all compete against each, not all, but they compete against each other. So how do you bring them all together in sort of this cooperative kind of bring it all here?
You build a gigantic complex of fabs. Alamogordo, okay? You do Los Alamos of fabs.
Okay.
And then they rent the space. You bring in all this incredible intellectual property from the Lambs of the world. Tim Archer, an amazing executive.
Sounds like Israel.
Well, okay, so you go to the Israeli plant. Now, I went to the Israeli Intel plant because I like to visit Intel plants. I went on Saturday morning.
I know, and there's nobody in there.
I was the only one there other than Dov Freeman. At that point, the guy who ran Intel, was a great survivor of the Holocaust. Amazing man. But yeah, you can run a fab. I mean, one of the problems with a fab is that it doesn't necessarily create a lot of jobs once it's in. But there are. Rick Hill has taught me a great deal about this. He sold Novellus to Lab. But the industry itself has to get behind this in more than just making it look like corporate greed. That's not going to fly.
It's going to be interesting. Well, Taiwan Semi's got the thing in Arizona, right? Aren't they moving ahead with the fab?
Yeah, but Taiwan Semi remember, Taiwan Semi's clients, David, are very heavily PRC. They have to be very careful, walk a fine line. And the previous president's MEDAX approach to try to figure out what to do with Taiwan, making it a defense issue, that muddled the waters, but I understand. I think it's right. But what has to happen here, Carl, is that we have to make it so that the Chinese are not in charge of our semiconductor world. And the Chinese order, they do just in case. They order all sorts of chips, and we do just in time. And if you look at where GM's rate and Ford, I'm telling you, those stocks would be appreciably higher if it isn't for the shortage. We hear about the shortage. Sonos talked about the shortage yesterday. But no, let's be clear, and the executives should understand this if they don't. It's who are trying to figure this out, who are customers. It takes 18 to 24 months. So this is not a short-term problem. And if you want to get your chips, I know where you can get them. You have to pay up. It's going to hurt your gross margins. Do what Skyworks did. Well, that is the solution.
Yeah. As the president said yesterday, Chinese are going to, quote, eat our lunch if we don't get it together. And I know
they've been eating our dinner for ages. She's got the wrong meal. She's General Cho, Trump, Colonel Fan. How much higher is General Cho ranking than Colonel Sanders these days, David?
That's why he's a general.
Bird Colonel versus a four-star.
Jim, there's a lot of news on the retail, Reddit, GME trade. Looks like we're going to get both Griffin and Huffman testifying in front of the House. I don't know if you saw Charles Schwab announce their January new accounts up 200 year on year. In December, it was up 75 year on year. And we're looking at trading volumes now, Jim, that are rivaling the peak of the COVID crash last spring.
It's incredible. Now, I think the real issue will be traced out. I traced out last night with Dan Schulman, CEO of PayPal. Dan Schulman has said last night, at 20 minutes and 36 seconds in his unbelievable half-hour talk yesterday, he dropped a bomb which says investments are where he's going. He's going stocks. So then the question, if he's going stocks on his unbelievable one app, is he going to buy Robinhood? Is he going to create a Robinhood that has trust? Because Robinhood has violated the people's trust. We know that. The hearings are going to be brutal. The Justice Department investigation. David, remember Justice Department when they investigate financials, it is not idle.
No,
but ever since Arthur Anderson,
the period during when Tony West was running that investigation for the DOJ.
He's doing a great job, by the way, I think, at Uber and cleaning Uber up.
Yeah, that's right. He's been there, actually, in general counsel for a while now.
David, the hearings, and it's the SEC from San Francisco, which is incredibly aggressive.
Yes.
People know them as an office that you don't trifle with. So I know they have they do have some people at Robinhood that are seasoned SEC people, but I've got to tell you, the compliance there versus the compliance at PayPal?
Yeah.
No
comparison.
Don't have it.
Those hearings, if they come off, it's going to be very interesting. I guess potentially Ken Griffin and Gabe Plotkin.
Show trial, David? Show trial among the rich?
I'll be very curious to see the line of questioning. Yeah, because it's not as though he did anything wrong.
No, but
he just didn't manage his portfolio very well.
Vlad ran a tech company.
Now we're talking Robinhood. I was talking Melvin. I was talking Melvin.
What, Griffin?
No, Gabe Plotkin, Melvin,
and then
the questions about Citadel and Where are they in all of this?
The $3 billion capital call that turned out to be less, and people are still throwing money at Robinhood. Carl, these venture capital, they can't resist it. Like Robinhood's still been the top app all week. So people are still downloading it. And look, I'm cheering for the people who use Robinhood. Want them to have unfettered ability to be able to do what they want. But the decisions to close certain or restrict trading is not something that people are going to forget. And the trust has been violated. And to rebuild trust in the financial world is almost impossible, which is why I say if PayPal wants to own this business, they will own this business.
Guys, speaking of Robinhood, one of the things that those people on the platform like to buy is SPACs. We're at the 37-minute mark of the show, really haven't talked about it. I wanted to just quickly review the week for SPACs. I don't know if you guys have seen these numbers. We tried, our producer and I, trying to get them together in the right numbers. We're going with SPAC analytics. I think we had 37 issuances this week. Raising $12.7 billion. Now, again, this is, our friends there. It's hard to keep track. There are so many. I mean, Michael Klein, who's one of the kings of SPACs, right? Churchill, he did 6 and 7. He forget just waiting. Just, let's do 6 and then we'll do 7.
I know.
KKR's got a SPAC. Harry Sloan's going to have, remember the DraftKings? He's going to have a new structure, I'm told, as well. I got to check with him where you're going to be able to do more than one deal from the SPAC. Danny Meyer's got a SPAC. Leonard Green's got a SPAC. Shaquille's got a SPAC. A-Rod's got a SPAC. You go on and on.
A-Rod, great show.
Yeah.
Churchill, I think Michael Klein's going to fight on the beaches. He's going to fight in the fields. He's going to fight in the streets. He's going to fight in the hills. And he will never surrender until we get to this Churchill 8.
He won't. Churchill, of course. Churchill 8, 9, 10. Exactly right. Thank you for the Churchill quotes. Great museum, by the way.
Churchill holds up. Yes, indeed.
Love that one. The underground.
Yes, the underground. Everyone should go to that. That's the actual
great one.
Where we won well. The Russians won well.
But when it comes to SPACs, so and by the way, hundreds more are planned and will come public, most likely. You heard Ken Mullis yesterday. He of the flying car SPAC earlier this week. Geez. I like to call it flying cars, not really. Urban mobility, transport. There's another one out there as well of those, but he says this is not going to stop.
Yesterday, Carl, on Twitter, I was looking at why does David insist on killing the SPACs? And Jim, why do you kill the SPACs? Actually, we're not killing anything. We're reminding people that if you're early on in the SPAC, you make money. Later on, as JP Morgan's research shows, it has not necessarily been a great investment. And it's ridiculous to think that all these companies can go find companies to buy that are worthwhile. Because if they were, then we would have a lot more IPOs. There's a lot of companies coming public that otherwise would.
Listening to you talk about it with Andrew was instructional before the top of the show. It's funny, on Bumble yesterday, Jim, we had that huge surge of interest on the new issue, and some viewers said, look, this is why we're interested in SPACs, because we're tired of paying up on day one for a new classic IPO.
Well, look, I understand that, and the IPO market seems broken relative to the SPACs, but I like the idea that you have to be vetted by the SEC versus the projections that SPACs make, which make everybody feel that 2030 is going to be the greatest year. Once again,
listen, I think you're right.
To Whitney Wolf Herd. That was a great deal. People may be unhappy with it, but I was thrilled. I thought this was a triumph of capitalism. Told her so myself.
No, but you're right about the projections. You've made that point many times. You can just talk about, hey, 2026, we're going to be, measure it at 2 times EBITDA where we're buying this thing. 2026, all right. Hey, if you want to accept that, you can. But with a Bumble, you have to make more specific projections or not make them at all.
Right.
By the way, guys, let's keep an eye on those shares given the performance yesterday and its debut. Jim mentioned, of course, the CEO, and we've just talked in general about it. But one thing I didn't mention yesterday was the success here that Blackstone's had on this. It was only November 2019 when they bought the parent, essentially, or at least bought part of it through their one of their growth funds. And it's interesting as well, a growth fund. Just back then, Jim. And, of course, they have benefited enormously as a result of that, having taken Bumble public out of that company, which was called Magic.
We were trying to figure out what would happen where we go without Badoo, because Badoo is a slower growth. By the way, it's just twice the growth of Match, okay?
Sorry, say that again?
Well, they have 2 divisions at Bumble.
Yes.
And Bumble is just an incredibly successful company. One division is slower. But Blackstone, throughout this, has been a really terrific company. very good advocate, I think.
Yeah, and they're, as you might imagine, are very happy with it, and it also reflects well on them in terms of the female leadership that has come to the fore here at this company.
Very strong company, really great growth. I really believe in it. I think the model is the best in the industry, and I think it's just a fantastic young growth company for young investors of the Murray Men type, because it's going to be with us for a very long time, and you have to wait for the earnings. Obviously, it's well behind Match, maybe 3 years behind Match when it comes to that.
Finally, guys, on the M&A front, I did want to mention this because we don't see it too often. Lasers again, Jim. Everybody wants in on the lasers.
You went 4 dimensions.
And I'm not talking space lasers here, guys. I'm talking about other types, but you may have seen it. Remember earlier this week we talked about Coherent getting another offer.
Oh, yes.
Lumentum is in a deal to acquire Coherent. Then you had MKS Instruments make what they said was a superior offer. And now you got 2.6 coming in. More cash in their deal. Let's call it worth. It was worth 260 roughly before the open. The stock's down. We'll take a look at where 2.6 is trading, but maybe it's worth 250. You can see what it's made up of. 130 cash, 1.3055 in stock. We'll look at 2.6, but it's been a long time since I've been able to say three-way.
It was at $78 a year ago. What are they thinking now? Now they like it at 257. They didn't like it at 78.
There's something going on here in lasers, Jim, and I'm going to leave it to you to figure it out.
Well, it's, I
it
think
has to do with 5G. It has to do with autonomous cars.
And it has to do with Mr. Baum wanting to talk or
die.
Yes, exactly right.
Oh, because of that laser. Oh, yeah.
No Mr.
Right.
Baum.
I remember that. Yeah.
And what was the operation that he knew about?
It wasn't gold. It was gold. It was Operation.
Go ahead, Carl. Operation Grand Slam.
Oh, yeah.
We pull this one out every, I'd say, once a quarter at least, right?
Of course you have to, because Goldfinger is an iconic figure.
One of the greats.
And the Mustang was in there. How about the Mustang E? How are they doing over there, Farley? Mach E? Remember the car that he says is going to be the first real challenge to Tesla? And I'm a believer. In the Bronco, you can't get one. Sold out. Chip shortage. David, chip shortage.
Actually, JPM has a good piece on how inflation might change as travel opens up, but maybe vehicle prices ease a little bit. They don't really see the opening of travel at least changing the inflation picture. Take a quick break, guys. We'll get to the bond report on the way out of here. Treasuries, 10-year did get to 118. That was the highest since February 8th, a couple of weeks ago. Analysts pointing out, again, more worries about inflation. We'll get consumer sentiment at the top of the hour. Over in Europe, we'll keep an eye on the German, French, Italian 10-year yields. And, of course, dollar index peak before we go to break. More Squawk on the Streets back in a moment.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Russian Foreign Minister Sergei Lavrov says the country is ready to cut ties with the European Union amid a recent escalation in tensions. Lavrov said Russia does not want to isolate from global life, but is prepared for that possibility. That story is on the website now. The UK economy contracted by 9.9% in 2020, its biggest drop on record, as the pandemic wreaked havoc and forced several sectors to effectively shut down. The UK economy is set to continue shrinking in the first quarter of 2021 due to ongoing restrictions. Head online for the full story. Disney beat subscription expectations in the first quarter, reporting 95 million paid subscribers to its Disney Plus streaming platform. The media giant also reported a profit rather than the loss analysts had expected.
Helping you navigate the new normal. Squawk Box on CNBC.
U.S. exporters are crying foul as the price of shipping containers spikes. Our Brian Sullivan's in Charleston, South Carolina this morning with an explainer on this latest trade dispute. Hey, Brian.
Hey, Carl. Yeah, I'm going to try to explain it. I mean, you guys like to talk about global macro. This is the most global macro of all the stories, and it involves these things behind us. You don't even think about them, but guess what? When you can't buy stuff at the stores, retailers can't get stuff on their shelves, and Peloton can't get new bikes, that's when you start to think about them. All right, in a basic, very basic way, here's what's going on. In a normal year, it would cost, I don't know, $1,500 to $2,500 to rent one of these things to ship goods from China to Long Beach or Charleston, South Carolina. That's a normal year. Then the container goes inside America, picks up soybeans or bourbon or whatever it is, goes back to the ports, and then is exported to China or other parts of the world. That's how it normally goes. Here's what's happening now. Demand from China is so hot. We are buying so much stuff from China that the container costs, guys, are now $4,000, $5,000, or even $6,000. And it's so profitable for the shipping companies that they'd rather send the containers back to China empty to basically get back in line, like that taxi driver at LaGuardia, than to put that container on the interior of the United States, which means, guys, that if you want to ship stuff around the world, you're going to either have trouble getting a container or you're going to have to pay a lot more. And it's got exporters crying foul to the point where they are asking the government for help because they want to sell soybeans and bicycles and whatever around the world, and they can't get one of these things. And meantime, the shipping companies are just printing money. It's one of these things that we never thought about until we do. And by the way, almost everything coming into the ports, guys, is tariffed. But China has never sold us more goods at any time in history, and it's really disrupting this.
Yeah, trade deficit, we'll point to that. It's absolutely fascinating, Brian. I guess actionable, who are the winners and losers beyond the obvious Maersks and manufacturers that don't export at all, I guess?
Yeah, well, that's so you named it, the biggest one, Maersk and Hapag-Lloyd and some of these, they trade overseas markets. Jim probably knows about some of these companies. I did not. Textainer, CAI, Triton International, American companies, TGH, TRTN, CAI, those are the tickers. Look at their stock charts, by the way. They have soared. You've also got some other plays, I would say, an Atlas Air Worldwide, AAWW guys. And again, I'm not recommending, I'm saying they're winning because, A, shipping rates are up, container leasing costs are up, and the air carriers like an Atlas are printing money because if you need something that's high value, you're going to charter a plane rather than wait months for some of these containers. So those are some of the winners. Jeffries likes names like a Danaus, a Zim International. There's a few like that, guys. Names we normally don't talk about. Peloton wants to fix this because they want to sell you more bikes. Here's the greatest anecdote of all. They've still got Christmas decorations coming into port. The lags are so great. Yesterday, a shipment of ornaments, I'm not kidding, a shipment of Christmas ornaments that was supposed to be here in November just rolled in. That's the kind of backlog we're talking.
Oh, my God. Brian, it's such a great explainer of a big macro trend that really only you can do when you get on the ground. It's great stuff. Hope to talk to you later on today. Brian Sullivan in Charleston. We'll take a break. Expedia's CEO is going to join us at the top of the hour. We'll talk about the quarter and the outlook for global travel when Squawk on the Street continues.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
On set, Casey Affleck and Anthony Atamani, plus a closer look at New York will resume indoor dining ahead of Valentine's Day.
The perfect way to tell someone, I love you, but I'm indifferent to your grandparents.
New Seth this weekend.
Jim, and stop trading.
Carl, people got it wrong. They're buying up Kraft Heinz, right? Why? Well, because they sold Planters. People felt that they got $3.3 billion, so it's really good. Forget it. It's the company that bought Planters, Hormel. Had them on last night. It was up initially when they reported the acquisition, and it's come down. Hormel is maybe the best performer in the consumer packaged goods group. It's beaten the market straight for years and years and years in an underperforming group, and it's going to take this asset, which is now its largest, and really just ramp it. You're going to be eating Planters everywhere. Congratulations to Jim Snead for a fantastic deal.
All right, yeah. People talking about spam-flavored Planters, Jim. We'll see what happens.
I have the pumpkin spam. I don't know. In the event of nuclear war, it's perfect.
Yeah, you're a spam connoisseur. We
yes,
know
I
this
am.
from
On a
the
chip.
past.
I like it on a chip.
What's tonight?
On a DRAM. Okay, so I've got Dexcom tonight. I've got some other STEM and ASAP, but Dexcom's important because this is glucose monitoring. The stock is down very, very badly, and I think it's just conservative outlook, and it might be an opportunity.
Jim, we got another minute or two before we have to go to break.
Cannabis.
I said at the top, we got almost, cannabis we did not get to. And I was going to say largely earnings, 80% of the S&P's in, 9% run rate, and a 19% upside surprise rate.
Well, I mean, it just keeps happening. I mean, look at it. We know that Dr. Gottlieb's on the board of Illumina. Look at that number. Meg had Illumina on today. That's a classic example. They beat 953 million in revs. People looking for 900. We're just seeing over and over and over again gigantic beats. And the beats are so large that you just think, wow, it must be some boom. But remember, we are in a strange time. A lot of companies did very well because of the great reshuffling. Yesterday, Zillow was really an extraordinary story to watch.
Though has turned around a bit. Disney shares are down, not down sharply, yeah, but Disney is down. And I note again, Viacom and Discovery, those names that have had incredible performance this year are both up sharply yet again to the tune of well over 50% now gains, 55% gains for this year. But Disney shares are down. Listen, let's not forget,
such a big
when they were asked about reaching profitability for direct-to-consumer, they still talking fiscal 2004.
But they didn't pull that forward. PayPal's doing well. That cooled after the meeting. I just want to warn everybody, you're going to hate me, everyone on Twitter. Beware of pump and dump schemes on cannabis stocks, okay? Beware of them. They are happening everywhere right now. Now, there are some very legitimate cannabis companies, and I really like them. And I've praised Afria, and I think, look, I really think that Irwin Simon's doing a great job. I like what Canopy's doing. Some of these companies are very real, but please do not be taken in by the pump and dumps. And they are happening right now.
Jim, good long weekend.
Thank you.
We'll see you on Tuesday. Jim Cramer, Mad Money tonight, 6 p.m. Another hour of Squawk on the Street. It's coming up after the break.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us. Shaped by technology and human ingenuity. We can make it work for you and your business.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
How inclusive is advertising?
If you're leaving out so many marginalized groups, the message that we're sending them is that they're not important.
Our industry reflects society. There's a culture. The UK does have systemic racism. Our industry has systemic racism.
Why it's important for business?
Not only is it a good thing to do in terms of being a member of society, but it's good for the bottom line.
We begin a two-part special exploring diversity and inclusion on the next Marketing Media Money.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Good Friday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. Market continues to sort of march in place a bit. S&P right around 39.12 after a series of record highs for various indices during the course of the week. Obviously, the story remains earnings with the likes of Disney and some airline CEOs meeting with the president. Our roadmap will begin with the Disney earnings. Big beat, 95 million Disney Plus subscribers as we watch the stock initially higher and then settle back.
Plus, pot investors come down from their highs. Reddit-fueled gains losing momentum.
And then New York City is reopening indoor dining. It's 25% capacity. The owner of the iconic Katz's Deli is going to join us later this hour. Carl.
Got to break into Disney quarter from last night, talk about the Disney Plus subs, and then the parks, too, faring a little bit better than expected. Julia Borston's got more on it. Hi, Julia.
Yeah, Carl, that's right. Just taking a look at the parks here, despite the fact that Disneyland remained closed for the full quarter and other parks operated at very limited capacity, the parks division did perform better than analysts anticipated. Its revenue dropping 53% from the year earlier quarter. Now, Disney estimated a $2.6 billion hit to operating income due to COVID, bringing its total loss to COVID to nearly $10 billion over the past 4 quarters. But CEO Bob Chapek said that consumer demand is strong and that average daily attendance at Disney World grew last quarter.
We have ample demand for our parks. Despite everything that's happening with the pandemic, I think we've made a pretty big impression on our consumer base and prospective guests in terms of the safety measures that we've undertaken at our parks to give assurances to people that they should come in and bring their families. And we're very, very pleased with what we're seeing in terms of future bookings.
Atlantic Equities with an overweight rating on Disney raising its price target, saying, quote, "We believe the parks business is on track for materially better profitability as it emerges from this downturn. We continue to believe the parks can see a strong rebound in 2022 and currently forecast $6.9 billion in operating income that year versus $6.8 billion in 2019. So Chapek referenced Dr. Fauci saying he hopes there's vaccines for everyone who wants them by April, saying that would be a game changer and would accelerate Disney's expectations for the parks, guys.
Yeah, Julia. I mean, it's interesting. I'll tell you, my family actually just booked a trip for Disney World as well, and I was kind of surprised to see, even though you can't pay for some of the extras, that the tickets themselves are still pretty expensive for Disney World right now. I am curious, though, given the fact that historically it has been the company's bread and butter, it is such a profitable unit. When you do look at the streaming business and the billions of dollars that are going to be invested into that content pipeline, how key it is to the streaming story to see the parks come back and come back as quickly as possible.
Well, look, I think what's interesting, Morgan, is there are a lot of families like yours, and I think that's what Chapek was referring to. But Disney is really investing in both of these divisions. There was a lot of talk on the call last night about how they're taking this as an opportunity to continue building out some of the features at their parks, such as the Star Wars themed hotel, other different things at the parks around the world. And so they really are investing in the parks right now, and they really are investing in Disney Plus right now. They're going to have over 100 new titles at Disney Plus this year. This is an area where they are not going to pull back just because they do have the weakness at the park. So for Disney, it's really full steam ahead on both of these divisions and just hoping that the parks can open up sooner rather than later.
Julia, when you hit your streaming target for 2024, 3 years early, what does that do to your targets for the next 3 years? Do they try to raise that target in the future or not?
Well, look, they did update their targets in December at that analyst day when they showcased literally 4 hours of content that's going to be coming to their streaming networks. I think what's going to be really interesting, Carl, is they're completing the international rollout of Disney Plus in the next couple of weeks. At the end of February, they're going to be rolling out to many other countries around the world. And once they have that that exposure, once they're really in all these different markets, it's going to be interesting to see what the uptake is. Do they see a sharp surge in demand just from the sort of low-hanging fruit, people who are Disney fans, or can they really use some of these other assets they have that are not just the core Disney brands to make sure that this streaming services has to be a staple just like Netflix is around the world? So they've increased those streaming targets, but a lot hinges on what happens with this international rollout.
Yeah, Julia, I realize there a lot hinges on the rollout. I do wonder, though, the fact that they have 95 million, almost 95 million subscribers just for Disney Plus you have Hulu and ESPN, what that could mean in terms of pricing power or the possibility of ads. I realize that the landscape is becoming very competitive very quickly, but it does seem like they are going to have a very sticky base, and it's certainly grown much faster than everybody expected.
A very sticky base, and it's interesting, they're not concerned about churn. A lot of people, including my family, subscribe for a year at a time. You get a better deal if you do it a year at a time. But they also say that they think they do have a little price elasticity there, that they do think they'll be able to increase prices without it impacting churn. They also, remember, have had great success getting people who were getting a free service through Verizon to sign up and pay for it. So not really concerned about pricing there. And I think in terms of advertising, because Hulu does have advertising, Disney Plus does not. For advertising, the more people that watch, the more advertising revenue they'll be able to generate. So real economies of scale there.
Yeah, and yet still trying to get Black Widow into theaters. It's going to be really interesting, Julia, to see if they can make that happen as well. Thanks for helping us on the Disney Quarter. Julia Borson, of course, who knows more than, has forgotten more than I know about Disney. In the meantime, regarding travel at large, shares of Expedia down this morning after reporting a weaker than expected quarter, fueled by the resurgence of cases and lockdowns. Our Seema Modi joins us with the company's CEO.
Carl, thank you.
Hey, Seema.
Thank you. Peter, good morning and welcome back to CNBC.
Good morning, Seema. Thanks for having me.
Of course. On the call, you did talk about how this travel recovery is going to be bumpy and not linear, but you also pointed to an improvement in January bookings. As you look out to spring and summer, are you starting to see an uptick in bookings, or are travelers still holding off because of the slower than expected vaccine rollout?
Yeah, I think we're seeing a lot of the same movement you would expect right now, which is people are starting to book further out. People are starting to book for the summer, but it's very use case dependent. So the things we've seen be strong, like alternative accommodations and Vrbo, continue to be very strong and very strong for those windows. Domestic travel clearly seems to be the focus. And of course, as you would expect, with international being unknown still in terms of how people will be able to travel, what the rules will be, we're still seeing very muted bookings there, although there's plenty of interest. It's just customers are not sure what they'll be able to do. So we're seeing pretty much what you'd expect, what all of you probably are experiencing in your own lives. We all want to travel. People are looking a lot. People are booking things they feel confident they can do. But in terms of broader travel, opened, truly opened internationally, it's still pretty limited.
Let's pick up on Vrbo. You mentioned it. I mean, it's been a consistent bright spot for Expedia, but I'm curious what else you're doing to grow the vacation rental platform and drive direct traffic and make it more of a household name. I think, anecdotally speaking, when people think of home rentals, they still think Airbnb.
Yeah, I think obviously it's market dependent. Vrbo is not a global brand. And in fact, even in our strongest, what we would call our strongest Vrbo markets, we don't always use Vrbo as the brand. What we are doing is investing heavily behind the brand in brand marketing, what we would call up funnel to attract direct customers. It's been working extremely well. We've gained share in all of our strongest Vrbo markets. And we think people are just experiencing the use case so much more often that they're going to know what it's like to stay in a home, what it's like to bring their families, their large families, et cetera. And that's going to have continued benefits for us. But we are pushing into it. We are pushing the Vrbo brand and other local brands where it makes sense. And as I mentioned yesterday on our earnings call, we continue to work hard on making sure we can get our Vrbo supply into all our OTA brands so that over time we can expand our reach of our alternative accommodation offerings.
Got it. So you're investing more in the Vrbo brand, but at the same time, yesterday you said that you're going to rely less on Google going forward. Can you walk us through what's driving that decision, making the shift away from Google? And is that potential risk of not getting more demand as you try to build this portfolio?
Yeah, I don't think it's a big risk for us. We have been in the Google Meta product for vacation rentals for a while. We concluded that right now it wasn't adding any real incremental benefit to us, that we would be better off investing that capital in direct relationships. And so we pulled out. It's not Google per se. It's that the product we felt didn't really provide tons of value for the customer. It didn't provide tons of value for us as a user. So we just put the capital in other places. And we'll continue to do that across Vrbo and all our brands, which is put the money in the most productive place we can put it to drive customer relationships. So for now, that didn't make sense for us.
Peter, it's Morgan. I'm curious, with airline CEOs meeting at the White House today to talk about a number of travel-related issues where COVID-19 is concerned. I mean, you got the discussion around testing requirements, possibility of vaccine passports. What would some of these policies, the implementation of some of these policies actually do to travel?
Yeah, well, I think it's great that they're talking about it. I think it's going to take cooperation between not just industry and government, but multiple governments. We're going to have to settle on rules and ways of transacting this. You know, our focus is making sure that we can help our consumers do it as seamlessly as possible. So if there are rules, you know, if and when international travel comes back, which is hopefully soon, you know, what will the rules be for going into a new country? What will you have to prove? What kinds of health passports will be acceptable? Or will there be a universal approach? Over time, I suspect, like all things, this will pass and there will no longer be a need for this. But I think in the interim period, as we try to restart travel and have uniform policies, as uniform as we can around the globe, that will certainly help oil the machinery to get travel going again.
Yeah, I wondered about that as well, specifically international. You know, what are your expectations in terms of the borders actually being opened? I know it's very difficult to estimate at this point, but how important will that ultimately be to your business and your ability to actually start to see some visibility into the forward months?
Yeah, I think we have, you know, David, we have a broad base of business, so we can do a lot of domestic business in many countries around the world. International remains a challenging space, and I think so. I think travel can and will continue to open even without international, and we'll see travel numbers improve as consumers feel more confident. You know, Americans will travel around America, European citizens will travel around the EU probably, but I think in terms of broad, long-haul international travel, it's hard to say. You know, the vaccine rollout will not be evenly handed out, I suspect, around the globe. We will have issues with people coming from certain countries or not. So I think we will get past this. I don't know how many months it's going to take to a point where everybody who wants to be vaccinated has been vaccinated and everybody can make their own assessments of their health. But I think in the interim, it's going to be bumpy, and there may be channels between countries. There may be certain regions that can travel within a region. But I think it's going to be messy for a little while until the governments and industry figure out some policies that work.
You know, I just wonder as well, what about, you know, a lot of people have been sitting home thinking about traveling. Maybe they've actually even been sitting at their computer looking at airlines. Do you run any risk of being disintermediated by people becoming more familiar with how to book directly with an airline and compare on their own?
I think the reasons for us and the reasons for people like us are as strong as ever. And typically coming out of downturns of various kinds, consumers are looking to compare even more, look for their best options. And when they want to compare, we are definitionally the best place to do it. I mean, you can go to 12 different sites to compare airline prices, or you can come to us. Likewise, hotels, vacation rentals, et cetera. So I think we have seen that during COVID, there has been the use case where you're going to visit grandma in whatever town grandma lives in, you know the hotel near her house, and you just book that hotel because it's simple. But that's different than deciding you're going to Mexico, or deciding you're going to Paris, or deciding you're going to New York and saying, where do I want to stay? Where do I want to fly? So I think we see probably the opposite, that in the short term, people will be coming to us even more. And certainly the industry, our relationships with the hoteliers and the airlines have been strong. And I think they fully recognize that consumers will be coming to us to find their solutions. So,
but Peter, with Airbnb, I was just curious, with Airbnb's market cap at $127 billion, around 6 times that of Expedia, does that reflect to you this expectation that the consumer shift from hotels to homes is permanent, or do you expect customers to return back to hotels, which are primarily located in urban cities? We know what the situation is right now in cities.
Yeah, I'm a strong believer that consumer behavior will rebound considerably. That doesn't mean that we haven't seen a lot of people try the whole home solution and be very pleased with it and keep it in their set of options more readily than perhaps they had before. But I think consumers will be rushing back. You just had a discussion about Disney. They'll be going to Disney World and staying at Disney hotels. They'll be going to New York and staying in hotels. That is not going to change. I think the hotel industry will come roaring back. Alternatives have been on a great tear. Airbnb has certainly been, an important part of what's going on there, and we respect obviously what they've achieved. But I don't think this is a grand consumer shift of how we all want to travel. Many of us still want to go to the spa or go to the hotel pool or whatever it is that brought us to a hotel. Or be in a central city, and I think cities will come roaring back too. I think the notion that people are going to avoid cities for some reason makes no sense to me. So I think we'll see hotels come roaring back, and I think alternatives will be a big and important and growing part of the category, and certainly will be good for us with Vrbo. But it's certainly not going to be a shift in the industry, in my opinion.
Understood. Waiting for that big recovery. Peter, always a pleasure to have you on. Peter Kearns, CEO of Expedia.
Thanks very much.
Coming up, hot stocks continue a volatile week after being lit up, oh boy, by Reddit traders. Those names, same names, now snuffed out, falling for a second straight day. We're going to tell you what companies you want to put your money in next.
The countdown to the close of the European markets is sponsored by IG.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
It has been a volatile week for cannabis stocks. Best day ever for the MJ ETF on Tuesday, worst day ever on Thursday. Here to talk more about the dynamics of the industry, former Senate Majority Leader Tom Daschle, who's an advisory board member for Clever Leaves. Also joining us is the CEO of Clever Leaves, Kyle Detweiler. Gentlemen, good to have you. Happy Friday.
Be with you.
Happy Friday.
Leader, I hope you won't mind if I begin with you, because I got to say, we cover the space pretty closely, and I would argue that the opinions about whether or not true Senate reform is likely this year is really split. Where are you right now?
I'm very optimistic, frankly. I think that given the Democratic majorities in the House and the Senate, given Leader Schumer's comments earlier this week, I don't think there's any question that a number of pieces of legislation have a greater opportunity for passage than we've seen in any time in the past.
How can you give us a better sense on timing and sort of what gives, I guess, not just the vote, the momentum, but the realization that it's time to have a vote at all? I mean, where does this stack in the list of priorities? Because there's a lot of other things the Senate is consumed with.
Well, there are two or three things that give me cause for optimism. First of all, as you know, the House has acted a couple of times already on this important legislation. And so they've already set the precedent. You see wider and wider interest in the states. A number of states have passed meaningful changes in their legislation and in the laws that exist within the states. And then I think there's also an increasing realization that there's an economic opportunity here. So given all of that, given the fact that a lot of this legislation has already been the subject of hearings and greater bipartisan support, my feeling is that while it may not be soon, it may not be in the immediate few weeks, sometime during this legislative session, you're going to see action on two or three important cannabis bills.
So in light of that, Kyle, I mean, if and when we see decriminalization federally here in the U.S., then you see actual legalization take root as well. How quickly could you actually ramp your operations stateside?
Well, it depends how the regulations unfold. In some degree, we could unveil products immediately. We are one of the largest producers of cannabis outside the United States, 2 million square feet. We're right up there with some of the other large producers like Tilray and Aphria. So I think we can launch products immediately. Now, if the regulation comes out in maybe a more contorted manner, which has restrictions on imports or interstate commerce, we might have to adjust our strategy. But I think we could be in the United States very fast. In fact, this week we announced our first commercial import of CBD into the United States. So in some senses, it's almost already beginning.
Yeah, I wonder what you think those regulations potentially should look like. And I ask because I know you also operate in places like Canada. We've seen some challenges, some perhaps unexpected regulatory-driven pitfalls in the Canadian market right now. So what are the lessons that could be learned?
Well, I think, Clever Leaves exists for a very simple reason, and that is to bring cannabinoid-based therapies to as many patients and customers as possible. So, from a social advocacy side, I think that, the governments of the United States and Canada should encourage as much product innovation as possible. We are one of the few EU GMP certified cannabis producers in the planet. There's only about 3 others, by the way I measure it, who have those same capabilities, and they're all in Canada. And if we can bring that expertise, those high quality production systems, I think the consumers and patients will benefit. So I'm in favor of a system that allows as much innovation, as much competition as possible, and doesn't try to restrict cannabis and say, hey, cannabis grown in California, that shouldn't be able to be shipped to Massachusetts. And similarly, high quality cannabis pharmaceutical ingredients from Colombia, those could be sold at drugstores in the United States as well.
Leader, your own home state has had an interesting discussion about the cannabis at the state level with the vote initiative and then some pushback from the judiciary. I just wonder whether or not you think the courts are going to start to try to rein in what ballot initiatives have tried to do.
Well, there may be that effort, but there was an overwhelming sentiment expressed by the voters in South Dakota, both on recreational as well as on medical marijuana. And so I don't think there's any question that over time these issues are going to be resolved favorably, just as they have been in so many other states.
Hey, finally, Kyle, as far as the price action goes on the stock, it's gone from basically 8 to almost 20 in the course of maybe 5 or 6 weeks. I guess your reaction to the squeeze, what's your relationship with those who might feel it's a short or a Reddit long at this point?
Sure. Well, I don't think Cleverly's had significant short interest at all. So I don't think what happened to Cleverly's is at all related to, other, short squeezes. I think this is an example where, there are fundamental barriers to institutional investors entering the cannabis space. And as those barriers are starting to come down, or as retail investors realize the opportunity ahead of time, that's created an opportunity. Cleverlease has only been public for 2 months. Some of the other peers, Aphria or Tilray, have been public for years. So they've built up this, a shareholder following, but, Cleverlease is relatively new. And I think that the price action in Cleverlease reflects the fact that, our business is probably undervalued. No other company, traded on the New York Stock Exchange or the NASDAQ has an operating cost structure which is 90% lower than some of those other peers I just mentioned. So I think this is really more a market recognition of the value of the Cleverlease business model as opposed to just some sort of, blips on a screen.
Yeah. Well, certainly federal action would definitely ratify the move we've seen in some of the shares. Kyle, Leader Daschle, always good to chat with you. Please come back.
Will do. Have a good weekend.
I mean, it's just fascinating when you think about institutional money on the sidelines. It kind of reminds me of the cryptocurrency conversation we're having, too. It is now time for our ETF Spotlight, taking a look at Prime Mobile Payments ETF. That's ticker iPay. It's up over 30% this year as the pandemic has shifted consumers and their purchases timeline. It's up fractionally right now. Getting a boost this morning, though, from its top holding, PayPal. CEO Dan Schulman saying at the company's virtual investor day yesterday that the fintech giant is aiming to double its user base by 2025 and reach 750 million customers. Stock's up 2%. We're back in 2.
The countdown to the close of the European markets is sponsored by IG.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
A courageous visionary facing tremendous odds.
I've always taught him to aim for better.
An entrepreneur with a sharp sense for business.
You just need drive and determination.
Now with a company worth over $6 billion.
We will do massive amount of business on a global scale.
Damon John is taking the world by storm and doing it in style.
If I can do it, anybody in the world can do it.
The Brave Ones, Damon John. CNBC.
I'm Courtney Reagan, and here's your CNBC COVID update at this hour. An investigation by the Associated Press found more than 9,000 recovering COVID-19 patients were sent to nursing homes in New York State. That's 40% more people than reported by state health officials. The New York Post reports an aide to New York Governor Cuomo said figures on the COVID death toll in nursing homes were withheld. NBC News has not been able to verify the report. A Cuomo spokesman says the state cooperated with federal COVID data gathering efforts. And Nevada has laid out plans for easing COVID-19 safety restrictions. Starting Monday, indoor capacity limits will be raised to 35% for casinos, restaurants, and some other indoor businesses. If COVID trends continue to improve, limits will be eased again on March 15th. And Japan has received its first doses of coronavirus vaccine, enough for 185,000 people. However, shortages of specialized needles means thousands of those doses may end up getting wasted. David, that kind of breaks my heart. Back over to you.
Yeah, that's not a good thing when that happens. Thank you, Courtney. Digital health company ShareCare announcing a deal to go public via Alan Mnuchin's backed SPAC. It's called Falcon Capital. You can see the stock is trading down about 2%. It values the overall company at about $4 billion, of course. And it's one of our SPAC focuses of the day. Joining us now is Jeff Arnold. He's the founder, chairman, and CEO of ShareCare. By the way, also, of course, the founder of WebMD, and so somebody who's not a stranger to CNBC's air. Jeff, good to have you this morning. For those investors out there who are trying to wade through all the different potential digital health offerings that are out there, how do you define this company and, you know, across the board in terms of whether it's for the enterprise, the provider, or solutions to the consumer?
Yeah, no, that's a great question. You know, I've been in digital health for a long time, since, you know, WebMD back in the late 90s. And, you know, what's different here with ShareCare is that we now have the technology to not just provide trusted information to people, but to be able to connect them to their doctor, to their health plan, and to their employer, right to the palm of their person's hand. So healthcare, as you know, is really fragmented. There's these sea of apps out there. And what ShareCare has been able to create over the last 8 years or so is to build that one integrated platform where the data is interoperable, it's easy to understand, and it's affordable for all.
So who is the core constituency here? Or are you having to deal with all three at the same time?
Yeah, so we call it B to B to P, with the P being the person. So how do we service the person on the platform as an employee, as the health plan member, as a patient, and as a consumer? So our go-to-market's been really strong. We have amazing clients in enterprise where we sell to large health plans like many Blue Cross Blue Shield plans. We sell to large self-insured employers like a Delta. We have over 6,000 health system clients. And because we're also B2B to P, you can also download us for free as a consumer.
All right. And you're talking about fairly aggressive compound annual growth rate of about 24% for your revenue, 27% for your gross profit over the next, let's call it 2 to 3 years. You know, you get to $629 million, according to your slide deck here, in revenues in 2023. What's going to drive that? Yeah,
I think, you know, if there's been a silver lining in the pandemic, which is, I know, hard to see, has been digital health. This has become a must-buy for employers, being able to create a culture of accountability and give people confidence to come back to work, that it's safe, and to give them tools to build resiliency. For doctors, you know, they're moving to value-based care, so they need platforms like ShareCare to manage risk. And if you're a large health plan, imagine having to piece together all these various point solutions for telemedicine or for diabetes or for these various tools. And ShareCare, we become that one-stop shop. And we're 95% booked for 2021. So as we sit here in early February, we've had a very, very strong January, and it's given us, we're already selling into 2022 and have have great confidence in those numbers based on the demand and the large diversified client base that we represent. Yeah. Now, those who are positive on your prospects tell me as well, they see an opportunity in, I guess, health security and digital therapeutics. Yeah. Explain exactly what health security is and why it would be important. Yeah, well, you know, health security is the new cybersecurity. So think of cybersecurity as protecting infrastructure against a virus. Health security is here forever forward to make sure that we have the best practices in place to protect people against the virus. And so we've created a platform where we've tech-enabled standard operating procedures. We've already deployed it in over 50 countries. That work has led us to start to deploy with states like the state of Florida, where ShareCare is a vaccine assistant, where you go to myvaccine.fl.gov and you can register through ShareCare for your vaccine. We send you a text, you fill out the information, and we give you a QR code that you can show when you're getting your shot. And then the clinician uses our portal to upload your digital vaccine card back into your ShareCare application, which we think is amazing, not only because it's making that process more efficient, but it's given us connectivity with the person to build resiliency with them over time, which we think is the greatest health security, is helping lower people's risk.
Right. Talk to me a bit about the process itself. Could you have gone public through a traditional route? You've been a company now, I think it's almost 10 years or something along those lines. Did you look at a number of different SPACs? Why go public in this way, and why specifically with Falcon?
Yeah, we had a board meeting in Q4. We had made the decision to go public. Many companies have gone public in digital health recently, and got approached by a few different SPACs. I started learning about SPACs. I didn't know a lot about it at the time, and I saw some really good benefits in them. One is healthcare is really complicated, and to be able to have time to tell our story to investors, I thought was really important. We had a really successful roadshow. We 2x oversubscribed the PIPE. But more importantly with that, I think we found the right SPAC sponsors. We had multiple offers and ended up going with Alan Mnuchin and Jeff Zdansky's Falcon because of a couple of reasons. One is Alan's, I think, amazing experience in capital markets, and him and Jeff's and Harry Sloan's success and DraftKings and skills, gave us a confidence that they could really help guide us through this process, get us public a little bit faster, so that we could hit the dance floor and be able to educate people on the power of ShareCare. Yeah. Finally, you disappointed the stock isn't really the SPAC isn't really moving at all this morning? Well, I saw, there was some rumors of it a couple of weeks ago, and it's gone up a little bit. So I don't know if that plays into it. But regardless, we got Anthem to invest in this round. Anthem, as represents 42 million members here in the U.S., and the Blues represent 1 in 3. We got outside of all these great institutional investors, we got Digital Alpha, and we're gonna pioneer this model of outcomes-based financing of how do we go from my health to our health as communities around the world are recognizing that they're going to have to invest a lot in ShareCare type solutions to improve well-being, increase resilience. So no, we're playing for the long term. Yeah, as you should be. All right, look, the stock's actually moving higher now. Jeff, thank you. Appreciate your time. Jeff Arnold. Thank you so much. You're welcome. Take care.
After the break, we're going to take you down to sunny Florida, where we find who else? Our own Jane Wells. Hey, Jane.
Oh, hey, Carl. Wow, it's beautiful out here. The beach is wide open. Florida is losing billions, though, because Canadians aren't coming. And the snowbirds who do come are being shamed back home and face new expensive restrictions. We'll have that when we come back.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
Canadians being shamed out of their yearly trips down south. Jane Wells joins us live from Hollywood, Florida with, let's be honest, it's the best assignment of the day. Jane.
Oh, my God. I can't believe I'm getting paid. But here's the deal, Morgan. Over 3.5 million Canadians come down here every year, and they spend over $6 billion. But since COVID hit, that's down 99%. And those snowbirds bold enough to come are being travel shamed back home by their fellow Canadians. And how crowded would this Broad Walk be on a normal February day?
Jam-packed.
Stephen Klein is with the local Marriott. Now, the border with Canada has been closed for months, but Canadians can still fly here, though few are. What's the difference in occupancy from last year to this year? Is it down? How much?
Yeah, anywhere down from 30 to 50% occupancy.
In my complex, we're supposed to be at least 300 Canadian people. We 12 or maybe 13.
I've pretty much gone every January, February, or March, at least once and sometimes twice for probably the last 20 years.
Now, Jim Byers is a travel editor in Toronto, skipping his beloved Florida this year. He says most Canadians, trust their government when it says don't travel.
Well, to a lot of Canadians, going to Florida, it's almost our God-given right. And when that's taken away, it really seems unfair and maybe a little bit depressing for a lot of people.
Now, for those who do come down here, they're now upset because they just learned when they return the government's going to make them pay to stay in government quarantine hotels for 3 days till they get a negative COVID test. But guys, they have to go back eventually or they lose their Canadian health care. Back to you.
It's such a quandary. I mean, it's interesting, this idea of a God-given right? But it's my understanding also that some of the Canadian folks that have migrated down there in the midst of all this COVID stuff don't necessarily, that the restrictions on their travel visas have also been loosened so they can actually stay here a little bit longer. I would imagine that if that is the case, that would be an incentive, no?
They are asking.
Okay.
They are asking their provincial governments if they can extend so that they can still keep their health care. Usually depends where you are, 180, maybe 210 days. If you're out of the country longer than that, you lose your residency, you lose your health care, and that's a deal breaker.
All right, that's just not fair, Jane. It's just not fair. I don't know. Maybe we should all, New Yorkers, replace Canadians. Just come down there. Save us, save a sip for me, Jane.
Cheers, my friend.
Cheers. Cheers. Jane Wells. As we go to break, Morgan Stanley expanding its coverage of EV this morning. Initiated QuantumScape and Fisker, both of them overweight. Let's take a look at what that's doing to those stock prices. Lordstown, though, and Romeo Power, underweights. That's Adam Jonas. You can see the stock prices, as I just said, reflecting that important call. It's a 100-page report worth reading if you're interested in the sector. We'll be right back.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes Hong Kong has been used as a pawn by the U.S. administration. With the new U.S. administration, I hope that they will give us a fair hearing as far as the national security law is concerned.
We're not a protectionist country. Rather, China is trying to become a leader of a new round of globalization.
The pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos Virtual Conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary, feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Shares of Affirm have been all over the map this month, about a $40 range since the beginning of February. Down today following its first results as a public company. Loss of 45 cents was smaller than expected, but sales volume caused by the pandemic was a concern for online shopping. We're going to talk to Max Levchin in the next hour on Squawk Alley, so stay with us.
I can see the future painted in my eyes. Open up the door and fade into the night. Dive into my world I know. Take my hand, follow me to the sun. There's no end. This is where we go.
At Standard Chartered, we believe money can be a force for good, which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost our planet.
This is where we go.
Standard Chartered, here for good.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
Keep up with the crisis. Squawk on the Street on CNBC.
Welcome back to Squawk on the Street. New York City reopening indoor dining today at 25% capacity. Joining us now is Jake Dell, owner of Katz's Delicatessen, a New York City institution. And according to this foodie right here, the maker of the best pastrami Reuben. Jake, thanks for being with us.
Thanks for having me on, guys.
All right, so you're reopening. What can customers expect to see when they come into Katz's this weekend? Are you still, as you have been in the past, a cash-only restaurant?
Well, we do take cards in the back, but it's going to look a little bit different. It's obviously we're a little spaced out, 25%. It's only about 17, 18 tables, but still we're lucky compared to a bunch of other restaurants in this city that have much smaller footprints and can only fit, one or two tables at a time. We had 25% back in the fall, so we know how that works. Temperature checks and screening at the door, order at the counter. You can see we already have some customers in here. Yeah, come on in.
Curious, would you ever consider taking Bitcoin?
Absolutely not. We're a 133-year-old deli. Come on, we're not
enough.
that modern.
Okay, so I am curious.
It's a big deal for us to take credit cards.
Okay, I know, that's why I'm asking. Okay, so at 25% capacity, how sustainable is that? How long can you go at that level?
Look, like I said, I think we're lucky compared to others, given the size of our footprint. We have a large dining room. I think, though, we are the exception to the rule. I think 25% is an industry-wide killer. And I understand there are health and safety risks, and I don't think any restaurant owner wants to put our staff or our customers in any sort of health risk. But from a purely business standpoint, it is certainly challenging, if not a death sentence for many businesses.
Trying to find some silver linings here in this horrible period, certainly as well for the restaurant industry in New York. I mean, is there anything you've had to do over these last 11 months that you will continue to do that's opened up a new revenue stream that maybe, you know, will end up being a positive when we're past this?
Yeah, absolutely. That's a great question. So, you know, one thing that we focused on really hard was our website and focusing on bringing the customer experience to your door, right? The true Katz's experience. You can't make it to Lower East Side. So how do we bring it to you? And whether that's things like local delivery, which you see behind me, pickups through our website, or shipping, nationwide shipping all across the country. It's something we've done since World War II. Our slogan is "Send a Salami, the boy in the army," which rhymes if you say it like a true New Yorker. We know how to ship food. We've always done that. Now we just pivoted really hard at the start of the pandemic. You know, busboys and dishwashers, and you know, when you don't have indoor dining, there's no need to wash dishes. So instead, I'm teaching them how to pack mustards and pickles and knishes and put that in a form that can be shipped across the country. And that has grown tremendously. And we really hope that continues once all is back to normal.
Yeah, well, I'm curious about that. I mean, you guys have been there for so long. When you walk around your neighborhood, what's the carnage like when it comes to restaurants? What are your expectations about who's going to make it and who's already gone?
You know, I think a kind of common refrain that you hear a lot now is the pandemic sort of exposed certain things that were already there. And I think with some restaurants, that's perhaps no difference. For some restaurants, you know, that may have always failed. This just sort of expedited that timetable. But for others, this was a real shot in the gut. I mean, this was horrible. It's not an easy time. It's not easy for the entire industry, hospitality industry. Hell, it's not easy for any industry. You know, unless you're Amazon, you're losing money this year. So it's tough. We're just all hanging on for dear life and hope to make it to 2022.
Jake, I want to go back to the delivery infrastructure for a minute. I mean, investors have been really hot on some of those third-party delivery operators. The fact that you've decided to do it all in-house, break down the economics for me and why you did it that way.
Well, look, any of those third-party companies take cuts that are, well, everyone has their own opinion on it, but from the opinion of the restaurant operator, it's egregious. So, and it's offensive. So we don't want to give those fees for something we're already doing ourselves, that we can do ourselves. And I understand why you would need that capital potentially, but we're lucky that our volume was high enough. Our customer base is loyal enough, you know, and you know, we just bit the bullet and built a giant factory a couple of years ago, and it's paid off. We've been lucky. We haven't actually laid anyone off during this pandemic, and I'm pretty grateful for that.
Oh, that's amazing. You know, I'm also curious, not just what you've been able to do, but what you've been willing to do. There must be a reason why, even in the depths when this kind of looked, when we were very thin on hope, that you didn't decide to just roll up the model and do something else instead. What was it that led you to commit to not just the city, but to what you've built over all these years?
Listen, you have to, because you have to. I mean, you put your head down and you go forward, and that's it. You take one decision at a time. You know, when the pandemic started, we immediately started giving out soups to the neighborhood, to low income and senior citizen buildings in the neighborhood. We've served, I think, something like 30,000 meals to all through 5 boroughs, through over 30 different hospitals, to workers, frontline workers. And it's something that was not a question, something we were going to do because we had to. Because in a family business or any business, I truly believe that you have to take care of the community, right? The community takes care of you. You have to take care of them when they're in need. So we put our head down and we do it. And whether it's shipping and it's a pandemic and Look, this is our second pandemic, technically, for Kathy. It's my first, so I don't know. But just make it up as I go, I guess. Hope make the best decision we can in the moment without losing touch with the nostalgia and the tradition that's truly at the core of Kathy.
Yeah. Of course, that, I think, first pandemic you're referencing being the 1918 Spanish flu. Jake, good luck this weekend. We're glad you're reopening indoor dining, and thanks for being with us.
Thank you for having me. And I really appreciate it.
That was great. Before we go, guys, take a look at shares of Bumble up more than 11% today. The dating app closed up 63% yesterday on its public debut. Talk more about that on Squawk Alley in a moment as the S&P goes green. Don't go away.
Tomorrow is just waiting to be created, to be reinvented and redefined. And it's those who dare to push the world forward, discover and reshape markets, and embrace the possibilities of data that will reimagine our potential and transform society as we know it. With new ideas and new technology, get there with NASDAQ.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market?
Plastic getting into the ocean in half over the next 10 years.
The interest that Claire and I have had when we were much younger has always been about trying to make a difference in the world.
Companies doing good on an economic.
Good morning. It's 8 a.m. at Disney headquarters in Burbank, California. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Friday. Welcome to Squawk Alley. I'm John Fort with Carl Quintanilla. Big hour ahead. Fintech pioneer Mac Levchin, co-founder of PayPal, is going to join us as his new company, Affirm, posts its first earnings since going public. And then a new era for paid content. Well, Microsoft says that maybe tech firms should pay for news. We're going to begin with Disney. The Mouse House touches new highs after a quarter led by streaming, closing in on the 100 million mark for Disney+. Julia Borston joins us now to break down the results. Hey, Julia.
Well, John, Disney Plus growing to 95 million subscribers, well surpassing its original guidance 4 years early, along with Hulu and ESPN Plus. That direct subscription base growing to 146 million, driving that division's revenue up 73% in the quarter, while that division's losses fell by more than half, though the company wouldn't update its expectation. Now it says it's going to break even by 2024.
We've been especially pleased with the success of our direct-to-consumer business, and our recent strategic reorganization has enabled us to accelerate the company's pivot towards a DTC-first business model and further grow our streaming services. Disney Plus has exceeded even our highest expectations.
Average revenue per user for Disney Plus has declined as it's rolled out as a no or low cost option to the Hotstar subscribers. Those are mostly in India. But KeyBank did raise its price target with a buy rating on the stock, saying they see few roadblocks for Disney's direct-to-consumer ambitions, given aggressive, high-quality content creation with 100 titles to be released this year, international expansion coming on February 23rd, runway for price increases in advertising, which should continue to benefit with increased viewership. Atlantic Equities raising its price target on the stock as well, citing that management made positive comments on churn, saying that conversion rates from Verizon, which gave free access to the service, were pleasing, and that a step up in churn with a price increase was not expected. They say that seems fair given the value that Disney Plus provides. Now investors are watching the February 23rd rollout of Disney Plus Star. Star is that ad-supported tier, and that's going to be available in Europe, Canada, Australia, and elsewhere. Carl, it's going to be interesting to see whether having all that additional content really helps drive more subscribers to Disney Plus.
Yeah, Julia, in the last hour, we talked about Black Widow and the company's apparent hopes to make that a theatrical event. Are we going to start to see other studios try to hold their best cards for the theaters in a way maybe that we didn't see last year?
Well, look, it's going to be on a studio-by-studio basis, Carl, and it's really just going to depend on what happens with theaters reopening. And a lot of that, just like with the theme parks, a lot of that does depend on the vaccine, how comfortable people feel going forward. But I think we're just going to see a lot of flexibility. Disney might put it in theaters, but they might be able to launch it digitally sooner than they would have otherwise. You know, they have Raya and the Dragon. This is a really big animated movie coming up, and they're going to be doing that simultaneously. They did announce that ahead of time, but I think the name of the game now is going to be flexibility, and who knows what the theatrical movie-going market is going to look like this summer.
That's true. So many uncertainties. Julia, thanks. Julia Borston on Disney this morning. Sticking with that quarter, Heather Musnick is the former head of content partnerships at Hulu. Joins us this morning along with Ben Smith, media columnist for the New York Times. Guys, happy Friday. It's great to see you both. Thanks for the help today.
Good morning. Thanks for having me on.
Heather, let me begin with you. When you think about Disney at this point, we're just talking about the optionality on say, Black Widow, for example. In your mind, does it remain a streaming story, or is it a reopening story?
I think that it remains a streaming story. I think we're going to see, we still don't know how quickly Black Widow is going to fast follow for a purchase and for inclusion on Disney Plus, and the numbers are going to drive that. But I think that, and that decision hasn't been made, but I do think that it will be a fast follow. We're already seeing a strong, strong support with Raya and the Last Dragon being same day available on Disney Plus for purchase. So, I mean, Black Widow is obviously going to be their biggest hit of the year, so they're not taking any big risks with that. But I still think this is Disney's year of and it's going to continue to be Disney's story around being a streaming first company. And we'll see that support with how quickly Black Widow comes out on Disney Plus.
Yeah. Ben, I'm curious to know how you view the competitive landscape right now. Obviously, they're way ahead of schedule on their Disney Plus sub target. They've done it in a fraction of the time that it took Netflix to get to these levels. And they've got, as Needham argues this morning, world-class storytellers, despite having half the value of Netflix. I mean, how worried should Netflix be?
I mean, I do think you're sort of seeing this split between the companies that with the acceleration of the pandemic, kind of made it over this line. And that really, Netflix obviously had this huge lead. Disney got there just in time and then just had this, the pandemic gave them this incredible year for streaming. And then I think there's, you have Warner Media and NBC who launched in kind of confusing ways in the middle of the pandemic. And it seemed, and are just aren't in the same, just aren't in the same league at this point.
I wonder, Heather, whether part of the message here is that this isn't about a la carte anymore. It's really more about who gets to control the bundle. Because even though you can get some of these services still, yes, one-off, you see them forming bundles. You see some of those initial kind of digital forms of cable that were more lower cost offerings either falling up or hiking up their prices. Is this really more about control and offering better bundled offerings? We see Apple doing that too. And should we expect to see more of that in 21 and beyond?
Yeah, absolutely. I mean, this is a world that is unbundling with all of the media companies launching their own services. And I think that over time, over the next few years, you'll start to see some consolidation as services either, succeed or fail of their own accord. And then and Disney is poised to actually win this fight across the media companies, and I think you will start to see some rebundling, but it's going to take a while. This is still very early days for the direct-to-consumer streaming world, and I think that we are going to head into rebundling, but right now it's about the winner of this current battle, and then over time, winner will take all.
And then that rebundling includes different types of content, too. I'm thinking about what Apple is doing with Fitness Plus. You can imagine Peloton getting into this game as well once they get their supply issues worked out, right?
Yeah, absolutely.
Ben?
Yeah. I mean, I think there is this world where everyone is a media company. I mean, everyone from Spotify to the New York Times are looking to bundle or to be part of those bundles as well.
Ben, we got to turn to paying for content. This Microsoft move supporting this Australian law that would have Google and Facebook pay publishers, and then saying that they would support a similar move back home. How significant is it? And I just wonder, I mean, a News Corp, for example, at an all-time high, also upgraded at Morgan Stanley. Do you think we're starting to see that reflected in sentiment around some of these names?
Yeah, I do think that the long struggle between the tech companies and particularly the news media is starting to play out in certain ways. Australia, News Corp's base, is acting really aggressively to essentially force tech companies to compensate publishers for, the news you see in a Google search or on your Facebook feed, and doesn't really have any of the kind of sense of humor about antitrust that we have in the U.S. And what was so interesting is to see Microsoft, which is not exactly the equal, where Bing is not exactly caught up with Google on search, essentially dive in on the side of the publishers. And I think what you're seeing has gone from being like sort of a hazy regulatory mess to being a really classic fight between big companies, a tug of war, a lobbying fight in Australia and Europe in particular. And I suspect that whatever resolution you get there will, as Microsoft suggests, be imported to the U.S.
Yeah. I wonder, Heather, I mean, I'm not sure how much you wade into this part of media, but to Ben's point, it is interesting to watch Apple start to find wedges on privacy. Apparently now Microsoft finding wedges on paying for content. It does set up a much different relationship that we've seen where in the past, whereas we've sort of looked at these giants as common behemoths, but now they're definitely finding their differences.
Yeah, I mean, they absolutely are. But, they all have, the common goal, obviously, of bringing all of the world's content to and being the place for everyone to discover content. So they're aligned in that way. And, we'll see how they can differentiate over time. But certainly, at the end of the day, everybody is in the direct-to-consumer world, right, trying to own their share of the conversation.
Ben, when I look at what Brad Smith at Microsoft is doing here, it in one sense isn't that surprising because Microsoft for a long time has taken a more institutional view of news. You know, they used to be a partner with MSNBC, even, you know, so paid content in cable was something that they were interested in way back when. But I see these lines of demarcation forming where you've got Apple, for example, with Apple News and Microsoft more in the camp of saying, well, let's set aside types of news that are maybe more credible, maybe more traditional, maybe worth paying for, whether the audience agrees with that or not. And that's set up against Facebook and Google, who are saying, hey, we're just linking to stuff out there that's being offered for free. Why should we have to pay for it? Is this more about the principle of content, you think, or is it more about potentially weakening some of these other tech giants who are getting their revenue from advertising more than from people paying for a product?
I mean, I think it's certainly both. That it's, you know, you have people, you know, you have Google and Facebook in particular under this massive global regulatory and sort of PR assault, you know, for essentially being like the world's leading distributors of misinformation and garbage. And so and the pendulum is obviously swinging back toward a place where, you know, where it's like, oh yeah, those gatekeepers who we threw out, we kind of like them again. And so I think Apple and Microsoft, you know, feel like the wind is at their back, like these other companies have this huge problem and they're taking advantage of it in every way they can. And the news industry, which is, you know, a rounding error to these companies, the entire industry basically, is a useful wedge, as you said.
Yeah, that's definitely true when you think about the totality of their businesses. Guys, there's a lot that's going to get interesting in the weeks and months to come. We hope you'll come back and chat it up with us. Good to see you both, Heather Musnick and Ben Smith.
Nice to see you.
Liking the gatekeepers, though? I don't know. That might be a bit far. Affirm CEO, meanwhile, and PayPal Mafia member Max Levchin is going to join us next. With that stock down quite a bit, it posted its first earnings report as a public company. A lot more Squawk Alley still ahead. Stay with us.
Change is all around us, shaped by technology and human ingenuity. We can make it work for you and your business.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
Daybreak in the US.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC. Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Welcome back. Shares of Cloudflare having a rocky morning despite results and outlook that both top the street's expectations. But keep in mind that stock up about 400% in the past 12 months. Well, with us now in a CNBC exclusive on the quarter is Cloudflare CEO Matthew Prince. Matthew, welcome back. So what a run Cloudflare has had, and these results kind of capping off a strong year. What do you think is the main challenge ahead in 2021?
You know, I think that for 2020, it was just an extraordinary year, and we're really proud of the role that Cloudflare played, making sure the internet worked how we all needed it to during the pandemic. And so I think we're really excited for 2021, both as things return to normal and what we're seeing in terms of the vaccine rollout and our help with states and local municipalities to do that. But I think that we're incredibly well positioned in order to continue to deliver the services that we have and help our customers make sure that they can go through their digital transformations and be successful in what is going to be a more complex world going forward.
Now, I think some investors are looking at that 2021 revenue guide up 37% at the midpoint and saying, boy, that's a deceleration. What kind of normalization should investors expect, and what are the ways that you expect to continue pushing forward and gaining share as that happens?
Yeah, you know, I think that we want to be really prudent about how we're looking at the future, and there's a lot of uncertainty ahead. But our revenue guide for 2021 at 37% growth is up from what our 2020 guide was. And so, you know, I think that we have shown that we can execute during what are very challenging circumstances. And I think that the tides of the IT change to moving to the cloud, to focuses on security, the focuses on zero trust, are very much in our favor. And we're looking forward to executing as we have year after year.
Tell us about maybe strategically how you were able to get the kind of growth that you did in those customers with more than $100,000 in annualized recurring revenue. I believe that was up 57%. And as you look at both the guidance and just overall the strategy for 2021, how much of that is going to be with that larger customer set?
You know, Cloudflare serves an incredibly broad set of customers, and we had a record quarter for total customers. We added over 10,000 total new paying customers, but we saw especially strong growth in our largest customers. And what we're seeing is that the biggest companies in the world are increasingly relying on our network in order to make sure that they're fast, reliable, and most importantly, secure. I think as we see more and more security incidents, it puts more emphasis on why having a network like Cloudflare, protecting your infrastructure, is absolutely critical for any business that's online.
Talk for a bit geographically about Asia Pacific. You're going through a transition in China of partners there, and so the growth in China was a bit slower than the growth in Europe and the growth in the U.S. Do you expect that to normalize? Are there signs of that, or is there kind of continuing challenge in that transition?
You know, we have about half of our revenue that comes from North America, but what's really remarkable is that for a company that is still as relatively young as Cloudflare is, more than about half of our revenue comes from outside of North America, and we have had incredibly strong growth in Europe. And as you mentioned, one of the things that's unique about our network is that it actually extends into China. And so since 2014, we've been working with Baidu as a partner there, and they've been a terrific partner for us. The contract with Baidu came up for renewal, and we looked for ways that we could increase the performance of our network inside of China and give one unified network around the entire world. And JD really stepped forward. We're working with them over the next 3 years in order to turn up Cloudflare's network in over 150 locations across China. And what that gives our customers is the ability to, with one unified network, sell anywhere in the world and do business anywhere in the world. And I think that's very unique about what it is that we're delivering.
You're in the neighborhood of a $25 billion market cap. We've been talking a lot about M&A on Squawk Alley. Is this a time to use that currency and maybe pick up some innovative companies and technologies that could fuel your growth?
I think one of the things that I'm really proud of at Cloudflare is how much organically we've been able to deliver products and new features. And so in 2020, we delivered 550 new products or features across our platform. And so our R&D efforts are really yielding results. And I think if you can have organic development, that's always our preference over inorganic M&A. But we're always looking for interesting companies and interesting technologies. And so we're not religious against it, but we're definitely biased towards our internal development when we can deliver products as effectively as we've been able to.
Well, if you find something interesting, be sure to come back and let us know. Matthew Prince, CEO of Cloudflare, thank you.
Thank you.
Guys, watch Twitter today. It's on pace for 10 straight gains, on pace for the best week in about 6 years. It's been 8 years since Twitter hit an all-time high of 74.73. Really not that far away. We're going to watch that as Squawk Alley continues.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
How inclusive is advertising?
If you're leaving out so many marginalized groups, the message that we're sending them is that they're not important.
Our industry reflects society. As a culture, the UK does have systemic racism. Our industry has systemic racism.
Why it's important for business?
Not only is it a good thing to do in terms of being a member of society, but it's good for the bottom line.
We begin a 2-part special exploring diversity and inclusion on the next Marketing Media Money.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Are really leaning into a digital first approach when it comes to building their relationship. So prior to the pandemic, you would see people engage on the product and then they would jump into the real world as far as interaction went. And this fascinating shift has taken place that we think is here for the long term, which is people are getting to know each other on our products. They are spending time on video, on audio.
Bumble's founder and CEO Whitney Wolfe Herd with us yesterday ahead of the debut. Stock was up 60+% yesterday, another 15% today. She's now the youngest woman ever to take a company public. For the full interview, go to CNBC.com. In the meantime, Squawk Alley's back in a moment. 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
I'm Courtney Reagan, and here's your CNBC News update at this hour. Former President Trump's defense team is getting ready to lay out their case to the Senate. The presentation is expected to last 4 hours. President Biden refusing comment on the trial, but saying he is watching for the outcome.
I'm just anxious to see what my Republican friends do, if they stand up.
And you're not planning to speak with any of them about what they should do or how they
I'm not.
The Biden administration has launched a formal review of the U.S. military prison at Guantanamo Bay with the goal of closing the controversial facility. This according to Reuters. The agency says the president is considering signing an executive action on the matter in the coming weeks or months. And Amazon is suing New York Attorney General Letitia James to stop the state from taking legal action over its early COVID-19 response. James calls Amazon's suit a, quote, sad attempt to shift attention away from what she describes as unsafe working conditions. Carl, back over to you.
Interesting wrinkle there, Courtney. Thank you very much. You know, John, I was just thinking the contentious relationship between Amazon after New York City didn't work out and now the state AG. Just looking at the shares, it's curious. They've had a lot thrown their way in the past, say, 6 months, but really has moved in a flat line since about Labor Day or so.
It has, and this is Amazon not appearing to back down here, kind of taking on Letitia James and the New York political establishment directly. We'll see how it works out, Carl, but interesting, aggressive stance from Amazon.
Yeah. We are getting some breaking news remarks from the Treasury Secretary. Steve Leisman's got it. Hey, Steve.
Morning, Carl. Treasury Secretary Janet Yellen, in her first meeting with G7 finance ministers, striking a very different tone from the prior administration when it comes to engagement with allies, saying that the U.S. relations with other countries will change dramatically under the Biden administration, which she says is committed to multilateralism. And here's a quote from a statement put out by the Treasury saying the United States places a high priority on deepening our international engagement and strengthening our alliances. You'll remember that the prior administration had something of a confrontational and somewhat cooperation stance with G7 allies. On policy and spending, Yellen saying, quote, "The time to go big is now," as she urged other G7 countries to spend when it comes to addressing the pandemic. She expressed her support for G7 efforts on climate change and also saying the G7 must address challenges facing low-income countries. One other thing, maybe perhaps apropos for this particular show, the Chancellor of the Exchequer, you remember Britain right now, is the head of the G7, calling on G7 countries to reach a multilateral agreement on some of those thorny issues when it comes to digital taxations, currencies, international servers, and do so by mid-2021. John, that'll be an ongoing issue for this year.
Indeed. Steve Leisman, thank you. Meanwhile, Affirm posting its first results as a public company since its IPO earlier this year. It is down considerably this morning, despite beating the street on earnings and guidance. Affirm founder and CEO Max Levchin joins us now. Max, good to see you. Good morning.
Morning. Thanks for having me.
Now, I just think it's really interesting in some of the slides that you had along with earnings, you showed the industry gross merchandise value mix. And of course, sporting goods and outdoors is at the top at 31%. We know Peloton is a really big customer. But then you've got home and lifestyle, I believe. I can't tell if that's home and lifestyle or travel and ticketing. And then you've got fashion and beauty. Tell us about the growth in those other two 17% categories that make up a little more than a third of the GMV flowing through Affirm.
I think it's safe to say about 2020 that the travel and ticketing is the little 4% one.
Right, I figured, yeah.
Yeah. Funny fact, or maybe not so funny, 2019 was a major investment year for us as we brought on lots and lots of partners in travel. And 2020 was the first year that was not the travel year. So it's an interesting timing, but the 4% there is really the lack of travel in 2020, which we very much hope to see improve. Incidentally, we are seeing it improve, so that's the really good news there. The other 217 buckets are fashion and beauty, which incidentally sped up over the holiday period, which to me says people are expecting to be seen. Also, about a quarter of our customers that we surveyed were buying travel during the holiday period. And so that's also growing. So in general, I think the consumer sentiment just prior quarter has really been all about, hey, we've been cooped up for a long time. We think we're going to come out and see the world.
Yeah, people got to put on makeup for those Bumble profiles, I suppose. So let's talk about Peloton because they've had some challenges getting bikes out. At some point, does that become a factor that you have to talk more about because they are such a large customer and it could be a gating factor to you getting the revenue that otherwise would be flowing through to Affirm?
First of all, we love Peloton. They've been a fantastic partner, and we'd like to believe we've been a great partner to them as well. Our business outside Peloton accelerated. We grew 40% faster in the non-Peloton part of our business just in a prior quarter. And so I think that's good news for Affirm. That said, I think John literally chuckled when someone asked him on his earnings call, is that consumer demand slowing down? And while they have the logistical challenges to work through, it is a result of incredible demand. And, as a partner, we see that the demand is strong. So my sense is, everything is going to be probably fine in that partnership for us. We're very happy with how they have performed. But of course, we're very heavily investing in all the other partners that we have.
Now, we like to remember origin stories, and you and Elon Musk were both at PayPal early on. You're one of the kind of godfathers of fintech because of that. Now, Elon Musk at Tesla recently began building up this hoard of Bitcoin because he wants to be able to transact, let people buy Teslas with Bitcoin. Right now, Affirm is not accepting Bitcoin as a method of repayment, I believe. What's your take on the role of Bitcoin in this fintech ecosystem?
Well, first of all, I think I'm a known crypto skeptic, so I'm always very careful. That said, it is incredible how Bitcoin and all the cryptocurrencies have grown. And I think at some point, skeptic or not, you have to listen to the market. So maybe we'll start with Dogecoin, but it is something that you have to pay attention to. I think MasterCard a couple of days ago announced that they think Bitcoin is something that they will consider seriously inside their network. And if you have an asset that's growing in value as fast as Bitcoin is, I'm not sure people actually want to spend it. But if it becomes a medium of exchange that folks want to actually use to buy their Pelotons and their sporting goods and their outdoor, we will have to consider it.
I'm curious to know, Max, obviously this is becoming a very top priority question for corporate leaders, whether or not they're willing to invest in at least Bitcoin on the heels of the 10K out of Tesla. So far, Uber, GM this week, PayPal last night on our air said not yet. I wonder, are you sensing reluctance, at least on the part of enterprise companies, to doing this directly? Does it remain a consumer story in your mind for now?
Again, I think it's a slow but steady waking up process where corporate players are saying, all right, this thing is here to stay. It's very real. It's well past the interesting, quirky idea that some, cyberpunks are excited about. And so I think everyone is looking at it and asking the question, is this an investment class that you have to consider? Is this a currency that people actually want to not just hoard and watch appreciate, but also spend? And so my guess is that we are in the early stages of corporate awakening to cryptocurrencies.
Yeah. And I assume, to tie it back to Affirm, and your general view, your long-term view has been that consumers, especially millennials and Gen Z, their trust in traditional financial institutions has eroded. And as a result, they're searching out alternatives. Maybe Bitcoin is one of them. But clearly, that's the ongoing thesis behind the model of Affirm, right?
That's exactly right. So in that sense, I think I'm talking my own book a little bit here, but we are seeing massive growth in buy now, pay later segments. All the products that we bring to the market are built around this idea of bringing financial control, sense of certainty, sense of safety back into the hands of the consumer, and just letting them do more with their money. And so Bitcoin in that sense is very much a parallel, type of a product, because it is designed to bring money to the people, democratize investment, democratize payments. And so in that sense, it's extremely aligned with what we're trying to do.
Max, what kind of shifts are you seeing in consumer behavior as we get further into 2021? Willingness to spend, perhaps concerns about job loss, job stability, presence of stimulus. Is any of that showing up in the patterns that you see?
Absolutely. So a couple of random factoids. Stimulus, I think U.S. government, whatever your political views are, does not get enough credit. I think stimulus was an incredibly important thing and continues to be an incredibly important thing that a government has done for its people. We have a savings account product that we offer to our customers as a part of the overall agenda of just letting them do more with their money. And we saw meaningful increases in our savings deposits as consumers started receiving their checks last year when the government issued the stimulus. And so in that sense, we see people saving, at least in the Affirm ecosystem, but also starting to feel a little bit more comfortable spending, even among those that were concerned in our surveys for their jobs. Another sort of interesting consumer trend, people, again, in the Affirm universe are becoming more planned about their spending. We saw a really interesting trend in the last quarter. Holiday shopping began much earlier, and retailers caught on to it and started promoting their deals early. But that normally happens, and yet the growth towards Black Friday, Cyber Monday was really steady, kind of an increasingly rapid drumbeat as people were thinking, how am I going to spend my money? How do I get my gifts, etc. Half the customers we surveyed said that they will move almost entirely to online shopping for their holidays, which is significantly more. And so I think sort of the shift from offline to online is very real, very powerful. I don't think we're going back to sort of full scale offline, what we left behind even after hopefully the vaccines are fully distributed.
That's really interesting, especially for a digital-leaning part of the ecosystem like Affirm. And then I also want to ask about some of the fallout of this chip shortage that we've seen across so many industries. And the reason why is that we were just talking about the impact on the auto industry, and equipment and auto was a 9% GMV category for you. I wonder if perhaps as new cars get more difficult to purchase, you're seeing more people either fixing up cars, buying auto-related equipment to improve cars versus perhaps just spending on getting a new one flat out. Is that a driver that you see?
The dominant use case for the auto part segment for us is really people that have a passionate relationship with their car. And so a lot of this is people saying, I want to add a cool feature to my car. Sometimes it's connected features. Sometimes, it's a good looking auto part. I'm not an auto guy or a bicycle guy, so I'm probably insulting someone's good taste in their car. But we've seen a tremendous amount of demand in sort of auto enthusiasm, and that part is growing. And so I think that's probably something maybe tangentially confirmatory to what you're saying, but as we do not do auto loans, I couldn't really speak to what's going on in new car or used car finance.
Okay, so less fixing up their cars in the general sense, perhaps more chrome and those kind of aftermarket car show type add-ons, huh?
That's certainly a very, very passionate segment, and we love serving them because those folks have an unbelievable love for what they're buying. And a big part of what Affirm lets people do is afford things safely and comfortably. And sort of like, I have this thing, I love it, I have to have it, it's expensive, I will pay for it, I know exactly when I'll be done paying for it. And so in that sense, this hits right to what we're all about, and we love serving those people.
Max Levchin, founder and CEO of Affirm, thank you. Good to see you.
Thank you.
Go Grease Lightning. Check out shares of SurveyMonkey down 16% plus here on some weaker than expected guidance. We'll watch that, obviously, on the heels of their quarter. More Squawk Alley continues after the break. Don't go away.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Is that of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero, 90% of those are now back at work.
We are optimistic. The fiscal stimulus and investment will be boosting our demand.
We have already several quarters of contraction, so I hope that we could see some encouraging growth.
We are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Foreign tourism will be coming a little bit late that we expected earlier.
A big part of resuming travel would be to get standardized procedures.
Life insurance in Asia continue to be strong, and then some of these structural trends have been accelerated.
Working from home has been so much accepted in Japan. Some industries are booming, so they can absorb jobless people.
Divided by distance, united by business.
This is the new reality we're all
helping
in.
you navigate the new normal. Squawk Box on CNBC.
CNBC in Squawk Alley, we're observing Black History Month. Here's BET co-founder and CNBC contributor Robert Johnson on his defining career moment.
Black entertainment television in 1991
became the first African-American company publicly traded on the New York Stock Exchange. And my team and I rang the bell signifying that we were a publicly traded company participating in the U.S. economy. The fact that we were first, the fact that we symbolize what Black Americans can do if given an opportunity was one of the proudest days of my life in business.
More of those great stories next week, but in the meantime, you can head to CNBC.com for Johnson's full story. We are going to take a quick break. Don't go anywhere.
Keep up with the crisis, volatility, relief efforts, economic impact.
Union amid a recent escalation in tensions. Lavrov said Russia does not want to isolate from global life, but is prepared for that possibility. That story is on the website now. The UK economy contracted by 9.9% in 2020, its biggest drop on record, as the pandemic wreaked havoc and forced several sectors to effectively shut down. The UK economy is set to continue shrinking in the first quarter of 2021 due to ongoing restrictions. Head online for the full story. Disney beat subscription expectations in the first quarter, reporting 95 million paid subscribers to its Disney Plus streaming platform. The media giant also reported a profit rather than the loss analysts had expected.
ZocDoc, an online healthcare scheduling company, is now partnering with the city of Chicago to help streamline the vaccination process. Joining us to discuss is the CEO of ZocDoc, Oliver Carras. Oliver, welcome back. It's good to have you again.
Good to be here. Thank you.
We're definitely getting into that period where people are going to ask legitimately, okay, how do I go about doing this? And it looks like for you guys, Chicago is going to be an important city. Can you just tell us about the tools and how it's going to work?
Yeah, you're right. It's like finding a needle in a haystack to get your vaccine these days. And, this is a problem that's already solved, right? Like we did a great job as a society in public-private partnerships developing the vaccines. But now every city seems to go through their own trial and error process to try and find out how to actually distribute it. We can help just with finding it. For the last 13 years, we have been making healthcare accessible, integrating with multiple different players. And so for Chicago, we've created a central site where you can see all the various players that distribute the vaccine. And as a consumer, you don't have to go to 10 different sites, to 10 different registrations to just be told there's no vaccine available. You can see this all in one central place. Now, big disclaimer, it's obviously still a vaccine shortage, but at least you know that you can look at one central site and find it when it's available.
Right. Well, speaking of shortages, we've been hearing a lot from federal officials and people in the private sector about the promise, I guess you could argue, of the month of March, more likely the promise of the month of April. I assume you've tried to game that out. Is that when you see a real flip in the supply-demand equation?
I mean, for one, we need to just make it easier for patients to get access to this. It's not effective if we put a huge hurdle because you have to spend hours either on various websites or with call centers to try to get access to this vaccine. This is surprisingly hard, but on ZocDoc we can sort of help you book a vaccine within a minute. And so we need to make sure that we don't overburden patients to do this. I think there is obviously pent-up demand right now, but what will happen very soon, if you look a couple months out, as you just did, is that we will run into a population that's more vaccine reluctant, and we need to take out hurdles to do that. We can help with that. That's our core business, and we do that for free with the city of Chicago, and are stand ready to do this with any other city or provider that's in the process of distributing the vaccines.
Hey, Oliver, it's John Ford. I want to talk a bit about ZocDoc itself. You say you're profitable with accelerating growth and credit in part a variable revenue model that you shifted to recently. Tell us some more detail about that transition and how it works.
Yeah, that was a momentous transition for us. We started out over a decade ago as a subscription service where every doctor paid the same price, but it just created a hurdle for doctors to come on. We have since changed this model to one where doctors can join for free and then just pay a fee for every time a new patient books with them. Our ingoing assumption was that lowering the threshold would get more doctors to sign up, increasing access and choice for Americans, and that's exactly what happened. In the states where we first rolled this out, the provider numbers are up 50% and more, and all the other states are on similar trajectories. So we are very energized by this. Was one of the great events of 2020 for us.
So I got to ask, you might have noticed investors like IPOs these days, and if you've got accelerating growth and you're profitable, that sounds like a pretty nice combination. Why not go public here?
That's a question I get a lot, but honestly, if you just look at what we did over the last 12 months, we obviously finished our business model transition. We saw the accelerating growth. We also very quickly transitioned into telehealth, right? During the pandemic, we built one of the largest telehealth networks in the country, on par with Teladoc and Amwell. And more than 10,000 providers are participating in this. And, as you just mentioned, we recently expanded helping out in the pandemic by organizing the vaccine effort. So we have a lot to do right now, and that's what's mostly on my mind, right?
So that's a great question to end on, because it's an analog to all the other questions we have about streaming versus going to the movies, about working remote versus going into the office. Is telehealth going to... I assume we're looking at a period of deceleration once it's obviously safe to go back and see your doctor in person, or I don't know, maybe not. Maybe the convenience is what takes over from here.
So look, telehealth is here to stay in some shape or form. But what's pretty clear to me is that consumers don't want to go to one side for their in-person visits, right? And they in-person will remain very relevant, right? There's no televaccine because there's the same reason there's no telepizza. You need to actually physically be joined with a treatment, but they don't want to go to one website for in-person, one for telehealth, for one for prescriptions, for another one to have price transparency. They want a one-stop shop, and ZocDoc is best positioned. We're at this point the only hybrid platform that has both in-person and telehealth available, and we are really well positioned to serve the consumer holistically as their one-stop shop.
Congratulations on the funding round, which is important to mention as well. And we love talking to you about the future of medicine. It's obviously changing before our eyes. Thanks, Oliver.
Thank you so much.
Keep your eyes this morning on Alphabet. Citi, a bit conflicted on the stock. They reiterated buy. They take the target up to 24.15, but they do take it off their top pick list. You can get more on that on CNBC.com. We're back in just a minute. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population.
We can certainly regain for our country the respect of the European partners, and I'm sure we will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure it will be able to understand and to heal the growing social malaise.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of million, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
In case you missed it, Chappelle's Show is back on Netflix starting today, ending a long-running dispute with Comedy Central over the show's rights. Dave Chappelle made the announcement in a 10-minute Instagram post last night titled Redemption Song. Carl, it's interesting. In that Instagram post, he says, and I quote, "I never asked Comedy Central for anything. If you remember, I said, I'm going to my real boss, and I came to you," referring to the audience, "because I know where my power lies." Reminds me of the Reddit revolution a bit.
That's true. He really did crowdsource that negotiation, John. But it does sort of also bring to mind the notion of storytelling ability, i.e. Disney versus Netflix and animation and so forth, but also library. A lot of the intellectual property is going to be so important, and a lot of that's already in the vault. By the way, one more note, an interesting report making the rounds on Twitter today. The site Above Avalon estimating that the Apple Watch is now worn on 100 million wrists, passing that milestone last December. Approximately 10% of iPhone users doubling up with the watch. Remember, John, when wearables was sort of a big question mark as it pertained to Apple?
Yep, I remember, but now they got the watch, they got the AirPods, they got the AirPods Max, which they are charging a mortgage payment for, and they appear to be getting it.
Yeah. Next week, guys, it's going to be another, earnings are definitely cooling down, but we're going to get some retail. We'll get Walmart and some big travel names, including Hilton, Marriott, and TripAdvisor. So have a good weekend, good long weekend. We'll see you on Tuesday. For now, let's get back to headquarters. Melissa and the half.
And welcome to the Halftime Report. I'm Melissa Lee, and today for Scott Wapner, front and center this hour, stocks on pace for another week of gains. Record inflows into equities and technology. What is signaling about where this market goes from here? We'll discuss and debate the next steps for your money with the Investment Committee. Joining us for the hour today, Jim Leventhal, Pete Najarian, Shanna Sakosha, Chief Investment Officer at Boston Private Wealth, and Jenny Harrington, CEO and portfolio manager at Gilman Hill Asset Management. Let's get a check on the markets here. In a little bit of a pause after we close at record highs for the S&P as well as the NASDAQ yesterday. S&P up by 0.2%. Same for the NASDAQ. The Dow looking almost unchanged. The real action, if you can call it action, on the Russell, which is the outperformer for the week. So what did we make of the week, Pete? And it may seem like a quiet day today, but the context, as always, is the most important thing. We have gone through the bulk of earnings season. Earnings have been very good. We've gotten earnings from big technology, the leaders of the market. They have been good, and here we are, still sitting at record highs.
Yeah, it's pretty amazing, Mel. And if you go through the earnings, yeah, they started off with the banks. The banks' earnings themselves were really strong, but some of the reaction, obviously, is what happens, it seems like, time and time again. But overall, that move has moved back up to the upside. We look at the 10-year, and you can suddenly see a lot of the different banks, not just the financials, starting to move to the upside. And you look over at the financials each and every day, and it's Capital One, it's Goldman Sachs, it's Morgan Stanley. They just continue to move to the upside, the Wells Fargos of the world. So we've got that sort of on the backdrop. But also, how about this run in oil? This just continues to run to the upside, and we've watched energy now. It seems like we go up a little bit, Mel, and then we step back just slightly, then up. And that just seems to be the direction that we're going when we're talking about oil, because we take a look at where crude is right now as it's pushing towards closer and closer to $60 a barrel. And these beta names have been absolutely on fire. We've had nice moves out of Chevron and Exxon and the usuals. But it's that next level down where you're getting those really big hits from the Occidentals of the world, Devons and some of those different types of names. So I think this is a little bit more broad than people talk about. I think when you really break it down and then you look at just technology itself and you look at the NASDAQ, it isn't just about technology. It's semiconductors. It's a biotech. Semiconductors and biotech seem to hit new all-time highs, it feels like, almost every day. And then we get the pullback, and then everybody gets a little bit nervous, and then all they do is reload. So I think there's a lot of reasons right now to just try to not fight the markets and just try to ride along with the markets, especially with volatility trading as low as it is right now, Mel.
I am glad that you brought up oil, because I was watching intraday crude prices, Pete, and they are pushing to intraday highs at this point. We've got Brent pushing to 62 here, and this is probably the most hated trade, or amongst the most hated trades in the markets that have gone higher. And as Peter mentioned, energy is among the leadership groups in today's session, with the XLF up by almost 1% at this point. Lebenthal, where do you stand here on energy?
Yeah, well, I think it's a great question. Thanks for asking it, because part of why energy is high right now is because of unexpected discipline from OPEC Plus. And frankly, not just OPEC Plus, but the shale producers. Everybody has sort of stepped back and let prices go up without flooding the market with supply. That's unusual. That's a huge contributor. I also think, and this may be a little bit provocative, but I think this administration is making it very clear, not this part is provocative, very clear that they don't want fossil fuels. And the actions that they're taking are likely to raise the prices of crude oil and natural gas going forward. I'm not taking a political stance in this. I'm just simply saying if you refuse permits for pipelines, then it's going to be harder to get that supply onto market. So on the margins, that will increase crude oil prices as well. So you put this all together, and it looks pretty good for energy prices to stay where they are. Particularly, I didn't even mention demand. If demand starts picking up as the vaccines get rolled out and we start traveling again, this looks like a good year for energy, Mel.
What was that? What was the provocative part of that? Did I miss?
Well,
did I
the
miss
provocative
it?
part. No, the thing is I don't want to make it a political discussion, Melissa.
Sure.
You know, I don't want to say who's right or wrong.
Right.
It's just clearly the policies of this administration are designed to create bottlenecks in the supply of oil.
Yeah, you make it harder to drill for oil. You make it harder to get oil onto the market. It's a supply and demand issue. Oil prices go higher. So, Shannon, do you buy into that? Is oil a place to be at this point?
I think it represents such a small part of the index at this point, Melissa. It's really hard to make a case that you want to try to pick one of these major oil companies and continue to build around it. So we have very limited energy exposure in our portfolios, and the reason is that we see better opportunities in other parts of the market. I do not disagree with Jim's modestly provocative statement that the energy renaissance here in the United States absolutely contributed to the fact that we've had depressed energy prices over the last few years. You know, we have more supply. I do think that supply will continue to come online. I do not think OPEC Plus will continue to be as as disciplined as they have been. You know, I think that there are a lot of things that impact those relationships that are outside of, you know, our purview. But I do think that if you're looking at your overall portfolio, where you want to be, we have, as I said, limited energy exposure. We're in EOG and Valero, like those names, but I wouldn't be adding significantly to my energy exposure in this environment because I do think that there's going to be some cross pressure on oil prices later this year.
Yeah, we are watching the XLE push to session highs at this point with Brent up by more than 2% right now. We're watching it tick higher. So Jenny, I will go to you. You know, wrapped up in Jim's modestly provocative statements is the notion of inflation. And we saw that also highlighted in the UBS report where they say, you know, you ride the spike train. You saw hospitalizations. You saw stimulus come in response to the hospitalizations and the rise in COVID cases. That stimulus heats up the economy. That heating up of the economy leads to inflation. And while it may be in pockets of the economy, there will be inflation. I'm wondering if that is part of your investment thesis, because it looks like oil falls squarely into that.
Right. So with respect to inflation and our investment thesis, we're always long term. I think when I'm thinking about inflation and what the impacts on that are as we invest, what we can look to is in 2020, when the 10-year went from 1.6, dropped to about 0.5% and started to move back up. But when it dropped, what happened was it basically added 3 multiple points to the broader market. And that happened in a very bifurcated way. I think that the 3 multiple points went disproportionately to the large end of the market. One of the things I'm expecting is that as bond yields start to move back up, those 3 multiple points might be taken back out. And they might be taken back out in terms of the big names that got them just plateauing and the earnings growing into them. But for my investment thesis for the portfolio that I manage, that we all know is a dividend portfolio, kind of value leaning, it's got a much lower multiple than the broader market. So I don't think that there's risk in those stocks that are trading at a discount to the market in losing that. So inflation, you know, as it affects multiples in the market, that's how I'm thinking about it. Just one thing on energy that I think is really unique and interesting. This is a technical, but as we get closer and closer to March, when the price of oil plunged from, what was it, at 40 to 26, and then we got into that crazy thing in April and May where it went negative, that's actually, as those comps come in, there could be a big push in the momentum trade because you're going to have really, really favorable comps coming in, both in terms of earnings and share price appreciation off of those numbers. So there could actually be a shift in a momentum, or some quantitative programs could start to push energy as we get to the 12-month anniversaries of that. Additionally, I heard that hedge funds are something like short energy 5 times more than anything else in their portfolios. So there are some technicals that could put further wind at the back of energy in this inflation, regardless of inflation and how that plays in.
I'm sorry. Can we
and by the way,
that?
We are overweight.
Can we repeat that, Zach? Because I actually think that is a provocative statement. That hedge funds are 5 times more short energy than any other part of their portfolio?
This is what, of the short portfolio, this is what I heard on a call earlier this week. And so I think that whether it's 5 times, whether that number is precise or not, I think directionally, to me, when I heard that, I thought, whoa, this is a really big statement. There's a big short position in energy. And so as this momentum trade could push it, you know, maybe that erases, maybe those shorts are covered. And I'm not, please don't get me wrong, I am not saying we're going to see anything like this short chase that we saw over the past few weeks. I just think that as energy stocks start to improve, there's a lot of fundamental things that could play into pushing their share prices quite a bit higher.
Right. I take away from that energy is a very hated part of the market, Pete. I also take away from that that this momentum that we're watching, you know, unfold even just right here before our eyes in terms of the energy stocks could actually continue because of that short squeeze. Do you see in the options market, Pete, any sort of signs, fingerprints of, I don't know, the retail trader getting in on this, perhaps, maybe with very short dated options in energy?
You know, that's a really good question, Mel, and it's something that we have seen time and time again. And it was long before all of the conversations about GameStop and all the rest of it. You go back to November and you take a look at the XOP, which really is a great example of what I talk about when I say beta names, the Diamondbacks of the world, and all these various names that we throw out there. But when you take a look at what's been going on, Mel, since, call it the start of November, right around the election time to now, that run is absolutely extraordinary. And I think that this run, yes, I have seen a lot of option paper and a lot of these smaller next level names. We've also seeing it in the big names, though. So it's kind of gone across all of energy, where I see huge option paper in the XLE, in names like Exxon and Chevron. But then all of a sudden you take the next tier down, the beta names as I call them, and you really see huge option paper that's been coming in there, it seems like, week after week, and continue. Now, they're not always right. Are they always right with the timing? Absolutely not, because you're right. They do mostly go short term, because these are short term, looking for a big jump type trades, and more of them have worked than not. So I think that's something that keeps them coming back into this trade. But this is a part, because you mentioned it is such a hated trade, right? I mean, everybody wants clean energy and this and that and the other. But on the other side of it, you take a look at the price of oil and how it's run to the upside. And you take a look at a lot of these names that have really come off the mat, that were really sold off and just about to be put out to dead. And then suddenly we've had this big surge to the upside. So we have seen much more than normal amounts of unusual option activity that has come into a lot of these oil names, but specifically more so, I think, to the next level oil names as opposed to the big guys.
Yeah, can you give us just an idea, Pete, of some of those beta names that you were talking about that's seeing heavy flows short term?
Sure. I mean, we've seen it in the short term over the last couple of months in Apache, in Devon, in Occidental, in Diamondback. I mean, you could go through a long list. Parsley. There's a lot of different names out there where we've seen this consistent sort. There are names that I'd never heard of, Mel, where I actually have to go back and look up, hey, who is this? And what, you know, I know it's an energy name, but I have to look up and sort of research it, because they are reaching for some of those names where I think they were left for dead, and maybe there's a little life left inside of them. So we're starting to see some of the paper in some of those names as well.
All right, let's get to technology at this point. As we mentioned at the top, record inflows into the sector, and the second best performer so far this week. And of course, we have to talk about technology since it's the biggest part of the market. Jenny, where do you go in technology? Do you think that maybe valuations at this point are getting stretched?
This is another tale of two cities. So you have the big tech, and I think on the big tech, valuations are stretched. I also don't think that that means that many of those companies need to trade down significantly. So if we're talking about Facebook, Amazon, Apple, Microsoft, they could plateau. In fact, they mostly have plateaued since the end of September. Apple's up 5% since September. Amazon's down 5%. Microsoft's up 8%. You know, it's just Facebook is down 8%. So they've kind of plateaued. I don't think that you need to be in those, and I think this gets into the bigger thing, this this rotation that we're starting to see in the market. I think that you can look to the have-nots in the technology sector, and money can move into those, and then those can start to really improve off of the either lows that they saw last year or the no performance that they saw last year. So I think there's a leadership change even within technology, and you see that too, Melissa, when you say we had some of the biggest flows into technology last week, but you know what? Tech is still up only about 6% on the year, where energy's up 16%. So it doesn't mean that tech's just on fire. I think the whole sector is balancing out.
Right. And
I don't think the big guys are seeing the huge flows.
Yeah, and as Jenny had mentioned, there's a lot of push-pull within big cap technology. I mean, take a look at the call on Alphabet today. Citi raising its price target on Alphabet, but saying it's no longer the top pick. And some can argue that what we've seen in the share price of Alphabet over the past couple of months or so is a re-rating of the stock that it had deserved, that it should have never traded as low or underperformed the rest of its peers for quite some time, Jim. Where do you stand on this sort of call? Because they're saying that they are bullish in terms of growth from a dollar perspective on YouTube, on search, and all of these properties, but not as bullish as peers on the street.
Well, when we talk about Alphabet, I mean, one of the things to talk about is Google Cloud that we weren't talking about a year ago, and now it's come up as a true competitor to Amazon Web Services and Microsoft Azure. So I find that in and of itself very intriguing. But Mel, let me go back to what Jenny said, if you don't mind, because I take the other side. I think this is a perspective thing here. I know Jenny. We talk a lot. I know Jenny's thinking about IBM and Intel when she says what she says. I'm looking, though, at the big caps, the Alphabets, the Facebooks, and the Apple, and I'm saying they are actually fine right here. What I'm worried about is the other end of the spectrum when you look at the software stocks, the Twilios of the world, the Shopifys. I mean, these are things that are trading at 50, 70 times sales. And that's where, when we talk about tech and we question valuation, to me, that's the area to question. Large cap tech, at the multiples roughly around 30 times this year's earnings for Microsoft, Facebook, and Apple, those guys will do fine this year. They may not lead the market. I think cyclicals will, but they'll do fine. It's the high-flying stocks that have a lot of air underneath them. They could hit an air pocket like Zoom or Fastly did and be down 40% and still be expensive. So that's the area that worries me.
Yeah, Fastly is an interesting case only in terms of its customer concentration problem that it had. But I take your point, Jim, in terms of if we are to believe that the economy is reopening, then should investors sort of reevaluate the high multiple technology stocks that they reach for in a period of lower economic growth because they wanted to pay up for that growth? Shannon, are you in that camp? Do you think that we need to sort of reevaluate those higher PE stocks?
Absolutely. I think that in this environment, those felt safe, or in the previous environment, 2020, those felt safe because there was an undercurrent of uncertainty as it relates to the reopening trade, as it related to what does business enterprise spend come back to, where are we from a consumer spending perspective. But I would also agree with Jim on, if you look at where these businesses are going to continue to drive earnings, I mean, that's really what we're looking for in the back half of the year. We're looking for earnings growth to support the multiple expansion that we've seen. And if I have to put my bets on what companies can continue to drive stronger earnings, even with a regulatory overhang, even with the results that they've continued to post over the last year or so, I would still look at some of these big technology names like Alphabet, like Apple, to be able to continue to grow earnings. And so I think it's important to differentiate. If you're focused on the fundamentals and you believe that there is going to be differentiation and a return to emphasis on top line and bottom line growth, I think that you have to have some of these quality tech names in the core of your portfolio. Do you need to reach for outsized valuations and expensive stocks in tech? Absolutely not. Jenny's right. You can find some things that are underpriced relative to their peers. But I do think that these still make sense from a core perspective. And what we're not seeing is what we were fearing last year, was that as we entered into this cyclical rotation, that people would be en masse selling their big tech stocks to fund purchases in areas like industrials, materials, and energy. We're not seeing that. We're seeing it come from the sidelines, which is exactly what we need to see to continue to see the indexes grow, because technology is 28% of the S&P 500. So we have to keep that in perspective.
All right. Speaking of valuation, semis sitting near all-time highs. A global chip shortage is really taking hold here. Josh Lipton taking a closer look at the state of the sector, what Wall Street is saying, and how the Biden administration plays into all of this. Josh.
So, Melissa, let's start with the SMH, the ETF that, of course, tracks the chips. It's on track here for its best week since early November. The big gainers this week, names like Applied Materials, Lam Research, and KLA. Now, I checked in with RBC's Mitch Steves. There has been more news, we know, about at least the potential for a new government support for domestic chip manufacturing. If that happens, Mitch says these names could benefit. He has buys on Applied Materials and Lam Research. Looking ahead, Bernstein's Stacy Rasgon says one key question for chip investors: what happens when pressure from this current chip shortage actually eases up? Do customers keep buying, or are they going to have to do they overorder and take a pause as they work through inventory? It's a big question that we don't have an answer to right now. So what does a chip investor actually do here? Stacy's saying stick with stocks with secular long-term tailwinds. For example, Qualcomm, he says, leveraging that 5G rollout. And he says attractively valued names. Stacy says Broadcom fits the bill there. Melissa, back to you.
All right, Josh, thank you. Josh Lipton on the chip shortage. Pete, we asked the question, what should an investor do? And you, an investor, bought AMD calls. Why?
Yeah, I think there's a lot of different opportunities out there, Mel. I'm already in Marvell. I'm in the stock and the calls, but I'm also in Micron Technology, and a lot of that is the 5G exposure that you can get out of both those two names. But when I look at AMD, Lisa Su has done an absolutely amazing job. We all know that, and that's a stock that I thought was going to break up and through 100 probably over a month or more ago, and it just didn't happen. It just sort of faded back, Mel, and it's hanging in the 90s. So I think there's opportunity there, and we had some option activity in there that stated to me that people are expecting some sort of a move still to the upside. I still think this is one of those premier names. They've obviously done away with Intel, it seems like, over the last couple of years. They've really done an amazing job of just dominating in that space and then creating even other areas where they've got plenty of growth. So I think AMD right now is probably still inexpensive at these levels. So I think there's upside. Now, has it stretched? It seems like it's stretched, but I think when you actually look forward and you look at the kind of growth they've got in all the categories that they are fulfilling, I think this is a stock that absolutely should and will be over 100 in the not too distant future.
Shannon, you agree?
I think that chips are challenging right now because from a investment perspective, if we look at, how many different industries and sectors that the, potential, chip shortage could be impacting, for chip manufacturers, right, you could see higher prices and better margins. For everything else, though, this downstream impact of, potentially higher chip prices, I think that they're a negative. We talk about this with energy a lot, right? This is great for energy producers. It's pretty bad for everybody else. And so I wonder a little bit about how investing in chip stocks, it does tend to be somewhat cyclical, and being able to pick, the particular chip. We have limited chip exposure. We've got ADI, and we're comfortable with that exposure. But I think it's difficult for investors, unless you're doing something that Pete's talking about and investing in a broad range of chips. I think it's difficult to buy and hold for the longer term. And I know I have colleagues on this show that feel differently about that. But I think that this chip shortage, the stress on some of the companies that are the downstream consumers of chips, I think that when we think about inflation, which you talked about at the top of the show, I think it's an important point to be looking at your portfolio and thinking about how that could manifest itself in the coming quarter.
Shannon, let me just clarify that then. In terms of the pressure, are you saying that because of a chip shortage, Ford is going to charge more for a pickup truck, or Sony's going to charge more for its console, or, the list goes on and on?
Yeah, well, I would sure like them to be able to, but Melissa, can they in this environment where we don't see consumer spending back to pre-pandemic? Right. This is margin. This is margin pressure for some of these downstream consumers, potentially, because I don't think that they can push that pricing pressure through. So good if you're going to own chips, as long as you're in the right companies, but I think the downstream pressure is going to be negative on a lot of these consumers of chips.
Jim, there's a real bullish argument to be made if one is to believe that the economy is going to heat back up again, that demand will increase across all sorts of goods that demand chips, that it's not just a chip shortage. We're actually taking a look at a sector that is extremely, extremely cyclical and leveraged to that sort of reopening trade. At the same time, if we are to believe that the Biden administration is going to be successful in bringing back chip manufacturing to the United States, there is an argument for, a Lam Research and Applied Materials, an MKS, for instance, in terms of building out fabs and building out capacity here in the United States. You need that equipment. Where do you stand?
So let me summarize a very complex situation by saying I'm very bullish on the semiconductors and the equipment manufacturers. Let's just start with the fact that they are cyclical, and we're in an early stage of an economic expansion that is likely to be fueled for the next couple of years by fiscal stimulus and monetary stimulus, not to mention reopening. But to the problem that we have right now, it is being solved right now. I mean, let's talk about Taiwan Semi. They've announced about 18 months ago that they're going to open a very big plant in Arizona, a multi-billion-dollar plant. Other companies are following suit. So this problem was known ahead of time, and it's being worked on. Most importantly, this is not just a chip problem. This is not just a U.S. problem. This is a global problem. The fact that President Biden is attacking it right now indicates that it's going to get attention from the highest levels. That's why I don't worry, for instance, about a General Motors, which reported great earnings this week, but sold off because of the chip shortage. The problem is going to be solved. Now, I don't know if that's 6 months, 12 months, or 18 months, but that's the sort of time frame during which the economy is going to continue to pick up. We already see demand, well, we'll just talk about autos. I mean, demand is through the roof for autos. They frankly, they're working overtime to try to get as many cars as they can back onto dealer lots. So I don't think the demand's going away, even if they have to curtail some of that supply because of the chips, not where we are in this economic cycle.
All right. Despite the recent record highs for the major averages, there are still a number of big names 10 to 20% off their 52-week highs. And Jenny, actually, you own several of these stocks. You're interested, though, in Pfizer. Why?
So Pfizer just reported earnings, and they actually had a really, really decent quarter. So what I look at a company that's now trading at 11 times earnings with a 4% yield. And in the earnings call, they said specifically, we do not think that our COVID vaccine is getting any credit in the share price. I think that's a pretty easy thing to prove out because you can see a share price that's not only off the high, but basically flat for over a year. One of the things we're hearing, and we don't know this for sure, but it's likely that we're going to need to continue to get COVID vaccines next year, the year after, and maybe a few years after that. If that's true, that vaccine could be a huge source of revenues for Pfizer that's not even remotely priced into the stock. So little things like that make me pretty positive and excited for that list of things that are still off their highs. There's a lot of potential in the market. And to Jim's constant point is it's a stock picker's market this year. It's exciting to find things like this.
I have a question for you, though, Jenny. Why is the assumption that even if you have to get repeat vaccinations, that the price of the vaccine will remain high? I mean, aren't vaccines usually commoditized over time, and so therefore the price comes down, and so it's going to be less of an impact for Pfizer?
They're making no money off of it right now, right? They're making nothing off of it right now. So it's just a source of revenue. I wouldn't say the price remains high. I would just say it becomes revenue producing in a positive way for them in the future.
Got it. All right. Disney streaming subscriber numbers, but shares pulling back after hitting all-time highs. Our experts debate what to do with this stock from here. Halftime report returns in 2 minutes.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
This story went from a dilapidated, rundown duplex all the way to the White House.
That's why the clients come here.
For money.
$40,000 would be paid for the killing of the judge and the prosecutor.
American Greed on CNBC.
I'm Courtney Reagan. Here's your CNBC News update at this hour. The Biden administration plans to allow about 25,000 asylum seekers into the U.S. so they can attend their immigration court hearings. The border crossings are set to begin next Friday. 2 men accused of helping former Nissan chairman Carlos Ghosn flee Japan while awaiting trial on fraud charges are asking the Supreme Court to delay their extradition. A lower court ruling had cleared the way for them to be handed over to Japan. 3 Fox News anchors have filed motions to dismiss claims against them and their employer as part of the libel suit brought against them by voting machine company Smartmatic. They say the case fails to specify defamatory acts. And star defensive end J.J. Watt has left the Houston Texans. Watt said he and the team mutually agreed to part ways. Watt had 1 year left on a 6-year, $100 million contract. That's your CNBC News update for this hour. Back over to you, Melissa.
It's a lot of money to walk away from. Courtney, thank you. Courtney Reagan. Disney hitting all-time highs after a strong earnings beat. Most of you own it. Pete, you actually sold your calls, though. Why?
Yeah, I was in it for the trade, Mel. We actually had some unusual option activity earlier in the week, actually on Monday in here. And I love this name. I feel like it is a little bit stretched. I understand the ecosystem of how well they've done with streaming. And when you look at that, those numbers, Mel, they're absolutely extraordinary. And you got to take your hat off to Disney in terms of that report. 146 million. They are not that far behind Netflix if you combine the entire ecosystem of streaming. So those were great numbers. The stock actually popped up. I got out of my calls immediately. I feel like it's a little stretched. Sooner or later, they will start to open. They will start to see the parks come back, the cruise ships come back, and a lot of the other areas where they got so much revenue that will absolutely impact the company. But for right now, it's all about streaming. So I'm more concerned about trying to trade it because I don't feel like I can own it right now and feel all that comfortable.
It's all about streaming, and should we be concerned about the quality of those streaming numbers, even though they look fantastic at first blush? I mean, in terms of the average revenue per user, Shannon, it looks like those numbers, that number is down year on year. Last year, we were looking at average revenue per user, ARPU, of $5.56. This year, we're looking at $4.03. That's a decline of 28% over the past year. Do we care about the quality of the number, or do we only care about the number?
Well, this is not inconsistent with the argument that we've been having about Netflix for years, right? So I think what's included in that is that it is some lower cost international subscriptions that are incorporated into that number, as well as the annualizing of some of the subscribers that were free previously through the Verizon arrangement falling off of the subscription rolls. The reality is, though, is that if you take out the international, which is always going to be lower margin, it's all about getting the footprint expanded. We see the same thing on the Netflix side. The strength of this is that they have vastly exceeded the number of subscribers, and the take here over the next couple of quarters is to see how many of these subscribers that were free initially are remaining on the subscriber rolls. And I do believe that that's going to be pretty strong. The thing about Disney in this environment is that we were looking for the parks revenue to fund Disney Plus, and now we're looking at Disney Plus as outperforming, and now we have the tailwind of improving parks revenue. Timing that, Melissa, is going to be difficult. We don't know exactly when they're going to get back to full capacity or even 75% capacity. But either way, it's going to be a tailwind, and the business will be stronger post-pandemic versus pre-pandemic on the basis of the strength in Disney Plus.
Theoretically, transparency can only get better from here. Theoretically, Jenny, you own Disney.
Right, and Pete and Shannon just covered pretty much everything I'd like to say about it. We look out definitely until 2022, and we say exactly what Shannon said, which is the post-pandemic Disney will be stronger than the pre-pandemic. So if you look at 2018 earnings, they were earning $7 a share. You look at 2022, and you need to just throw this year's earnings away. You look at 2022, and you can add on streaming, you can add on Fox, you can add on the opening of the Star Wars. And this is really interesting. And you think about all the pent-up demand. I know so many people who had to cancel their Disney trips. So I think there's some bigger picture things that are interesting in thinking about Disney too. And one of them is where 2020 took away future revenues from Disney, right? Those revenues are going to be paid forward maybe in the second half of 2021 and definitely into 2022. You can look at other companies like Apple, and I would argue that revenues are paid forward into 2020. But Disney, I think there's so much pent-up demand. We're going to see that come up in 2021 and 2022. But there's other stuff that's important too here, which is in December they had an analyst day, and Bob Chapek gave guidance for what the subscriber numbers would be. And we're back to a point where we can believe in guidance again, and we can believe in numbers, and we can have functional expectations that are likely to come about in the next year. So there's a real shift in these earnings reports this quarter, but particularly in Disney, where I think we can get back to normal in our investment process. We don't need to rely on hype and stories. We can actually look at numbers, forecasts, and believe them to be highly likely to be accurate and true in the next few years.
A Disney bear, though, Jim, might say that hype is part of of how Disney got to where it is right now in terms of multiple hype around the streaming part of the story. The belief that perhaps it should have a little bit of the same valuation as a Netflix or another hot streaming service, and yet this is Disney. So how do you sort of tackle that valuation question? Because right now it is expensive when you compare it to itself, or should that old playbook be completely thrown out because we are witnessing a re-rating of Disney?
Mel, I'm so sorry. That wasn't static. That was me sort of gasping when you said that. Look, this is a public service announcement for all of our viewers. If you are looking at the multiple on Disney's stock this year, stop. Stop, okay? I don't care about the 100 times, and nor should you. You have to understand, take 2019, the theme parks were 45% of operating income. They're zero right now. To what Jenny and Shannon and everybody is saying is when you look at 22 and they're back online, plus you've got streaming probably in 2023 contributing earnings. I mean, these multiples get back to where Disney was a few years ago in the high 20s, and frankly, where it deserves to be. So sometimes you don't believe people when they say they're going to grow into the earnings, but this time you can clearly see how much theme parks matter and where direct-to-consumer is going.
Yep, and Jim, you do own Disney as well. All right, stay with us. We've got Pete's latest trades and unusual activity straight ahead. As we head to break, a check on S&P 500 sectors. We've got energy. We talked about that top of the show, leading the way up 1.2%. Stay tuned.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
On the next Managing Asia, we put the spotlight on sustainability.
By 2030, we want to all abolish petrol-based virgin PET bottles. That is a huge challenge.
I'm hopeful that we'll be able to cut the amount of plastic getting into the ocean in half over the next 10 years.
The interest that Claire and I have had when we were much younger has always been about trying to make a difference in the world.
Companies doing good on the next Managing Asia.
Unusual activity. So, Pete, what are you watching?
Well, the first one I got for you is in the financial world, Mel, and I mentioned that earlier, how we're seeing more and more of that, and we've had some nice movement out of some of these financial names. This one's a bank, Wells Fargo. If you just go back to February 2nd, Mel, we had a huge buyer out there. Their stock was trading about 30.60. We had a buyer of 28,000 of the April 32.5 calls. Well, those are already starting to work really, really well for that trader. And as a matter of fact, now with the stock trading at 33, we're talking about a $3 move to the upside. That's great. Now today we're seeing more buyers. They're going out to May, though. So they're buying a little time, which we hadn't seen in the past. A buyer of 10,000 of the May 37.5 calls, Mel. Those are going for about $1.10. A big chunk of that in one single print. So that just tells me they continue to see the banks as something to the upside. Next I got for you is Carnival Cruise. Now this is another one where when you look at the range, it's been between 15 and 21 since all the way back to last May. Here we are pushing towards 21 again. It's trading around 2060, and we got a buyer of the February. We got 2 weeks basically for these. February 26th, the 21 calls, so they're just out of the money, and they bought 13,000 of these calls for approximately 85 cents up to $1. Again, a big chunk of that in one single print. So I love when we see these kinds of trades. I'm going to be in both these trades. I've got a couple of months to trade out of Wells Fargo, and this one I've got a couple of weeks to trade out of CCL. So we'll see if Carnival's got some upside.
All right, thanks for that, Pete. We are tracking the investment committee's latest moves, plus it is a big week ahead for earnings. The trades are next on Halftime.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12 months.
The target is to vaccinate 80% of our population to achieve the herd immunity.
So by the end of this year, 40 or 50% will be covered by the vaccine.
Why only 55%? Because that doesn't sound like herd immunity.
We have around 40 million who are below 18. Medical authorities do not recommend them to be vaccinated.
We hope to get most of our people vaccinated by the third or the fourth quarter of this year. If we get the vaccines faster, we'll be able to roll out the program faster.
The vaccine, I think, is a turning point, but don't underestimate testing. I think if we can get testing to 45 seconds, 30 seconds, that will also be a groundbreaker.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Big week of earnings next week. And Jim, you're watching CVS in particular.
Yeah, CVS has been a gift every time they report earnings recently. The last 3 quarters, they've really exceeded estimates. But the gift I really look for is what they do with the balance sheet. Mel, they took out a ton of debt about 2 years ago to acquire Aetna, and they've been generating free cash flow from that and paying the debt down every quarter. That's the gift, because as they keep paying down debt, the multiple is going to go up. Very cheap stock. Sometimes that's a pejorative to say that. Not in this case. The multiple is going to expand along with earnings over the next year.
Yeah, we're also watching a lot of hotel stocks reporting earnings next week. And Jenny, you own Marriott in particular.
Right, and this we look at the same way Jim was talking about how you look at Disney. You throw out this year's earnings, look to 2020 2019's earnings, where they earned $6. They're going to come out of the pandemic better off than they went into it. They'll have 10% more rooms under management. They've fully integrated Starwood. And most of all, they're going to have huge pent-up demand. Oh, and they cut costs during COVID. So throw out what they actually report, look for the future, and expect really good numbers in the future.
All right, I want to get to a portfolio update that's really interesting. This one comes from Pete. Pete, you sold Twitter. You sold Twitter as it closes in on a 10-day winning streak. Its best week potentially in 6 years. Why'd you get out?
Well, Mel, I've owned that stock for a really long period of time. I went back and looked at this thing, and I've been in there for quite a few months, and the stock has really performed well. Obviously, going into the election, that was a big deal. And then post-election, it still continues to be a big deal. You just mentioned this run that it's on even right now. It got up, I think I got out somewhere close to about 65, Mel. It's done nothing but continue to go to the upside. So just as an update, during the show, I actually bought Twitter calls. So I might be out of the stock, but I got back into calls and see a lot of activity in there as well. I didn't dislike the stock. I just felt like the run had been incredible, so I figured I better take it off. And now I've got the option, at least to the upside. If it runs over the next couple of weeks, I can hold on to that.
The old stock replacement strategy. Shannon, where do you stand on Twitter or another social media stock?
So we own Facebook. You know, that's always seems like it's a bit of an unpopular opinion, but you know, we think that there continues to be growth and opportunities in Facebook, and we do think that over the course of the next 6 to 9 months, with the regulatory overhang, that we could see some pressure on Facebook stock. But if you look at sort of the depth and breadth, the ability to grow ad spend, that's where we think Facebook's going to continue to do that, as maligned as the company is. And ebbs and flows with Zuckerberg's comments. So,
do you think the regulatory pressure will ease as time goes on, Shannon, or increase, or stay the same?
So I think a lot of, over the course of the last 2 months in particular, we've seen a significant interest in the regulatory overhang. And one of the things that I'm less concerned about is that being a near-term concern. I think that President Biden has plenty on his plate. I actually think that trade policy is going to come first, well before worrying about big tech regulation. And I think that it's still very much misunderstood in Washington how to regulate these companies. And so I think that, you know, whether it's Facebook or Google, which are currently, you know, under scrutiny, either from the DOJ or the FTC, there is going to be a path where these CEOs are going to help the government navigate how to regulate their businesses. I want to be clear about that. I think that there will be cooperation, and therefore, while we would look for potentially some overhang in the M&A space, there's a lot of homegrown innovation. I've talked about it on the show before in these companies that I think can continue to drive higher revenues for them at the top line.
All right, we got a lot more trades ahead on the halftime report, and a reminder, you can always watch or listen to us live on the go on the CNBC app. We will be back in 2 minutes.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive, and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oréal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
For your futures outlook, week ahead with a slew of economic data on deck. Jeff Kilberg is looking to put together some protection. Jeff, take us through it.
We have a big week ahead. Certainly is going to be interesting because it's a shortened week. It's only 4 trading days, but nonetheless, we are seeing earnings season wrap up. We've had about 350 companies report in the S&P 500, and in the wake of new all-time highs, I am a little cautious going into the week. Look at some of the data coming out. We have PPI. We also have retail sales. Retail sales should help us have a better understanding of what the consumer is actually doing. But inside of this caution, and in the wake of those new all-time highs, I want to be a seller of the S&P 500 March futures contract. I'm looking to sell at 39.25. Looking for a drop down to just 38.25. However, we always trade futures with stops, and 50 handles higher, I want to be stopped out in the event we see another new all-time high at 39.75. This is a 2-to-1 risk reward. I'm risking $2,500 to make $5,000.
Thanks, Jeff. We'll see how you did next week. All right, Ask Halftime is next. You can email us at askhalftime@cnbc.com. Back right after this.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
Helping you navigate the new normal. Squawk Box on CNBC.
Welcome back. We had to squeeze this one in, Pete. This is a fascinating move on your part, I thought. You initiated a position in sundial growers, not even you bought the actual stock. This is one that is hot on the Reddit chat boards. It's being diamond-handed left and right. So why'd you do this?
Yeah. Well, they've had just an absolutely incredible amount of option activity in there, Mel. I mean, just to give you an example, yesterday, Sundial actually led the markets in terms of the volume at 2.6 million contracts. So there's been so much activity there. And that activity is not just yesterday or the day before. That activity's been building for a while now. And it was just something where I'd seen some activity in there about a week or so ago. I'm looking at the stock, and I thought, you know what? The stock is basically priced almost like an option, so I'd rather have a position in the stock. But this is a trade. I'm not looking at fundamentals. I'm not looking at the rest of it. This is truly a trade, and I'm seeing all that option activity. Some of it's going out a little bit in time, going out towards June and so forth. So there's just an incredible number of buyers there. It just got my attention. I jumped in, and I will not be in here very long, Mel.
All right. We got the final trades next on Halftime.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
A courageous visionary facing tremendous odds.
I've always taught him to aim for better.
An entrepreneur with a sharp sense for business.
You just need drive and determination.
Now, with a company worth over $6 billion.
We will do massive amount of business on a global scale.
Daymond John is taking the world by storm and doing it in style.
If I can do it, anybody in the world can do it.
The brave ones, Daymond John. CNBC.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
The investment committee is answering your questions. First up, Jenny. Sam from Mississippi writes for Jenny. What is your current thinking on Lumen? And you actually took advantage of the pullback.
I did. I listened to the earnings call after they reported this week, and it's so useful to listen to those because you're often reminded of exactly why you own this. You do not own a moonshot here. Do not buy this for a trading vehicle. Own this because it's a company that mints $4 billion of free cash flow. They're improving margins. They're paying down debt. They're struggling with revenue growth. And they're going to pay you an 8.5% dividend yield that you can really count on through thick and thin. Own it for that. Own it if that fits your portfolio, which it does for me. But don't pretend it's something that it's not. It's a big dividend yielder with like almost no growth.
All right, this one's for Shannon. Jack in North Carolina wants to buy a casino stock for the long term. He asks which one has the best fundamentals and potential going forward between GM, Wynn Resorts, Las Vegas Sands, and Penn. What do you say?
No offense to what DraftKings and Penn are doing here in the United States with online sports betting, but if we want to be in gaming, we want to be in Macau. Las Vegas Sands is the best positioned gamer in Macau, and they are going to reinstate their dividend in the coming quarters, which I think is another plus for the stock.
All right, let's get to the final trades here for this Friday. Jim Lebenthal, kick it off.
Yep, Qualcomm, it got knocked down about 10% after earnings. That was just profit taking, and now it's reconsolidated and ready to move higher.
Jenny.
National Retail Properties reported that they're collecting 96% of rents, and they're still down 26% off this time last year, 4.9% dividend yield.
Shannon.
Healthcare is going to continue to grow. Buy Merck. They're focusing on specialty oncology, and it's what they do best.
Pete, I'm still thinking about your sundial purchase.
Yeah, me too. I'm just taking a look at it. You know, Jim talked about semiconductors. We talked about that earlier in the show. Marvell. We see some huge call buying in there. I think this is a stock that you have to own. I think it's going higher.
I will see you, Pete, and the rest of you out there on Fast Money at 5 tonight. That does it for us on the Halftime Report. Great to be with you on this Friday. The exchange with Dom Chu begins right now.
All right, thank you very much, Melissa. I am Dominic Chu, and here's what's ahead on the exchange. Rising commodity prices, soaring housing prices, stocks soaring, low rates, and trillions of dollars in stimulus. Sounds like a recipe for inflation, right? Well, maybe not. Maybe it's stuckflation. We'll explain later on in the show. Plus, the banking industry is feeling pressure to adopt Bitcoin, and the push is not coming just from clients. It's coming from within. The details exclusively of that internal tug of war coming up. And the mass adoption of trading is a beauty boom ahead, fleeing to Florida, and one New York City staple goes from sweet to sour. That's all ahead coming up. But we begin first with the markets. Stocks right now trading in a narrow range to close out the week in any kind of a move here. Try to close in the green for the S&P and the NASDAQ. It would be a record close, by the way, if we could get there. The indices are on pace for a second straight positive week, but right now the Dow Industrials down about 0.1%. The S&P about that same percent to the upside, and the NASDAQ outperforming in that same bit as well here. So those three indices, a key focus. Some new highs in media today. Talk Disney, Comcast, News Corp. Those stocks, by the way, at record highs. Discovery is at a 6-year high right now, and Twitter is at a 7-year high and on pace for a 10-day winning streak. Twitter, it wasn't that long ago. Wall Street wasn't exactly as enamored with that stock. So watch social media, watch traditional media, a lot of big highs today. Semiconductors still in focus. The ETF that tracks that sector, the VanEck Vector Semiconductor ETF, ticker SMH, about 0.75% to the upside today, outperforming the market. Now, going back to last November, Lam Research, Western Digital, Applied Materials up all more than 10% just this week alone. So keep an eye on those semiconductor stocks. Meanwhile, despite valuations being through the roof by some measures, our next guest says the economy is headed for a state of stuckflation, meaning we should not fear inflation or deflation at all right now. For more, let's welcome in Jim McDonald, Chief Investment Strategist at Northern Trust. They've got a lot of money under management. Jim, stuckflation, that sounds to me like no inflation, no deflation, the perfect environment for risk assets. Is that the way it's supposed to look?
Well, so Dom, stuckflation has been a theme of ours for 5 years now. And it's a reflection of the fact that technology is coming into a lot of industries, bringing in capacity at very low cost, and that is preventing pricing power from taking hold. Now, we do have a shorter-term theme, which stuckflation may be tested. And it may be tested because of the huge fiscal stimulus, very easy monetary policy, and a cyclical recovery. But we think it will pass the test, and we still will be in a stable inflation environment for years to come.
If that's the case, a stable inflation environment, that almost suggests like there's no real risk right now that's being priced in with credit on the Treasury side of things. It seems to me that's a constructive environment for many different kinds of assets, including stocks. Is that the way that investors should read this?
Well, I think it is the case. If you look at what's happened in the market, certainly there has been a lot of rally in things like credit spreads and expansion in PE multiples. The biggest risk to this is that we do have this test of inflation. It leads to higher interest rates. But our view right now is that that is likely to not be a problem over the next 12 months. We have recently reduced our exposure in the credit markets. High yield has had a great run. We have reallocated some of that into natural resources, which is a play on the recovery, and also into U.S. equities. So we're now broadly overweight U.S. equities and with an overweight in some natural resource areas and also in global listed infrastructure.
Jim, is that indicative of a broader call on this kind of rotation to value that many experts have been talking about over the last 4 to 6 months here? This idea that the most beaten up parts of the industrials market, the energy market, oil and gas, that sort of thing, is the place that you want to be rather than in mega cap technology or media?
So we don't think it's an either or. I do think that the laggards will recover, and that's one of our themes. But we don't think that the case for technology stocks is over. So I would describe it as much more of an environment where the laggards will perform much better relative to technology. But we don't want to make a big call that it's just time to tilt to value. We do want to balance between value and growth.
What's the scariest part of the market for you right now, Jim? As an investment strategist, there's a lot of money at Northern Trust. A lot of clients must have a lot of different questions. Are there things that predominantly get themed together in your mind for the biggest risks to the market right now outside of COVID?
Sure. So outside of COVID, I would just have to say that there are certain areas of euphoria that have demonstrably occurred over the last 6 months, whether it's pockets of retail trading or it's the SPAC phenomenon. Those are some signs of individual concerns. The macro concern around the market, beyond what you're saying with COVID, is just that things are priced a little bit towards perfection. That just means lower returns over the next couple of years. It doesn't mean that we're set up for a big correction, because we do think the strength of the recovery over the next 12 months with a Fed who's very committed to not moving rates means that the bias remains higher.
Do you believe, Jim, before we let you go, that the activity that we've seen trading in Bitcoin, cryptocurrencies, cannabis stocks, some of these short squeeze stocks is in any way unhealthy for the market?
I think when people start talking about fundamentals not mattering anymore, and that the old-time investors don't get it, and all that matters is the news flow and what's going to be the next hot stock, that is disconcerting. I do think over the intermediate to long-term, fundamentals will prove out and matter.
All right, Jim McDonough, Northern Trust, thank you very much, sir. Have a nice weekend.
Thank you.
All right, well, the airline industry is facing a long runway to recovery, and requiring a negative COVID test to get on a domestic flight could make that runway even longer. That issue and more being tackled at a meeting between the White House, COVID-19 response team, and airline executives happening today. Our own Phil LeBeau is always on top of everything in the skies and even on the ground. Phil, what exactly did they talk about? How much more stringent could travel get because of COVID?
Well, look, if the White House decides that there should be a negative test for anybody flying domestically, it will become more stringent. But there's no indication at this point that that is likely to happen anytime soon. I talked with a number of people who were part of or listened in on the meeting today between the White House COVID task force and airline executives. This was a virtual meeting, lasted about 30 minutes, and basically everybody I've talked with said the same thing. This was a good exchange in terms of the executives saying this is what we're doing, the White House task force saying this is what we're focused on in terms of the spread of COVID-19, limiting it all. And again, no decision has been made on whether negative tests will be required for domestic flights. The airline executives stressed, and they have talked about this for some time, so this is not a new message. They believe that masks and disinfecting, along with HEPA filters on planes, that is limiting the spread of COVID-19. The concern for the industry is what would happen if the White House says, look, all domestic flights have to do what you're doing on international flights. You must have a negative test before you can fly. If that were to happen, the concern is this chart right here that you see what few people are flying right now, and it's down between 60 and 70% compared to the same time last year. It depends on the day of the week, but generally down 60 to 70%. The concern for the airline executives is that number will stay depressed for a longer period of time, and that you will not see a snapback in a recovery of domestic demand for flying, maybe in the spring or in the summer. Take a look at the airline stocks today, and we're showing you those for the ones that had a CEO who was attending virtually this meeting. Not a whole lot of reaction here, Dom. The bottom line is this. The airline industry is fairly confident at this point that the White House will not require a negative test for domestic flights. But again, That could change. The White House made it clear today they are being guided by science, and if they believe that the science indicates that is the smart thing to do, they may move in that direction. Dom?
Phil, the important date a lot of airline employees are watching right now is March 30th. That's when federal aid expires to help the airline industry. How critical is it that a new COVID relief package get more money to these airlines to help save jobs?
Well, certainly for the employees who would be laid off, and I haven't got a total count right now, but I'm guessing it's somewhere in that 25 to 30,000 range. For those employees who would be furloughed again, it's very critical. And from the perspective of the airlines and the airline industry, if there is a snapback, and they believe that there will be a snapback, that it'll come back very quickly, they want to be able to say, let's ramp up service as quickly as possible. Let's keep those people on the payroll.
All right. Phil LeBeau with the latest on the airline industry. Thank you very much for that. So what does this all mean for the future of airline in the industry, and who's best positioned for the recovery? Let's now bring in Helene Becker, senior analyst and covering airlines over at Cowen. Also, Gordon Bethune. You know him. He's the former Continental Airlines chairman and CEO. He's also a CNBC contributor. Helene, I guess we'll start with you first. We just heard Phil lay out some of the state of the industry. From your perspective, is the industry on an upward trajectory, albeit modest right now? Is it recovering? Is it something that we can be optimistic about, or are there still too many hurdles to get over?
Well, thanks for having me on, Dom. Yes, to all of the above. It's a lot to get over because of these restrictions that are in place. The industry needs revenue. If we could just open things up so that people could travel, even if they have to mask up when they get to where they're going and so on, it would be so much better than where we are right now. The roughly 1 million people we saw yesterday traveling, and we're kind of hanging around the 800,000 to 1 million people a day off peak, on peak days rather, means that there's a lot of pent-up demand. I think people want to travel. It's just that their governors or their governments aren't allowing them to. So we need to get past this whole issue of locking down and staying home and so on in order to really have a great recovery. But I think Phil hit it, the nail on the head. There's a lot of pent-up demand. People want to go.
I mean, Helene brings up a great point, Gordon. This is no doubt an unprecedented time for the airline industry overall, with unprecedented tax dollars being put in to support the overall industry and system. In your mind, have the restrictions that have been put on travel, have they been too onerous? Are they just the right amount? Are we not doing enough? I mean, you used to run an airline that traveled all across the world. How much of this is an issue? I mean, did the government go too far?
Well, I don't think too far. I think Helene is right, as she usually is. We need less restrictions, not more. The very early signs of recovery on airline balance sheets is being squashed by this threat of having to have a test before you board a domestic flight. I couldn't think of anything more catastrophic for the recovery of an airline than to do that. We don't require you to have a test to go into your Kroger and buy groceries. So, I mean, the airplane is as clean as you can get. I think we need to lighten up our touch. I think the government has done that. I hate to see them think again about requiring passengers to pay more money, that's for the test, to recover and fly domestically. I really, really hope it doesn't happen. I hope so.
Gordon, if I could kind of follow up on that, if you look at the overall state of the business right now, there's no doubt that a lot of government assistance, taxpayer assistance is critical to the industry. Is there a way that the industry can get back on its own feet without having to have that much more taxpayer money put into it? Is there a way that they can operate out of this efficiently? And if so, what types of characteristics do companies in the airline business need to exhibit to get back on their feet quicker?
Well, one, it's passenger revenue, so there's a major indicator of health. Obviously, that's growing, albeit slowly, but I'm with Helene. Let's not go backwards here. We need to continue to go forward as we have, and passenger traffic is building steadily and slowly. I think those people that use the word snapback are probably correct because the number of cases and the number of deaths are going down. All the positive things that make us feel better about being citizens and being able to do our jobs with COVID. And I think that's becoming better known and more aware. So people are traveling more. They're just let's not keep them from traveling. They're coming back right now.
Elaine, put it in perspective for us here. You cover all of these airlines. As an investor looking at this, are there certain airlines that are better positioned to weather the storm, emerge stronger? Are there ones that are perhaps weaker hands right now that you want to stay away from as we expect things to recover?
Yes, so thank you. I think that domestically we're going to recover faster, and that obviously presupposes no testing. We just need people want to break out of jail. And I think that's what this is going to be. I think, we think that we're losing spring break, at least March, maybe Easter, we'll see some improvement. We're really hoping that case counts and hospitalizations are down by Memorial Day weekend so that we get a good summer, not a great summer. And in that environment, I think you want to own the domestic U.S. airlines like Southwest, Spirit, Allegiant. Those would be our top 3 picks. I think internationally, as we recover, that's probably a 2022 event. You probably want to look at United, Delta, and American in that order. I think the balance sheet improvement Gordon alluded to is going to occur as the revenues start to come back. I mean, we just need revenue, and the only way you get that is by opening things up. And I agree it has to be done safely, but there are ways to do it without these tests and so on that really causes people to say, oh, too much of a hassle, I'm not doing this. So we're hoping that recovery in earnest starts, let's just say late May, June.
It's one of the most impacted industries, of course, in this COVID pandemic right now, travel and tourism. Elaine Becker, thank you very much. Gordon Bethune, thank you, sir. I hope you guys both have a great long weekend. Thank you.
Thanks. You too. Thank you.
All right. Well, coming up on the show, MasterCard is in. PayPal is in. Square is in. So why aren't the traditional banks in? Wall Street is starting to feel the pressure to adopt Bitcoin and cryptocurrency, and it's coming from an unlikely source. The exclusive details are coming up ahead. Plus, there's a trade war happening over shipping containers. Yes, our own Brian Sullivan is live at the port of Charleston, South Carolina, with more. Brian.
Yeah, Dom, and if you're one of the people out there that have ordered a Peloton or a treadmill or a rowing machine or whatever it is, and they're telling you it's going to be 3 to 4 months until you get it at your house, it's not their fault. It's probably because of what's happening in these. And U.S. exporters are also ticked off. We'll tell you about the container crisis next on The Exchange.
This is The Exchange on CNBC.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Russian Foreign Minister Sergei Lavrov says the country is ready to cut ties with the European Union amid a recent escalation in tensions. Lavrov said Russia does not want to isolate from global life, but is prepared for that possibility. That story is on the website now. The UK economy contracted by 9.9% in 2020, its biggest drop on record, as the pandemic wreaked havoc and forced several sectors to effectively shut down. The UK economy is set to continue shrinking in the first quarter of 2021 due to ongoing restrictions. Head online for the full story. Disney beat subscription expectations in the first quarter, reporting 95 million paid subscribers to its Disney Plus streaming platform. The media giant also reported a profit rather than the loss analysts had expected.
Welcome back to The Exchange. There's a serious problem in shipping that's disrupting global trade, and it could hold back the recovery both here at home and perhaps abroad as well. Brian Sullivan is live at the Port of Charleston in South Carolina with that story. Brian.
Yeah, John Lennon said war is over. I don't know if he was talking about the trade war or not, because if there was a trade war, it's with these containers now, Dom, because the volume of imports that we are consuming and buying from China and other parts of Asia is the greatest it's ever been, and it's causing a huge dislocation and imbalance in these things, these ubiquitous shipping containers that we never think about. We never had to think about them. And by the way, U.S. companies never had to think about them. They were cheap. They pretty much were anywhere you needed them. Ohio, Iowa, Chicago, they were there. Not the case anymore. The value of goods flowing from China is so great that the price of these has gone up 250%, which means they're being sent back empty rather than going back into other parts of the U.S. So you sit at home and you're thinking, well, I'm not an exporter. Why do I care? Here's why you care. We gave you the Peloton example. Here's who's hurt, okay? Obviously, U.S. exporters. You want to sell something to China or other parts of the world, you need one of these. You either can't find one or you want to try to overspend. That hurts the recovery. The importers of things like Pelotons, treadmills, machinery equipment, they're waiting months because the backlog, and the farmers too, they're particularly ticked off because that's a huge part of our exports. We talked to Jim Newsom, who runs the South Carolina Port Authority, including here the Port of Charleston. He's been in the business 40 plus years. He said the imbalance is the greatest he's ever seen.
Brian, welcome to Charleston. This is a record level of imbalance. If you look at Northeast Asia and the U.S., it's about 3 imports for every 1 export. So it's really unprecedented. And then within the country, the imbalance is even greater, because if you have a container in L.A. and you need it in Des Moines, it's not very helpful.
Yeah, so Dom, you want that road to recovery you guys were talking about? We need to sell stuff to other parts of the world so we have manufacturing jobs in the country. If you can't sell stuff because you can't get a container or it's not profitable, that hurts the recovery. That's why this story matters.
I mean, it matters too, but let's talk about whether or not there is any sign, Brian, out there that things are actually getting better. We're hearing about these shipping bottlenecks, but are there points that investors and traders can look at, Wall Street and Main Street can look at to say, hey, things are actually getting better, so to speak?
No, is the short answer. I'll tell you why. Now, normally, Lunar New Year kicking off today, Dom. Usually that's a period where people take a week off in China. Everything slows and bottlenecks tend to ease. First off, a lot of people are working Lunar New Year because they're getting extra pay in China. We've heard that factories just cranking out around the clock. So that's not going to provide that natural gap. You've got 41 ships sitting off the port of Los Angeles. Normally, there's none, or maybe a couple, waiting to come in. You have shortages in truckers, right? Some have gotten COVID. Some have stayed away because of COVID. There's bottlenecks everywhere. At the bottom of it, Dom, everybody is sitting at home buying stuff online through Amazon and Walmart.com. That stuff is probably coming in one of these and coming around. But remember, it's got to be a two-way trade. So I hate to say it, Dom. Right now, there does not appear to be any kind of a solution. I know that's a frustrating thing to hear. That's why we're getting delays. But by the way, there have been some winners. If you're a stocks guy, look at Textainer, Triton International, CAI, or Atlas Air Worldwide. These are companies we've never talked about. Their stocks are up 150, 200% because they're the ones leasing these. And by the way, the federal government's starting to get involved, Dom, because there's actually a shortage. You think, why not just make more? Despite prices being up, the manufacture of these containers, which is mostly done in China as well, is down, and the Federal Maritime Commission is starting to poke around because they're just wondering what exactly is going on. Why don't we have more containers where they need to be or more new ones? It's a big global trade story.
Shipping and logistics will continue to be probably one of the huge focal points of this entire story. Brian Sullivan in the Port of Charleston, thank you very much. We'll see you all day long. All right, coming up on the show, it's not just the airlines, restaurants, and hotels that will benefit from a reopening as well. There's also an area of the market that's looking pretty right now that could also get a big boost. There's a hint there, looking pretty. But If you're looking to get into the recent pot rally, there's one name that most analysts seem to agree is a good bet. In fact, it has no sell ratings on Wall Street right now. We've got that name coming up. And don't forget, you can watch us live on the CNBC app, on your smartphone, on your tablet. The Exchange will be right back.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
Breaking news on what has turned into the soap opera, and that is GameStop.
We watch the internet now, thanks to the rise of social media, bring a bottom-up revolution, and now it is happening to finance. And I really do think this is really the start of a new era.
These kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect, but I think it takes an enormous amount of faith in the system to be that transparent, and then for each individual to make their own mind up, whether it's to buy and to sell.
We've gotten a lot of criticism that, maybe there should be more restrictions. So it pains us to have had to impose these restrictions, and we're going to do what we can.
This is why we need an SEC that has clear rules about market manipulation and then has the backbone to go in and enforce those rules.
The system is broken right now for certain stocks, for the heavily shorted stocks. And people are thinking somehow, well, this is a home run. Take the home run. Don't go for the grand slam. You've won the game.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Welcome back to the Exchange. Markets right now are looking, we'll call it stable. You can see the Dow is down just about 50, 60 points. The S&P up by just about 1. We'll call it flat. And the NASDAQ pretty much flat as well. 14,029 the last trade on the NASDAQ composite. Let's check the sectors behind me. As you can see here, we got a pretty even split, though. Energy and financials leading the way higher. You can see they're up about 1/2 to 3/4%. Meanwhile, you can see down here, discretionary, retail, and utilities are all down between 0.5% and 1% at this stage right now. Here are some of the individual movers this hour. First stock, Bumble, up another 12% today after surging 64% in its Wall Street debut yesterday. You can see they're a big move higher just off the highs of the session. Now, at the current price, the market capitalization is now up to, get this, $15 billion for that dating app and company in that site. Our second stock is Illumina, sharply higher after beating on the top and bottom line thanks to record orders in the fourth quarter. The company is also issuing better than expected guidance for the fiscal first quarter as well. Those shares up about 15% off the session highs. And then check out the casino stocks, getting a lift today on news that casino capacity in Las Vegas can increase to 35% starting on Monday. Penn National Gaming is leading the way higher. You can see they're up by about 4% or so in the trade, but still, Wynn, Caesars, MGM, you get the idea. Now let's send it over to Courtney Reagan, who's got a CNBC News update. Good afternoon, Courtney.
Hi, Dom. Here's what's happening at this hour. Former President Donald Trump's defense team says the current impeachment trial is a threat to political leaders' First Amendment right to freedom of speech. Lawyer Michael Vanderveen claims Donald Trump's comments leading up to January 6th attack on the Capitol is, quote, ordinary political rhetoric. Meanwhile, President Joe Biden met with a bipartisan group of governors and mayors this morning to try and rally support for his $1.9 billion COVID-19 relief plan. Justin Timberlake is apologizing to Britney Spears and Janet Jackson. The pop singer has been under sharp criticism for his role in Spears' public breakdown and for not defending Jackson after her Super Bowl malfunction in 2004. The apologies come 1 week after the release of the New York Times Framing Britney documentary. And 92% of workers canceled, postponed, or avoided booking vacations during the pandemic. But research shows taking time off is more important than ever. Check out the news with Shepard Smith tonight at 7 p.m. Eastern Time to find out how you can enjoy brief moments of bliss during these tough times. That's the CNBC News Update at this hour. Dom, back over to you.
Such an important key during these COVID times. Courtney Reagan, thank you very much. Well, it's been a wild week for the cannabis stocks as they became the new target for Reddit traders. Let's take a look at Tilray, the poster child, so to speak, for all of this. On Monday, a 16% rally. Tuesday, a 40% rally. Wednesday, up 50%. Yes, that's 50. But then yesterday, down almost 50%. Today, we are seeing a move lower again. While Tilray may be the poster child for the enthusiasm in cannabis, it does not appear to be Wall Street's favorite name. CNBC Pro combed through the analyst reports and found that one name kept coming up again and again as a top recommendation, and that stock is Green Thumb. For more on why that stock is Wall Street's fit pick and why Wall Street is a big fan, just go over to CNBC/Pro. Well, coming up on the show, Charles Schwab cashes in on the trading boom, a bullish beauty call, fleeing to Florida, and a not-so-sweet ending for one retail staple New York City residents know very well. Keep it right here. The Exchange is back in 2 minutes.
On set, Casey Affleck and Anthony Atamane. Plus, a closer look at New York will resume indoor dining ahead of Valentine's Day.
The perfect way to tell someone, I love you, but I'm indifferent to your grandparents.
New Seth this weekend. Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
I wouldn't describe Hong Kong as a sticking point between U.S. and China. Sometimes Hong Kong has been used as a pawn by the U.S. administration. With the new U.S. administration, I hope that they will give us a fair hearing as far as the national security law is concerned.
We're not a protectionist country. Rather, China is trying to become a leader of a new round of globalization.
The pressure on Australia, the boycotts that we're going through at the moment, these are 180 degrees at odds with everything Xi Jinping solemnly told the Davos virtual conference.
It will take some time. I don't think there's, we're going back to where, we were before the Trump administration.
I think still in the early days of the Biden administration, but so far we have seen some companies that are listed in the U.S. returning to Asia, to our market.
Let's catch up on a few stories that should be on your radar. It is time for Rapid Fire, and here to break down the headlines are Robert Frank, Rahel Solomon, and Michael Santoli. First, From GameStop to pot stocks, retail traders just can't seem to get enough, and this retail frenzy is boosting online brokerages that are not named Robinhood. Charles Schwab saw staggering growth in January, reporting that it had added over 1,000 new brokerage accounts. By the way, that's up 200% over the same time last year. Total client assets ballooned to more than $6.7 trillion. That is a 67% jump from the same time last year. Michael Santoli, we've talked about the free trading stuff for a while. Robinhood's synonymous with it, but all of the brokerages offer free trading right now. How much has the day trading mentality permeated investing today? Does it feel like 1997 to 1999?
It definitely feels like it in terms of this source of energy coming from the broader public, a little more excitement around certain types of stocks that seem intuitive to this group. Absolutely, it rhymes. What is surprising to me to some degree is the difference that zero commissions made. I mean, I was around covering the very dawn of online brokerages in the 90s, and everyone knew the commission rates were going to be going down steadily over time, and they did. But when they got to $5, you would hear the people in the industry say, hey, the average trade side's $10,000. What's the big deal about paying $5 in a commission? Well, guess what? If you want to get people who want to buy fractional shares and have smaller accounts but are excited to trade more, this is what did it. So the pie's growing big enough for everyone to get a piece. And, of course, Schwab, been there a long time. A lot of that asset growth is from the market, but it seems like a thriving moment for the industry in general.
Robert Frank, I mean, you cover the really, really rich people out there. How big of a deal is it that there's a, so to speak, democratization of the industry, that investors are now not just like the millionaire types, but you can actually get in because of things like zero commission trading and of course, fractional share ownership as well?
Yeah, Dom, this is long overdue. You know, the stock market is the wealth engine of America, and unfortunately, too many families were left off that engine and were not attached to it. The top 10% own 88% of the stocks in this country. And by the way, those numbers just haven't changed in over 20 years. So the fact that we finally have new investors, many of them young investors, coming into this market, hopefully going from being traders to long-term investors, is what we need. Now, what we do need now, in addition to more investors, is less gamification and more education about investing.
All right, so a big deal there for Charles Schwab, still following the big surge in retail trading. Next up here, if beauty's in the eye of the beholder, then the future is looking gorgeous for the beauty industry overall. The world's largest cosmetics maker, L'Oreal, is predicting a 1920s-style boom ahead for its market at an investor conference. L'Oreal CEO said the recovery will be the fiesta of makeup and fragrances. His words. This as L'Oreal reported better than expected revenues thanks to strong Chinese sales and robust growth thanks to skincare products. Other beauty companies have also been performing handsomely, if you will. Coty, Ulta, Estee Lauder have all more than doubled from their 52-week lows. Rahel, you cover many of these companies. I know you've been sitting in on some of those earnings calls as well. The big deal here is it a resurgence for health and beauty, or has it just been around all year long and we just haven't really seen it?
I don't know if it's a resurgence quite yet. I think where we're really seeing growth, Dom, is skincare, which you just alluded to there. Makeup sales had been sort of declining even before the pandemic, and the pandemic sort of accelerated that because most of us were home, but maybe you were on Zoom calls. But skincare, I think, is really where it's at. In fact, we heard the L'Oreal incoming CEO saying that's going to be his top priority when he assumes the position a little bit later this year. Also, not just skincare, Dom, but what companies put in their products, clean products. That's something we heard from Coty earlier this week, that they've been seeing really strong sales with the CoverGirl Clean strategy. So I think, yeah, I mean, I'm here for a fiesta of fragrances and makeup, and I'm certainly here for a bold lip. But I think skincare has definitely been accelerating. Sales have definitely been accelerating in the past few years, and we'll likely continue to see that because, Dom, I don't know about you, but, you know, wearing these masks, now we have to deal with maskne. That's a whole nother issue. Certainly skincare, very important for that issue, but I know a lot of people can relate.
Well, so Robert, every time I hear about the roaring 20s, right, you know, and this is not the first industry or CEO that's made an allusion to the idea that we could see a resurgence like the 1920s as people kind of emerge from the pandemic. But in your mind here, how much can it be that much like the Roaring 20s. I think Great Gatsby, I think of all these, flapper type parties and everything else. Is it really going to be like that once COVID is kind of eliminated from the equation?
Well, let's look at China. So what's been important to all these fragrance, makeup, and skincare products has been the comeback in China. I think L'Oreal had 27% growth in China in the most recent quarter. And China is what consumers could look like after the pandemic here. And what we've seen there is what they call revenge spending, where people are so tired of being cooped up and not spending that they went out. And the luxury industry is booming in China. All roads in luxury lead to China right now. And part of that is because of demographically what's happening in China compared to an older U.S. But I do think that China is the north light of what luxury could look like in this country and in Europe once we're out of this.
All right. I mean, it was one of the things that we talked about probably in April or May of last year. If you were looking for a leading indicator of what things could look like, it could be China because of the recovery over there. All right, next, let's go somewhere warmer. I want to go someplace warmer without taxes, perhaps. The ongoing migration to Florida is turning the luxury real estate market there into one of the hottest in the country, if you haven't already heard. In fact, the most expensive home ever sold in Florida just closed yesterday. Forget this, over $130 million, just down the road from billionaire investor David Tepper. Robert, I know what the allure of Florida is, but how hot can it get down there for the real estate market?
Just when we think it's peaked, it just gets more incredible. So if you look at Palm Beach, which literally has run out of mansions to sell, David Tepper, the home that he bought or is in contract for $73 million, that home wasn't even for sale. And what I'm hearing brokers saying is they have to go around and knock on doors to find homes to sell. Scott Schleifer, who bought the house for over $130 million, that was a spec house, just came on the market in January. Prices in Palm Beach are up over 50% last year. Sales contracts in January more than doubled. This is shows no signs of slowing, and that's because what used to be a millionaire migration is now a billionaire bonanza. And the wealthy, they just follow each other, especially those who are wealthier than they are. So I think this is going to just pick up steam.
Mike Santoli, there have always been reasons for people in the Northeast, specifically New York City, to be in Florida. In fact, some people split their time. Is this one of those moments where we could really see Wall Street down on South Beach?
Yeah, I don't know to what degree we have to move the infrastructure. I mean, right now, you do actually have hedge funds already set up down there, right? Remember, Citadel famously set up, I believe, in Palm Beach. So I don't think there's any impediment to it. I do want to say, though, let's knit this together. There was a Florida land bubble in the 1920s. I mean, people really did. It's always been the repository for the wealth that spills out of the rest of the country. So it's not surprising to see what's happening here, especially with the tax arbitrage happening.
Oh, he's connecting dots. There's some implications there as well. We'll have to get to that later on at some point down the line. And this is a bittersweet one here for all you candy fans out there. The iconic Dylan's Candy Bar is closing its flagship Upper East Side Manhattan location. The 13,000 square foot store is now listed for lease by Ripco Real Estate. This comes amid a report from Manhattan real estate watcher The Real Deal that Dylan's Candy Bar is being sued by the landlord of its corporate office for unpaid rents. Rents for the retail space in New York City have skid to historic lows. We've talked about this, down 25% from pre-pandemic levels. Rahel, this is another sign of retail apocalypse, so to speak. But is Manhattan indicative of everything else that's happening in the country, or is it very specific to just New York?
You know, it's hard to say, Dom, because I think those of us that live in the city, we live in our own little bubble, and we think that New York City reflects the larger country. But I can certainly say, being in the Upper West Side for sure, that it felt like a ghost town sometimes walking along Columbus Avenue, seeing all of the empty retail space. But Dom, one thing that's been really interesting as well is seeing some of these landlords now sue these companies for real estate. In fact, I saw it earlier this week in a Simon Property Group upgrade. I think it was by Morgan Stanley, but essentially saying that they're upgrading on the potential recovery of about $410 million in abatements. And so interesting to see if we'll start to see more of that as these landlords try to recoup rent. But Simon Property Group, that huge mall owner, getting an upgrade because it looks like they're going to be trying to recoup some of those rents too.
Quickly, Robert Frank, do you frequent the Dylan's Candy Bar in New York City?
My daughters did, but this company was having problems before the pandemic. They're a giant sugar house in a sort of culture that is increasingly health conscious, and it's so overpriced. Dom, would you pay $17 for a container of gummy bears? I mean, I love gummy bears, but $17 you can get them for like $4 on Amazon. So even before the pandemic, they were having trouble.
I just bought a massive bag of Sour Bright crawlers from Walmart.com. Mike Santoli, do you go to Dylan's Candy Bar?
I've been there. There actually was kind of a branch of that empire closer by me. It was a restaurant. By the way, 20 years is a great run for any location in Manhattan. So, you know, there's a natural attrition here. I think the novelty probably wore off a little bit of that store. So, you know, I'm symptomatic of something going on, but I don't think it's necessarily, you know, something that New York is going to lament for a long period of time, like the old Penn Station being torn down or something.
All right. Well, the new Penn Station looks pretty good, though.
That's
I would just say this. Robert Frank, Rahel Solomon, Mike Santoli, thank you guys very much. That was today's edition of Rapid Fire. Coming up in the show, the Robinhood CEO heads to Capitol Hill next week to answer questions about the role his company played in the Reddit rally and collapse for some of those stocks. More on what we can expect ahead. And it is Black History Month, and we are honoring some of our CNBC contributors. Here is James McDonald with his advice for the next generation.
The most important advice I could give the next generation of Black Americans is look at the success as an example that's before you. We've been a president of the United States. We've excelled in some of the largest financial institutions, and we've generated billions in those areas of finance that are the most complex. You can do it too. Go after what you want and be all that you can be.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch. Weeknights on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another $1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
On the next Managing Asia, we put the spotlight on sustainability.
By 2030, we want to all abolish petrol-based virgin PET bottles. That is a huge challenge.
I'm hopeful that we'll be able to cut the amount of plastic getting into the ocean in half over the next 10 years.
The interest that Claire and I have had when we were much younger has always been about trying to make a difference in the world.
Companies doing good on the next Managing Asia.
Exchange. It's Friday, and that means it's a good time to look ahead to what's in store for your money and investments in the next week. Here is your Friday Fast Forward.
A shortened trading week, but plenty of action ahead. Walmart headlines the earnings front off a quarter that saw online sales jump 79%. Also, Palantir reports for the second time since its IPO. The stock up more than 40% in 2021. On Wednesday, January's retail sales. Economists hoping for a rebound after 2 months of declines. And is housing still hot? Reads on starts and existing sales may give us a clue. Details from the Fed's last meeting are due, with the FOMC minutes. Thursday, NASA's Mars rover scheduled to land on the Red Planet after a 7-month journey. Back on Earth, Robinhood CEO testifies on Capitol Hill as Congress investigates that company's role in the Reddit rally. And that's your Friday Fast Forward.
A lot of stuff on the agenda here. And the Robinhood CEO testimony on Capitol Hill, sure to be a fiery one. For more on what we can expect, let's bring in our own Kate Rooney. She covers all things fintech for us here. Kate, this is a huge deal because it's gotten so much Main Street popular attention. Just how hot will it get for the folks over at Robinhood this week?
Dom, that's the question. This hearing is supposed to be about GameStop, some of the trading sort of chaos that we've seen, late January in the past few weeks. But Robinhood is really becoming the poster child of that. You saw it with, Senator Ted Cruz and AOC both going after Robinhood. They have really become a target in a broader issue, which in some ways is a lot of the volatility, young traders pouring all into the same stocks, and some of the back end Wall Street systems that have worked perfectly fine until some of these factors have jumped up. So Robinhood CEO Vlad Tenev appearing before Capitol Hill is a relatively young CEO. On the company side, I would expect them to sort of deflect they already have and sort of turn the attention to their clearinghouse and some of the back end systems that they say, could be run more quickly. Things like they call it T+2. But the fact that it takes 2 days to settle a trade. So I think they're really saying, there were issues here, but let's look at some of the other problems going on.
There is certainly a lot of bipartisan support for kind of going after what's been the root cause of a lot of the trading volatility. Kate Rooney, thank you very much. I'm sure you'll stay on top of that and everything else fintech for us here. We'll see you later on. Have a nice weekend.
See you, Dom. You too. Thanks.
Coming up on the show, Wall Street banks could be getting closer to adopting Bitcoin. Yes, Bitcoin, thanks to a big push from their own employees. CNBC.com's Hugh Son has the exclusive scoop. He joins us next to talk about why the big banks and their employees want Bitcoin adoption.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure we will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure it will be able to understand and to heal the growing social malaise.
The exchange, Bitcoin's remarkable run has employees at some of the country's biggest banks worried they may be missing out. Bitcoin down today, but up 26% just this week alone. A week that saw, by the way, both BNY Mellon, America's oldest bank, and MasterCard, one of the biggest payments networks out there, announced they intend to begin using or in some way administering Bitcoin this year. And CNBC.com reporting that employees at JP Morgan Chase have been asking when their turn will come. CNBC.com banking reporter Hugh Son joins us now with more on if and when a big bank might give Bitcoin that breakthrough moment. It's one thing when it's a custody bank, servicing assets for clients. It's quite something else when it becomes a part of the traditional banking system. Right, Hugh?
Yeah, no, Dom, how are you? And happy year of the ox to you, my brother. So look, when you look at what came out of BNY Mellon, I mean, if you look at JP Morgan's businesses, they have a custody, right? You look at the news from MasterCard just yesterday or 2 days ago, I forget, they also have payment rails as well. So you're seeing different parts of the ecosystem, and banks, being the most heavily regulated, they're the most complex. They're also the most crucial to our U.S. economy, because they have so many different business lines. They have asset management, retail banking, obviously big corporate investment banking, Wall Street banking divisions. And so it would be a huge stamp of legitimacy for the asset class, this nascent asset class, if a JP Morgan or if a Goldman Sachs were to get involved.
Who is pushing for this? I alluded to the fact that it could be internal employees. If it is internal employees that are pushing for this, how are the executives at these organizations answering some of those questions from employees?
It's a good question, Don. So, as you know, there is a groundswell. Okay. And look, even in the 2 weeks or so that I've been looking at this story and trying to get insider information about this, Bitcoin went from 30,000 to almost 50,000. There was a more than 50% increase just in the 2 weeks I've been researching the story. It is insanely volatile and insanely, surging at the moment. And so when you have that kind of price action, naturally, you think about the makeup of a Wall Street trader, they look at these charts and they want to get involved. They want to get involved because, making markets in something that has this level and has these characteristics should be profitable if you can handle the risk. So, the town hall that I reported on, the JP Morgan town hall, they engaged on this. They had to. There were scripted comments, between the head of the CIB, the head of the Wall Street division, and the head of markets and trading. And they brought it up and they discussed it. And, they were, for the most part, open-minded about it. Now, when I specifically asked them about this, because I'd heard wind of this, you had Daniel Pinto actually just say, basically, look, when this is a mature asset class, or when it's as a maturing asset class and everybody else is dealing with it, we have no choice but to deal with it. And it's more likely than not that they will eventually grapple with this.
It's a huge story. Like you said, one of the most heavily regulated industries out there. Hugh Son, thank you very much for that big story in JP Morgan and Bitcoin as well. I'm sure you'll stay on top of that for us. That does it for us here on The Exchange. Power Lunch starts after this quick break. Have a great holiday weekend.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as a train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism and in 2021, so we have to be ready for a new phase of tourism.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market?
were able to record last year in China is really amazing. And it was, by the way, the best that we had in 20 years.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Good afternoon, everybody, and welcome to Power Lunch for a Friday. Morgan Brennan will join us in just a minute's time or so. We're following the big money today, and we'll tell you where wealthy investors are placing their bets right now with the Biden administration in the White House. How have things changed? How much cash do they have? We'll tell you. Plus, stacking the chips. Why semiconductor stocks are surging amid a global chip shortage, affecting everything from video games to cars to mobile phones and more. And later, a blooming business. 1-800-Flowers, the stock doubling in the past year. The CEO of the online florist and more will join us as Power Lunch starts right now.
Good afternoon. Let's begin with the markets. All three major averages sitting just a few points from the record highs. The S&P right now is basically flat. 39.16 is your level there. Mike Santoli is looking at what the market is telling us about where it might go next. Mike.
Yeah, Morgan, at the index level, the market has been idling for a few days, really holding right near the highs. That says something in itself, the refusal really to buckle, despite the fact it's lost some momentum here. So you see it's still really solidly in this uptrend. We had that little kind of drop to the downside, that air pocket around the GameStop stuff, and we're right back on trend. So we'll see if that lasts as we get into next week after a long weekend. But look at some of these indicators of risk appetite, some of these subsectors of the market that'll tell you whether the cyclical enthusiasm about the economy is still intact. Pretty much so, yes. This is a month to date, so it's only a couple of weeks. This is the semiconductor index having a tremendous run, as we know. KCE is the investment banks, brokerages, asset managers. It's kind of the financial markets squared. That's what those companies are about. That's usually very healthy when they're outperforming. And the transports also, at least this month, have started to outperform as well. So nothing much has changed about the cyclical view. Take a look at Treasury yields. They are also, again, on the rise. And this is a 6-month look. So it's a pretty steady uptrend there as well. We're just about above that level from early January. So it seems as if the market is still comfortable with this economic reacceleration theme, Tyler, even if overall we're taking a little bit of a breather.
I love that line there. The KCE is financial stocks squared. Michael, thank you. So as stocks sit near record highs, Bank of America Global Research adding yet another word of caution in here, publishing a bull-bear barometer showing stocks are nearing what they say is a sell signal. Close, 7.7. I guess when you get past 8, it's a sell. Let's ask Ron Insana, senior CNBC analyst and commentator, as well as senior advisor to Schroders North America. You're so senior, Ron, I can't even stand it. And Michael Farr, CNBC contributor, president and CEO. You are going to be a senior? All right, well, get in line. I'm there. Well,
I'll be
get that
60.
nice Medicare card.
And
you'll be 60.
And he's a month older than I am, so we're going together.
Well, Ron, then you qualify for that nice GE pension. You got that coming to you, brother. That's going to be a good thing. Michael, how warm is it down there in Florida where you are?
You know, it's awful, Tyler. I think we're at about 83 today, and it's kind of muggy, so, you know, the air conditioning's turned down a bit. The hate mail, I can hear the hate mail coming out. Yeah.
Gentlemen, let's talk about the sell signal that apparently B of A says we're close to. Ron, do you see it that way?
I mean, I don't know. It's a tough call here. I mean, you know, yes, there are measures of this market that are in nosebleed territory, whether it's traditional valuations like price-earnings ratios, whether there are some sentiment gauges that are extremely high, whether the B of A Merrill Lynch number is pushing towards it. The problem that I've had with this argument, Tyler, and you know I've been cautious about all the speculative nonsense that's going on in the market. Just generally speaking, bear markets themselves do not start without higher interest rates and a less friendly Fed. And we're not there. So yes, the long yield, the 10-year note yield could be a problem for stocks, could trigger a correction 5, 10, 15%, always a possibility. I don't know if it's a type of sell signal, though, that sends everybody to cash unless they're in really low quality stuff.
Yeah, and Michael, I think you sort of see it the same way, if I understand you correctly, that as long as we've got an accommodative Fed, and it is really accommodative, and as long as we've got the prospect of further fiscal stimulus coming into the system, that really is a floor under stock prices, or argues that in the long term prices will rise.
I think so, Tyler. I mean, you take that and you combine it with, you know, a population that's going to be returning to more activities as we get past more vaccinated come the summertime. And you have pent-up demand from so many consumers who have been staying inside and have been holding back. So with all of the stimulus, with the low rates, and with a economy that's going to be returning to some more normal level of activity, it's really hard to argue how this stays down. And indeed, over the last 10 years or so, when as the Fed, or 12, as the Fed has been so accommodative, you've been wrong to bet against the Fed.
Yeah. Ron, I mean, Mike Santoli just showed us the S&P, and we saw that little pullback. I guess it's hedge funds who are kind of de-risking in the midst of all the Reddit stuff 2 weeks ago. I mean, overall, though, you could make the argument, at least in recent months, that it's kind of been a Teflon market. What do retail investors, especially those new retail investors who've been getting into this market, need to know and need to think about with everything we are seeing?
Well, you know, Morgan, it's an interesting question. I was just thinking about this before we came on. You know, you're probably too young to remember the movie War Games with Matthew Broderick, but at the very end, the computer that at NORAD says, you know, the best way to win is not to play. And I think when you get into this speculative insanity that we've seen, you know, whether it's the short squeeze stuff, whether it's, you know, getting involved in pot stocks and running them up for a day and then watching them fall, or getting involved in really speculative types of day trading activity, just don't do it. Stick to your discipline, you know, do the things that, and again, like, I'm not a personal finance guru by any stretch of the imagination, but you need your 6 months, you need your 401k, your health savings account, your kids' education, and then if you have Vegas money, you know, by all means go at it and play however you want if you can afford to lose that money. But for retail investors, I think this notion of a Reddit rebellion, or the idea that they can somehow take on pros on their own terms, is really wrong-headed, and they may have some buying power, but I can assure you that the pros have more. And again, as Leon Cooperman and others have said, myself included, these episodes end in tears. I think these are pockets of speculation that don't necessarily reflect where we are in the market cycle. It's late, no doubt about it, but the pockets of speculation, I think, will burst on their own.
Yeah, Michael, I want to get your thoughts on this, and also, I guess, just on the fact that, I mean, we're talking about the Fed liquidity picture and the Fed's involvement, the Fed's policy, and what that's meant for the market here. I mean, one of the things that B of A note points out is that we do continue to see that move by investors further out on the risk curve, specifically looking at the yields on U.S. junk bonds. I think record lows there. I mean, how does that speak to this moment that we're in the market, and what new investors to it need to know?
Right. Well, so two things in that question, Morgan, that are really important. When you have this much liquidity added to the market and you keep rates this low, when rates are this low and you can't get a return anywhere, you've got more dollars chasing more things, and therefore it pushes folks out further on that risk curve. It's been happening. I think it's going to continue to happen. I always try to remember that Fred and Ethel are listening. The average investor is listening today. And what you need to know, Fred and Ethel...
All these great pop culture references.
But ours are, and Sana's and mine are all old, you know. We're going back to Fred and Ethel. Look, we are one day closer to a correction. We're going to have another correction. Will it be 10%? Usually at this part of the year, February, earnings cycle's over. We've got a whole year of uncertainty in front of us. We've had a number of corrections in this February-March period. Wouldn't surprise me to see another one. It would surprise me to see it as the beginning of some sort of sustained bear market. So you look at your asset allocation, as Ron was suggesting, you think about being a long-term investor, you stay away from the speculative nonsense, and you stick with your discipline. If you have to reallocate and do a little bit of selling and de-risking, fine. Longer term, this market has a really strong tailwind underneath it. Earnings estimates are up 24% for the S&P 500 this year. That's tough to fight, Morgan.
But we're going to have to leave it there. Far and farther out as we go off, the chart was on pot stocks, gentlemen. I think that's a great place to leave it.
Yes.
We'll talk to you guys again soon.
Next week, it's the Fred and Wilma portfolio. We'll go even farther back.
Thank you. There we go. I like that.
Yabba dabba doo. Yabba dabba doo. All right, Morgie.
All right, on that note, a lot of optimism in the stock market recently, driven at least in part by improving numbers on coronavirus cases. Meg Terrell has that data for us. Meg.
I'm still laughing at Morgie.
Yeah.
So, Morgan, we are seeing improving trends in COVID numbers. If you look at cases, they are down 60% from their peak in early to mid-January. Hospitalizations down about 40%. And deaths, while the number is still too high, those have started to come down a little bit as well, about 15% from their peak. Now, we've talked with epidemiologists, virologists, and doctors trying to determine, is this real? What is driving this? And they told us a few things. Caitlin Rivers at Johns Hopkins saying that she thinks there is more social distancing and masking going on after people saw those major surges around the holidays. She also noted there might be 20 to 30% population immunity in the country right now. So fewer people infected, fewer people who can get infected means that there are just fewer people for the virus to reach. And then people did note that vaccinations are picking up, but it's still pretty early to see an impact from them. Now, the risks to this are, of course, more holidays and celebrations like the Super Bowl and Valentine's Day coming up. People are worried about cities and states lifting restrictions too soon. And, of course, the variants B.1.1.7 associated with the UK and the South African variant B.1.351. Now, we talked with Dr. Daniel Griffin from ProHealth about what he is seeing right now. Here's what he said.
We are so close. We're seeing that the numbers are going down. We're seeing that the deaths are starting to decrease. We're seeing the vaccine rollout increase. So I think things are really looking good. I think we've got a great spring and a great summer ahead of us, as long as we don't lose this fight and we don't get lulled into a sense of false security too soon.
So that really sums up what we heard from a lot of folks. There is real optimism about these trends right now, but warnings that we cannot let up too soon. We've got to double down and make sure we secure this for a good summer ahead. Morgan?
Yeah, Meg, I mean, as you said, it might be a little early for vaccines to be playing a huge part in the declines, but the rollout is picking up steam. So Alaska is the state that's doing the best. 30% of adults over 18 have received at least one dose. Of course, that's a very small state. Let's keep that in mind. But both Florida and California are at 17%. The supply may be ramping up even more. Talk to us about that.
Yeah, we got some news yesterday that President Biden has finalized contracts for 200 million additional doses of Pfizer and Moderna's vaccines. And he says the delivery for now a total of 600 million from both companies will be by the end of July. Now, that's a lot ahead of what we had been expecting. So that's enough for 300 million Americans, not even factoring in the Johnson & Johnson vaccine, potentially vaccines from AstraZeneca and Novavax, which could be coming over the coming months. So we will have a lot of vaccine before the end of July. The question is, will we have enough vaccinators and capacity to administer those vaccines for, as Dr. Fauci says, open season for vaccines to start in April? We can all hope, of course.
Meg Terrell, thank you. Tyler, or should I say Ty?
Morgan, you read my mind. I was just going to say to you, you are free to call me Ty anytime you'd like. Okay. Anytime you'd like. How did you know? How did you know? Does everybody know that? And I don't know that they know?
It's like psychic brainwaves, you know, through the remote connection.
I guess it's just the connection.
Screen.
Yeah, you can't do away with the connection. It's just there. Doesn't matter whether it's remote or not, right?
That's right.
All right, we're going to move on. Morgan. Coming up, semi-stocks at record highs and on track for their best week since November in the face of a global chip shortage. We will break down how the chips are stacked, plus 1-800-Flowers, benefiting from more people ordering gifts online. We will talk to the CEO about making the trend bloom. How do you like that? It's nice writing right there. Power Lunch comes back after this.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
As we cover COVID-19, our business is business. Stocks are telling us that the economy is going to come back and resurrect itself relatively more quickly than some of the economic numbers say. Making sense of the disconnect is what we're trying to do every day for our viewers. The way we socialize, the way we travel, it's all going to be changed for many, many years. This is seismic, it is historic, it is the story of our lifetime.
Welcome back. A big week for semiconductor chips. Semiconductors are in short supply as the demand for at-home electronics remains higher than ever, with far-reaching implications across the market. And Qualcomm, Microsoft, and Google putting their chips on the table. According to reports telling regulators they object to NVIDIA's $40 billion acquisition of British chip designer ARM, whose chips are used in 95% of smartphones worldwide. Joining us now to discuss all of this and more, Daniel Newman, Futurum Research Principal Analyst and Founding Partner. Dan, thanks for being with us today.
Hey, thanks so much for having me.
So we've been following this chip shortage very, very closely. I think probably the place I want to start, though, is what we've seen in terms of a reaction from the Biden administration so far. The fact that the president is expected to sign this executive order that initiates a 100-day review looking at the supply chain. Is that quick enough? Is that actually going to help this shortage anytime soon?
Yeah, I think we're in a real difficult situation. Of course, we've heard from the likes of AMD's like Lisa Su and others about the expectation of this lasting about 6 months. So 100 days, if her interpretation is right, is going to put us nearly all the way out, well over halfway into that 6-month period. And I really do wonder, Morgan, are we able to shorten this delay at all with any action that could be taken right now based on what got us here, right? Which was companies cutting forecasts, getting stuck in the back of lines, automotive industry missing our estimates that chips for smartphones wouldn't be needed. I think the Biden administration really needs to focus on how do we not allow this to happen again?
So how do we not allow this to happen again? And I bring that up knowing that there has been a debate, a discussion, and this was also the case in the Trump administration as well, about onshoring more chip manufacturing here to the U.S., which I realize could be a multi-year process, and that there are a lot of potential challenges associated with that as well. Is that something that could actually become a reality?
It's something we have to look at very closely. The economics of it are globally, anytime a fab has been built, it's almost always had some sort of government subsidy. And generally speaking, the economics are pretty good. And a lot of people talk about the jobs that would be created in the fabs, which is part of it. But you have to realize there's a whole economy around the semiconductor industry. You know, you build the fab, but there's also sourcing the materials, there's manufacturing, there's distribution. So there's a compelling case if we can make the economics work for many of these fabs. And by the way, it probably makes the most sense to really be looking at those that have already done this, you know, the TSMC, which is, of course, moving into Arizona, UMC, Global Foundries, Samsung, and others. How do we make it more appealing for them to come here? Because there's also the national security side of this as well. So there's economics, there's national security. There's a lot to consider here. But yes, onshoring more of this could certainly drive more capacity.
Yeah, so in the meantime, this deal, this NVIDIA deal to purchase ARM, it looks like, according to the reports, Google, Microsoft, Qualcomm are among some of the big names that are objecting to this acquisition going forward right now. Do you think it gets shelved, or do you think it actually happens?
That's a really tough question. If I could answer it, I'd probably be on the show a lot more often. What I would say is that, you know, any deal of this magnitude warrants some really careful consideration and review by regulators. We saw what happened with NXP and Qualcomm. It's a lot of scrutiny. It took a long time. The deal did not end up happening. ARM enables hundreds of companies to design, develop, package, manufacture semiconductors. So it wouldn't surprise me that companies, those that you mentioned, which are leading manufacturers of semiconductors or leading users of semiconductors, wouldn't want to make sure that an adequate amount of diligence is performed. Because ultimately, we have to protect the competitive landscape. That's what this regulatory scrutiny is all about. You got to ask, is it good for the consumer? Does it protect continued innovation and development in this particular industry? So your guess is as good as mine. But what I would say is, I'm really interested in seeing how this does play out. There's a lot at stake, and I would look at the consumer and how they could be harmed or not, and what type of advantages this could drive for innovation if it was to happen or not.
Okay, so quickly and lastly, given the fact that we do have the SMH, the Semiconductor Index, trading at record highs this week, are there names where there's still investment opportunity to be had, still upside to be had?
I mean, as an industry analyst, I don't track it exactly the same as the equities folks, but the momentum is huge, Morgan. I mean, all the chip makers, you're seeing the huge demand. Qualcomm's earnings last week, you heard incoming CEO Cristiano Amon basically say, we would sell as many of these as we could have made. So the demand is there. So I'm still very bullish about where the semiconductor market is going.
Dan Newman, thanks for joining us today.
Thanks, Morgan.
All right, Morgan, still ahead, the coronavirus dampening tourism in states like Florida and Arizona, but not for the reason you might think. Jane Wells is in Hollywood, Florida, with a look at travel shaming. Jane?
Hey, Ty. Usually this boardwalk, they call it Broadwalk, is packed in February with Canadians, but they're not here. And those who are going home are discovering it just got a lot more expensive. When we come back, angry snowbirds.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
courageous visionary facing tremendous odds.
I've always taught him to aim for better.
An entrepreneur with a sharp sense for business.
You just need drive and determination.
Now, with a company worth over $6 billion.
We will do massive amount of business on a global scale.
Daymond John is taking the world by storm and doing it in style.
If I can do it, anybody in the world can do it.
The brave ones, Daymond John. CNBC.
Helping you navigate the new normal. Squawk Box on CNBC.
Welcome back, everybody. Some snowbirds are skipping their winter trips south, and that's hurting Florida and Arizona. Jane Wells is in Hollywood, Florida, with more on that story. Hi, Jane.
Hey, Tyler, the latest Florida tourism numbers show that Canadian visits are down 99%. In Arizona, it's estimated they're down at least 70%. That's a loss of billions of dollars. Now, the border remains closed with Canada, but you can still fly here, and many snowbirds are coming across through airplanes and then having their cars transported across to the U.S. But they're learning when they go back home, they'll soon be forced to pay to stay in a government quarantine hotel until they get a negative COVID test.
Stay 3 days in a hotel, but they test you. You're going to see nobody. You're allowed to go out, smoke a cigarette once in a while. No, it's almost jail.
I don't know if I'm supposed to say, but our government is not treating us like your government here.
And snowbirds are screaming and squawking about this, saying, well, that wasn't the case when we left. But as I said, there's not a lot of sympathy for travelers.
Now, Jill Wykes usually winters in Sarasota, but she's staying home in Toronto. She edits the 55,000-member Snowbird Advisor. And whether to travel has really divided the snowbird community. In the meantime, here in Florida, they are benefiting a little bit from more domestic travelers from Ohio and Michigan, and they got a little bump last week from the Super Bowl in Tampa. Guys?
Jane, I just returned from Florida a few weeks ago. What, from your observation, now you live on the West Coast, I know, around L.A. From your observation, how do you sort of view the uptake of mask wearing and social distancing in Florida?
Well, California is 180 degrees, just as it is on the other coast. It's another world when it comes to mask wearing. Different governor, different sensibility in most places. You know, there's nice air circulation out here. You have to wear masks indoors at the hotels. But the outdoor bars, there's no social distancing and there's no mask wearing.
Yeah, that was what I noticed. It was a very different take from the New York metropolitan area, and I wondered whether you confirmed that or not, and you just did. Jane, great to see you. We'll see you next time. Morgan?
Yeah, take care.
All right, well, coming up on Power Lunch, the S&P 500 is up more than 10% in the last 3 months. Pretty nice return there. But not compared with Bitcoin, which has tripled. Is there a wealthy investor sticking with stocks or betting on Bitcoin? Plus, one business that's blooming during the pandemic. Can't take your Valentine out to dinner? Well, at least send flowers. The CEO of 1-800-Flowers will join us next.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
Keep up with the crisis. Squawk on the Street on CNBC.
I'm Courtney Reagan, and here's your CNBC COVID update at this hour. The CDC has just released detailed guidelines on how schools can open for in-person classes, listing a range of precautions that should be taken. It also says vaccinating teachers is not a prerequisite for reopening. The pace of vaccinations continues to pick up, with more than 2 million doses of COVID vaccine administered in the United States Thursday, bringing the total to 48.4 million. Moderna says today it's working with regulators on a plan to put up to 15 doses of vaccine in each vial instead of 10. New York Times reports the FDA likes the idea, but still wants to see more data. Using the same vials would let the company significantly increase production more quickly. And in Florida, a massive line of cars at a state-run vaccination site amid confusion over second doses. Dozens of people got their first dose at the center 3 weeks ago, but when the site was run by the county, they were told then they didn't need an appointment to return. But now that Florida is running the site, appointments are needed, resulting in dozens of elderly people being turned away. Oh, Morgan, we got to get this figured out. Back over to you.
I sure do. Courtney Reagan, thank you. The markets right now are mixed, but we're in a very narrow trading range. The major indices are on track for their second positive week in a row. Energy, again, the best performing sector. Take a look at the standout today. The Dow transports are up more than 1% today, up nearly 3% for the week, basically tracking similar gains to the Russell 2000 for the week. The oil market, meantime, though, is closing for the day, and we will go to Josh Lipton for those numbers. Josh.
So, Morgan, oil is settling higher today for the ninth session in 10. That's amid renewed optimism for another round of stimulus. Aside from yesterday's pullback, oil prices have been gaining ground here for several weeks thanks to unexpected declines in U.S. inventory along with OPEC's output curbs. But the demand picture remains unclear as COVID continues to spread and new travel restrictions are imposed throughout the world. Nonetheless, oil's gains have pushed the energy sector to outperform yet again this week. Notable gains in Occidental, Marathon, and Devon Energy, all up more than 10% this week. Back to you all.
All right, thank you very much, Josh. Now to a pandemic winner that is growing profits. Shares of 1-800-Flowers.com up over 90% in the last year. The company also recently reported record sales in its second quarter. And here to talk more about the blooming business ahead of Valentine's Day is Chris McCann, CEO of 1-800-Flowers.com. Chris, welcome. Good to have you with us. I guess the answer here is something we really probably knew all along, and that is that ordering flowers, you've made it very easy. It's not just flowers that you have Harry and David and other services as well. But boy, in a pandemic, when people can't go out, this is the way to go. And that seems like a very sticky kind of habit change.
I think so, Tyler. What we've seen is an acceleration of growth in our company that began back in 2018 and really then accelerated even further in 2020 with the pandemic. But it's driven by what you just mentioned, the need that we as people have learned. We have this need to connect, to express ourselves. And as a company whose vision is to inspire more human expression, connection, and celebration, and an e-commerce leader, we're just so well positioned in the trends that we see coming out of this pandemic that we think are sustainable going forward.
And people want convenience, which you clearly supply. Let's go beyond, because I think a lot of people maybe don't know all of the different businesses, I mentioned Harry and David, that you have. Flowers are one thing, and you can obviously, I don't mean to use, there's no pun intended here, you can grow that business organically, you can expand it. But what are the other platforms and areas that you're concentrating on and that you see as the growth drivers potentially of the company over the next 5 years?
And I think the word that you used, Tyler, is really what we've done is we started out as one flower shop many years ago, but what we've done is created this platform, this e-commerce platform for growth, a platform for expression, connection, and celebration. And it starts with this all-star family of brands that we have, led by Harry and David, 1-800-Flowers, Cheryl's Cookies, Sherry's Berries, our recent acquisition just this past August of Personalization Mall. So you see us now as a company in the expression and connection business with a leadership position in floral, a leadership position in gourmet food gifting, and certainly now a leadership position in expressions, personalized items, which is a fast-growing market. So you'll continue to see us grow by organic product development of products that help customers express and connect, or as we've done through acquisition as well, adding to that platform and leveraging that platform that we've built.
Yeah, I want to dig into that a little bit more. But first, Chris, I mean, whether it's flowers or whether it's some of these other businesses, we're talking about e-commerce. I know certainly some investors, some analysts out there have basically labeled your company as one of those COVID beneficiaries, given the trends we've seen throughout this pandemic. As we see vaccines roll out, as at some point, probably, hopefully this year, later this year, we see something of a return to normalcy, if you will. How much can the strength, can the growth that you've seen in your business continue?
Well, hopefully the vaccines accelerate and we return to some sense of normalcy sooner rather than later. But as we look at our business, as I mentioned, the momentum we saw began in 2018, 19, accelerated at the pandemic, but we've been on a good momentum growth even before the pandemic. And we really see ourselves now as a bigger, stronger company than we were prior. We've acquired Personalization Mall just this past August, and by putting it on our platform and leveraging our digital marketing expertise, we accelerated the growth of that company to where it grew by 50% this last quarter. A year ago, August, we acquired Sherry's Berries and took a business that was stagnant and losing money to now one that's got a nice growth rate and is generating a nice contribution margin as well. So if we just keep our focus on what is the consumer looking for to help express and connect, then we see double-digit growth for some time to come.
Speaking of,
I think that's important.
Go ahead.
Go ahead. Well, I think it's important to recognize that trend that we've all learned from being isolated, our need to express and connect, is a lasting trend coming out of this pandemic, along with the shift of offline to online.
Speaking of potential consumers, this advertisement that you put on Reddit, the love is a beautiful game, stop worrying about it, take your relationship to the moon, rocket ship emojis with a bouquet, love stonks. It's very clever. I'm wondering what kind of traction it's gotten.
It's gotten great traction, and I think it's gotten what you just did. It's put a big smile on people's faces. That's what we're trying to do, is just make sure we're relevant, create that cognitive speed bump when people think about our company, they see something different. And I'm thrilled with the creative team for coming up with something like that.
All right, Chris McCann, thanks for joining us.
Thank you, Morgan. Thank you, Tyler.
And happy Valentine's Day. Well, from worst to first, Google lagged FANG stocks last year, the rest of the FANG stocks, but leading the pack so far in 2021. Will that trend continue? Plus, in power movers, rockets, electric vehicles, and a biotech stock making big moves. Stay with us.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
On set, Casey Affleck and Anthony Atamanik, plus a closer look at New York will resume indoor dining ahead of Valentine's Day.
The perfect way to tell someone, I love you, but I'm indifferent to your grandparents.
New Seth this weekend.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary, feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of millions, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special year of the ox, Plowing On.
Welcome back, everybody. Time for the final Power Movers of the week. I don't know that I can wait until Tuesday for more Power Movers, but I'm going to have to. Fisker Automotive, it's soaring. Morgan Stanley's Adam Jonas initiating coverage of the stock at overweight with a $27 price target, calling it a sleeper premium electric vehicle play. On the other hand, Jonas starting coverage of Lordstown Motors at an underweight. $18 is the price target there. That stock getting hit, as you see right now, down 13.5%. And Amicus Therapeutics down big. Its treatment for a rare disease did not perform better than the current standard of care in a trial, down a third today. And we end with Virgin Galactic, the company delaying a crewed test flight, that's C-R-E-W-E-D, crewed, of a rocket to allow for more Morgan technical checks.
Yeah, and that's one I'm watching pretty closely. I mean, stock's down about 7% right now, but keep in mind it's still trading well above $50 a share. And we've seen some pretty dramatic moves just since the start of the year in that name. This is also a test flight with humans on board that was supposed to happen back in December. So the fact that it's pushing again right now, I think it is something that folks that follow this stock are watching very closely, because you need those tests to happen for service to actually launch, right? But this is part of that bigger, broader space tourism conversation we've been having.
Big setback or not a big setback?
Not a big setback, just unclear, still unclear when specifically we're going to see that test flight happen. It was expected to happen as soon as tomorrow, so now it seems like the timing is shifting. How much it's shifting into the future, we'll have to find out. Hopefully we get some updates in the next couple hours or next couple days. But anyway, Seema Modi, we are going to go to now for Trading Nation. Seema.
Hey, Morgan, we are talking tech today. Google parent Alphabet, the laggard of the FANG stocks in 2020, now up 20% in the last 2 months, beating Facebook, Apple, Amazon, and Netflix by a mile. Citi also upping its price target today to more than $2,400 a share on free cash flow estimates. That implies another 16% upside. Analysts bullish on the company's growth, but removing the stock as their top pick. Let's discuss a bit more with our Trading Nation team. Craig Johnson of Piper Sandler, Daniel Shea of Simpler Trade. Daniel, I interviewed Expedia CEO Peter Kern earlier today, who's told me that he plans to rely less on Google as he tries to drive more direct traffic to his site. I'm wondering if that's a cautionary sign, especially if other travel companies follow suit.
Well, it absolutely could be more of a cautionary sign, Seema. But I mean, for me, what I'm seeing in my personal life and just in talking to the people around me, I mean, YouTube is absolutely huge, right? And you have a situation where with this pandemic, we have seen a rush to online everything. You know, my son, he was supposed to have a snow day today, but sadly, he's now doing school on YouTube. And I think that this is just a trend that is going to continue in the future. I don't think that we're going to go back to the way things were pre-pandemic. I think that Google has been the leader in this space. They really don't have any kind of competition. Yes, companies can try to create their own avenues, but I do think that Google's going to continue to remain the leader, and I'm very bullish Google. I think that 2,400 is a great target.
Interesting. Craig, above 2,000 now. I mean, has the stock risen too far too fast, or do you agree with Danielle that it can go even higher from here?
See, I agree with Danielle that I think it can go a lot higher from here. And when you actually look at all these FANG stocks, I mean, it has been among the most constructive names. So those large cap growth investors are definitely going to be over-indexing in Google Alphabet from here. And as I come back and I look at the longer term chart, primary trend is higher. You're above your 50, you're above your 200-day moving average. The relative strength trend is broken out. So if you're looking for alpha in the large cap space, Alphabet is the name, and we would continue to be a buyer of it.
We'll see if you guys are right. Craig and Danielle, thank you. Have a great weekend. And we are tracking the restaurant stocks as New York City reopens for indoor dining on tradingnation.cnbc.com. You can also follow us on Twitter. Morgan and Tyler, back to you.
All right, Seema, thank you. And the S&P 500 has been on a big tear, seemingly hitting new highs every day, up nearly 80% from the March lows. There it is today, basically flat. So what are wealthy investors doing with their money right now? Are they taking it out of stocks or putting more in? What's the hot area? That's next on Power Lunch.
And daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Is that of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero, 90% of those are now back at work.
We are optimistic. The fiscal stimulus and investment will be boosting our demand.
We have already several quarters of contraction, so I hope that we could see some encouraging growth.
We are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Foreign tourism will be coming a little bit late that we expected earlier.
A big part of resuming travel
would be to get standardized procedures.
Life insurance in Asia continue to be strong, and then some of these structural trends have been accelerated.
Working from home has been so much accepted in Japan. Some industries are booming, so they can absorb jobless people.
Welcome back to Power Lunch. As the markets continue to hit record highs, wealthy investors are moving more and more cash off the sidelines. Members of Tiger 21, a peer-to-peer community of wealthy investors, said in a recent survey that its cash on hand, their cash on hand, has dropped to 13%, down from a pandemic high of about 20%. So where's all that cash going? Joining me now is the founder of Tiger 21, Michael Sonnenfeld. Michael, thanks for being here.
Thanks for having me. Nice to see you.
Where are wealthy investors putting that cash to work right now?
You know, Tiger 21 members are entrepreneurs who made their money primarily in the private market. So about half that money is going back into real estate and private equity, and about 20-25% of it is in the public markets. But if you were Rip Van Winkle and you went to sleep in late 2019 and you woke up today, you'd think it looks just like it did then. Nothing happened in between. Cash is back down to our normal levels, and those three allocations are about normal. They're interested in technology stocks is number one. We've been talking about the FANGs all year. Healthcare after that. Tesla, big winners. So people are pretty optimistic. They still have high levels of cash, but much less so than what happened in the pandemic.
When you mention real estate, what kind of real estate are we talking about? I mean, we've certainly been focused here very much on how hot the housing market is. Is it that, or is it something else?
So our members mostly made the largest category of our members' wealth came from real estate. So you have some of the top developers and operators across the country. And when they get into groups, they're dissecting the difference between the gateway cities like New York, where residential is downward trend, last mile industrial, where all of those internet deliveries are being delivered from, as hot as anything anywhere around the country. And so we're really trying to debate what's changed forever and what will come back. I think New York City will eventually come back, but retail, it'll never be the same because online delivery is just too convenient. And how many of us will go back to the same office environment that we were in before the pandemic? Offices will come back, but I think patterns of office use will be changed forever. So our members look in transitions for where there are real opportunities. Workforce housing, as an example, is something that provides steady income that our members like a lot.
Michael, what's happened to hedge funds? The percentage of cash or dough put in there has been cut by half or more. over the past couple of years. Why have your members soured on hedge funds?
So hedge funds just can't produce the juice they used to. Most hedging strategies, the ones that are traditional, their profits are related to a spread off the risk-free rate. And when you have such low interest rates, many hedging strategies just can't produce the results they once did. And because of their fee structure, those fees which people were willing to pay when they were producing high returns, they can't stomach with the low returns. So we've had this historic change. A decade ago, 7, 8, 9% of our assets were in hedge funds. Today, it's down to an historic 3%. It's really remarkable.
So, Michael, we've been talking a lot about Bitcoin and cryptocurrencies and about the fact that institutional money is starting to come to the asset class. I've also been hearing from a number of folks that we're starting to see more family offices take it more seriously as well. Are these the types of conversations? Are you seeing these types of investments play out as well in your network?
We do. You know, we have about 80 groups around the globe that get together every month, and the people in our groups are entrepreneurs, as I said, who've had liquidity events and are now learning from one another what to do. So Bitcoin is a hot topic. It's been a hot topic for 3 years. 3 years ago, it was our #1 asked for, and it has huge potential because of all the reasons: digital currency and global span and low transaction costs. But we had a conference last week with one of the top bankers in the world, and basically he said it's not going to go as far as you think before governments are going to step in. Governments can always step in. That doesn't mean Bitcoin will go away. It means that the way it's constructed now may have some changes, and it still could be a fantastic opportunity, but more in the nature of gold, if you will, except that gold is physical, and Bitcoin, of course, the advantage and disadvantage is it can move like lightning around the planet.
Yeah, Michael, I mean, you mentioned the fact that tech stocks and those growth names have been popular, but given the rise we've started to see, particularly in the long end of the curve, in long rates, interest rates, I wonder how much of a risk factor that is, and if inflation is truly a concern among those investors.
So everybody who had a classic training, MBAs, the members in our groups, when they talk about inflation, there just isn't yet any sign of inflation. People are expecting, I think the reason cash has come down, people are expecting inflation and interest rates to be low for the near to midterm. And in that environment, it speaks very well to the markets. So long-term is a long-term away, but right now it's a pretty positive story. And the reason why technology continues to be our #1 area is in a frictionless economy where you can scale an idea to $1 billion in an instant. You don't have to build a factory. You don't have to build a distribution system. You don't have to hire thousands of people. Technology stocks can scale like no other. And given the challenges of climate and the opportunities of artificial intelligence, technology is going to be the driver of the biggest change in our lifetime, which will come over the next decade.
Michael Sonnenfeld, thanks for being with us.
Thank you.
All right, right now, the Dow is down about 50 points, modest sort of flittering between positive and negative on the other indexes, and we will get you set for the last hour of trading before the long weekend next on Power Lunch. And don't forget, you can always watch or listen to us live on the go on the app. And that's what you need to do. We'll be right back.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure we will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure it will be able to understand and to heal the growing social malaise.
On the next Managing Asia, we put the spotlight on sustainability.
By 2030, we want to all abolish petrol-based virgin PET bottles. That is a huge challenge.
I'm hopeful that we'll be able to cut the amount of plastic getting into the ocean in half over the next 10 years.
The interest that Claire and I have had when we were much younger has always been about trying to make a difference in the world.
Companies doing good on the next Managing Asia.
Morgan, my 1-800-Flowers order is on the way to you. Happy Valentine's Day.
Oh, happy Valentine's Day, Ty. And thanks for watching Power Lunch. Closing bell starts right now.
To both of you, welcome everyone to Closing Bell. I'm Sarah Eisen here with Wilfred Frost.
He's
a
showing
mixed
us
session
up.
for the major averages, but the Dow. What?
Tyler's showing us up. Now I'm going to have to order some flowers for you very quickly.
Right. you still have time. A few days till Valentine's Day. Take a look at the major averages, pulling back a bit, still up for the week, third positive week in the last 4. Let's look at what's driving the action right now. Earnings remain in focus. Disney weighs on the Dow today despite reporting a strong quarter with nearly 95 million total subscribers for Disney Plus. But the stock is lower. Energy is back in the green, one of the strongest sectors in the S&P 500 today. And for the week, the energy sector's up about 4%. And an early read of consumer sentiment in February came in below estimates, raising some more concerns about the economy following yesterday's weaker than expected jobless claims report. 59 minutes left to go in the session. Wilfred.
Just higher on the S&P 500. Ahead on today's show, we'll speak with 3 CEOs whose stocks are moving on the back of earnings. Restaurant Brands Chief Jose Sill will join us in just a few moments to talk results, reopenings and much more. Plus, we'll speak with the head of Newell Brands about demand for everything from cookware to school supplies. And later, GoDaddy's CEO will be with us as that stock takes a big leg lower on the back of earnings. But first of all, let's focus on the big stories we're watching today. Mike Santoli's tracking the market action and taking a closer look at overseas equities. And joining us to talk about all of that is Mohamed Al-Arian from Allianz. Mike, let's start off with you in the broader markets.
Yeah, well, if we continue to idle here, right around the record highs in the S&P 500, it's been a few days right now where the index is kind of regrouping. It probably got a little bit overbought, is taking a breather. It's hard to look under the surface, though, and see too much that's negative, although we might be getting to one of these points where we've stretched to a little bit of the limits of the near-term rally potential. So keep pointing it out. It's riding that upper end of that line. That's been the case for quite some time right now. We've also done this a few different times over the course of this, 10, 11-month rally where you kind of flatten out and then recharge the rally. So we'll see if that happens. Global markets also very strong, so it's not just about U.S. story. In fact, look at the Shanghai market, especially this past week, the huge little vertical spurt higher. It has been a pretty good trend in general, but then you did see a little excitement. Now, just in general, a lot of things are continuing to confirm the general view out there that there's some kind of global economic acceleration out there, the reflation trade, so forth, really loose financial conditions. Look at the round trip that U.S. junk bond spreads have made in the past year. 1-year chart, crazy panic, liquidation in the March
the sell-off in equities and credit, and then we are exactly where we were a year ago. 3.5 percentage points is the spread between the average, on average, on the junk bond index to treasuries, which tells you got 4% or so, a little over that nominal yields. It's pretty tough to get in a lot of trouble unless that changes, and that supports equity values, even if they don't look cheap objectively.
Well, that's just what I was going to ask. Whether you believe in valuations or not, according to Josh Brown, they're irrelevant. Where does this take us on stock and debt market valuations with all this exuberance and more money flowing in?
Yeah, I mean, everything gets priced to some degree off of the cost of credit, and I do think that's why we're able to hold these valuations in the S&P. Also important to note that profits are coming in so strong and the estimates are going up fast enough that the S&P hasn't become more expensive on forward earnings than it was, let's say, last summer. So I do think there's a way in which the market can kind of hold in. Profits can rebound. Certain sectors race higher, other ones fall away, whereas, you can kind of do okay without normalizing valuations all in one bite. So that, to me, is where we are. A year ago, we were saying we're at the highest valuation since 2000. We are as well now at a little bit of a higher level, about 3%, about 3 points in terms of the PE.
Mike, thanks so much for that. For more on today's markets, let's bring in Mohamed El-Erian, former PIMCO CEO and Allianz Chief Economic Advisor. Mohamed, good to see you as always. Thanks for joining us. My first question is about positioning and inflows. When you look at all the data there, is it suggesting things are going to rise further from here, or are we getting a little bit stretched?
Thanks for having me, Wilfred. It's suggesting both. So the path of least resistance remains up. We've just had the highest weekly inflow into the equity market ever. So people are putting it to work. Charles Schwab's reported that there's been a massive increase in account opening, and there's more liquidity on the way. Having said that, we are at rather elevated prices. But this is all about liquidity. You've heard me say this over and over again. It is technical. The path of least resistance is still up over time.
When you see something like Tesla, which has been a darling, of course, of the market, buying Bitcoin, which has also been a darling of the market, do you start to think this is marking the top, or is it a bigger transition that's bullish for both assets?
So that one has a specific element to it, which is the broader acceptance of Bitcoin. And it's not just Tesla that is saying you can use it as a form of payments. It's others too. But you could have had in that sentence so many other things. You would have had SPACs. Look at the amount of SPAC activity we have had. Everybody and their brother and sister are opening SPACs. You could have all sorts of things that indicate that we are frothy. But remember the notion of a rational bubble. Yes, we are in bubble territory, but it's rational because of all this liquidity.
And the liquidity keeps flowing, Mohamed. The latest is Secretary Janet Yellen, in her first call with G7 finance ministers and treasury secretaries today, brought the go big message there, that now is the time to do something big on the economy. And yes, they were talking about sort of technicals of expanding the IMF firepower through SDRs, but what is the potential for more stimulus, not just from the United States at this time?
So she took the message go big to apply both to national budgets, where she's going to have less success, but also to apply to the IMF SDR issuance, which is basically an issuance of currency, that if it happens, countries will wake up and find that their deposit account has gone up at the IMF and they can spend it. So I think she will succeed on the global liquidity element because most other countries will go along. But she's not going to be able to move other countries very much on their own budgets. The U.S. is going to be way ahead. And if you just do the numbers, it is incredible how much liquidity is likely to be injected in this economy. The big question is, will it create an accident? At what point does a lot of liquidity become too much liquidity?
With that in mind, Mohamed, are you a believer that the dollar is due to weaken further, despite already having been soft of late? And why isn't gold performing better with all of this liquidity out there?
So first, I'm not a believer that the dollar will weaken a lot from here. I think we've seen most of the weakening because it is about more than just liquidity. It also has to do with vaccine distribution, where we dominate Europe. It has to do with the dynamism of the economy, with foreign direct inflow. So if you add everything up, it doesn't look as bearish for the dollar. So that's one. Two, gold, part of the attractiveness of gold has gone to Bitcoins. And I think that explains a lot where Bitcoins is as well. Gold is no longer seen as the only defensive vehicle. Now Bitcoins is starting to attract a lot of people that are in there for what I call negative reasons. You have the positive reasons, people that believe it's going to be a global currency, that believe it's going to be a form of payments. And then you have the negative reasons, people who just are protecting themselves against all sorts of things.
So wrap it all up, Mohammed. What does this ultimately mean? All the liquidity and everything out there, what the market's telling you about where the economy's going and for how long? Are we in the early innings of a multi-year new cycle or what?
So we are in the late innings of a massive disconnect. The question is, how do you close the disconnect between very high asset prices and a slumping economy? Today's consumer sentiment numbers suggest that it's not going to be a very smooth recovery. We're going to have ups and downs, but I think we're looking at a better economic outlook going forward. Will it be quick enough to validate the asset prices? I'm not so sure. And the biggest risk really is what happens to the Fed. How does the Fed react when nominal GDP growth plus inflation starts being so high that the yield curve gets very worried? What will they do then? If you got that call right, then you know what to do. But if you haven't got that call right, okay, it's a pretty uncertain outlook.
Mohammed, great timing, and let's keep the half screen of the yields up next to Mohammed there, because we've just hit year-to-date highs on both the 30-year and the 10-year. Whilst you're speaking, Mohammed, crossing 2% on the 30-year, briefly crossing 1.2 on the 10-year. What do you make of those levels, and is it rising too fast at the moment, or is this still a steady rise?
So the initial rise, which was the first full week of January, was too fast, and that's why the Fed intervened verbally. This one has been more moderate. If you put up also the yield curve, you'll see that the yield curve, the 210s and 230s, are very steep compared to what they've been in the last 2 years. So I suspect the Fed is looking at this. So far, the pace of increase has been moderate, and that's fine. But if this were to accelerate, then the Fed would have to face a choice between letting it go and risking the equity market, or alternatively going deeper into yield curve control. And that's a terrible choice for the Fed to have to face.
Well, we'll leave it there on that terrible potential decision. Mohammed El-Erian, thank you very much. Always good to talk to you from Allianz.
Thank you.
After the break, Burger King, parent restaurant brands, volatile this week on the back of earnings. We're going to talk to the company's CEO about the continued challenges from the pandemic and the path forward for restaurants as New York City resumes indoor dining. You're watching Closing Bell on CNBC. Dow's down about 53 points.
The countdown to the close of the US markets is sponsored by IG.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Russian Foreign Minister Sergei Lavrov says the country is ready to cut ties with the European Union amid a recent escalation in tensions. Lavrov said Russia does not want to isolate from global life, but is prepared for that possibility. That story is on the website now. The UK economy contracted by 9.9% in 2020, its biggest drop on record, as the pandemic wreaked havoc and forced several sectors to effectively shut down. The UK economy is set to continue shrinking in the first quarter of 2021 due to ongoing restrictions. Head online for the full story. Disney beat subscription expectations in the first quarter, reporting 95 million paid subscribers to its Disney Plus streaming platform. The media giant also reported a profit rather than the loss analysts had expected.
Brands out with its Q4 earnings this week. The company reported a mixed number with a beat on revenue but a miss on earnings. It also saw comparable restaurant sales fall more than expected. Joining us now for a CNBC exclusive interview, Restaurant Brand CEO Jose Sil. Jose, great to see you again. Thank you for joining us. Looks like the same-store sales were declining across Burger King, Tim Hortons, Popeyes. What was the problem? Is it that people are eating breakfast at home?
Hey, Sarah, it's great to see you. Thanks for having me. Actually, we were pretty encouraged with the performance with some of our business in the fourth quarter. Sequentially, we saw improvements with each of our brands. Popeyes, in particular, was comping over the launch of the chicken sandwich in Q4 of 2019, where we posted a plus 38% same-store sales lift, and we had a great year throughout 2020 with the performance of the chicken sandwich and some of our other great tasting products at Popeyes. At Tim Hortons, we saw really good progress in Q4, and in particular, we had our best performance of the year in December. We saw our drive-through business perform much better, and so we were encouraged by the progress we made on some of the key initiatives at Tim Hortons as well. And at Burger King, we were negative for the quarter, but we saw some improvements towards the end of the quarter. We made some investments in long-term value proposition, which we think is really critical to the business, and also in quality of our products with the Real Whopper 100 launch, which is a Whopper free of many artificial ingredients or flavors, which is a big step forward for our customers.
But a number of banks did cut the price target for your stock, and the stock was lower. And one of the concerns was that it appears, especially Burger King, is underperforming some of the global fast food peers. Why is that?
Yeah, we had a couple of quarters at Burger King where we think we have an opportunity to invest long-term in some key initiatives and key platforms. I think we've been a bit spotty in terms of our promotional activity. We wanted to build some platforms that are going to be there for the long term for the benefit of our customers. Value, an everyday value proposition with the dollar menu is one key step in that direction. In addition to that, we made investments in our core products like the Whopper, as I mentioned earlier. We're looking at a chicken sandwich. We've started the process of testing that in various markets around the country, and we're really excited about the quality of that product and the impact that it can have in the business long term. We're also investing in breakfast, and digital has been a big part of our business. It doubled digital business doubled in 2020 at Burger King, and we're now testing and beginning the process of rolling out a loyalty program, which we think will be a best-in-class program. Will have an impact in the drive-through, which is one of those areas or service modes that's critical from a loyalty standpoint. And we're really excited about the long-term prospects and have a lot of work to do with our franchise partners to keep building and growing the business long-term.
Jose, I also, I believe I'm right in saying you have tested accepting Bitcoin and other cryptocurrencies in a few Burger King stores around the world. Can you update us on that? Is there a plan to roll that out more broadly, including in the U.S.?
We had some news that came out on that a couple of years ago out of our Russia business, but we don't have any plans in the immediate term to go down the path of Bitcoin or any other currency. But we're always open to explore those alternatives, and we'll continue to look at those.
What's your expectation for getting back to comparable sales growth as economies do reopen? New York, for instance, starts 25% indoor dining, a place that a lot of the rest of the country's been for a while. What do you expect to see in terms of traffic and trends?
Well, we've been investing quite a bit in 2020, even in the face of the pandemic, the challenges that everyone's been dealing with. We invested and doubled down in technology. We were doing that already prior to the pandemic, and obviously saw the acceleration of the digital business in 2020. We've ramped up our expenses on the G&A front to hire better and more engineers to help us on that front. We're really viewing this as a key part of our growth long term for all three brands, in Canada with Tim's, in the U.S. with Popeyes and Burger King, and across the globe. We crossed $6 billion in digital sales in 2020 and more than doubled our digital business in our home markets. In addition to that, we're investing in quality of our food, continuing to make investments on the beverage side with Tim's, on the food quality side at Burger King and Popeyes. And we think that's a massive opportunity. We've made big progress in 2020 and are accelerating in 2021 on the digital menu board front, outdoor digital menu boards. The drive-through experience is so important for our business, and really investing in that and making it a modern and incredibly efficient experience is critical for our business. And then finally, we're investing in sustainability. We're investing in initiatives that we think long-term customers and our guests really expect from us to be on the forefront of these initiatives, which are the things that are going to help us distinguish our brands, our great brands, from others in the same space. So we're excited about the long-term plans. The investments we made on food quality are beginning to pay dividends in Tim's in Canada, at Popeyes, and at Burger King, and we're expecting long-term growth. And I think the final piece is we're excited about the growth prospects. Net restaurant growth is important for our business. Our franchisees are excited about that, and we have really optimistic views about the long-term growth of our brands in the U.S., in Canada, and across the globe.
Jose, I wanted to ask about food price inflation. I presume you welcome a little bit of food price inflation. Is that right? But at the same time, you're a little concerned it's going a bit faster than you would like to see.
Yeah, but pricing and inflation in commodities and in our business has always been part of it. We're watching it closely. We're monitoring it closely. We want to be able to focus on bringing in more guests into our restaurants. We think traffic ultimately is the healthiest measure of performance in our business, and we continue to focus on driving more people into our restaurants through our technology, through our drive-thrus, through our great tasting products that are part of our core menus, and continuing to innovate on all fronts to bring more guests into the restaurants.
Finally, Jose, just wanted to ask you about the minimum wage. President Biden wants to increase it to $15 per hour. I assume you've studied what that would mean. Would you be having to cut stores and employees if that were to come into federal law?
Sarah, we've been dealing with wage inflation for quite some time, and almost half the states in the country today in the U.S. Have some sort of inflation or wage increase planned over the coming years. And so our franchisees and our partners around the country, in Canada as well, they've been managing and working through the challenges of inflation on the wage front. Ultimately, our focus is on delivering great experiences to our guests through great teams in the restaurants. The top line needs to grow and be accelerating, kind of grow at a pace faster than wage and commodity inflation. We have a lot of initiatives in the drive-through, through digital as well, to help with productivity and throughput. And we're confident that working together with our franchise owners and delivering great experiences, we're going to be able to continue to grow profitably for all three brands in our home markets and across the globe.
Jose, thanks so much for joining us. Much appreciated.
Thank you. Have a great day.
Up next is Wall Street warming up to Bitcoin. We've got some new reporting on how America's banking giants are thinking about crypto in light of the furious rally in corporate adoption. As we had to break, check out the top searched tickers on CNBC.com. Disney tops the list today. No GameStop for once, despite GameStop gaining today about, a third of 1% slipped. It was higher earlier. Tilray, Sundial, a couple of the marijuana stocks there. We're back in a couple minutes.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
How inclusive is advertising?
If you're leaving out so many marginalized groups, the message that we're sending them is that they're not important.
Our industry reflects society. There's a culture. The UK does have systemic racism. Our industry has systemic racism.
Why it's important for business?
Not only is it a good thing to do in terms of being a member of society, but it's good for the bottom line.
We begin a two-part special exploring diversity and inclusion on the next Marketing Media Money.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Wall Street banks could be getting closer to adopting Bitcoin. Sources telling CNBC this is thanks to some internal pressure at big lenders. CNBC.com's Hugh Sum broke that story. He joins us now. Hugh, great to see you. Great story and great stuff on JP Morgan this week more broadly. My top question on this is JP Morgan considering getting into Bitcoin in order to be able to trade it and hold it for their asset management clients, or as a genuine means of exchange and payment across the whole entire bank?
Yeah, Will, how are you, by the way? Thanks. So specifically, we're looking at JP Morgan, and when I talk to, JP Morgan co-president Daniel Pinto, it's in the context of trading. So it's in the context of, you've got asset management clients, you've got hedge funds, institutional investors, maybe pensions, who want to own this and who want to purchase it. And so they're going to match buyers and sellers potentially sometime down the road. Now, the trigger for that, according to Daniel, in a conversation with me, was that they need a critical mass of demand from these institutional buyers. And as you guys know, we've had huge hedge funds come on air and talk about their case for Bitcoin, and you've just had a lot of capitulation in the industry in terms of people saying, okay, I get it now. I'm interested in this as a hedge against inflation, a hedge against dollar debasement. And there's increasing queries, not just from employees, but also from clients.
Wasn't Jamie Dimon one of the biggest vocal critics, I think a lot up there with Warren Buffett, of Bitcoin, calling it a hoax or a fraud? So does this suggest that they've changed their tune completely?
So he's called it a fraud that will blow up and not end well. Warren Buffett, as you mentioned, I think rat poison squared. So this is in the 2017 timeframe, and you got to remember, 3 years in the context of crypto is, a decade in the regular world. And he's first of all said that he regretted saying that, so we'll get that on the record. But specifically, look, I'll give you an example. JP Morgan has a mobile-only bank in the UK. Why are they doing that? Right? So they're experimenting. They know they cannot afford to be closed-minded about innovation. They can't be closed-minded about these new technologies. And if clients like it, they're going to say, look, it's not up to us to decide whether or not this is good or bad for JP Morgan. If our clients want us to be in this, then we will have to join them on this journey. And that's essentially what Pinto has told me.
Hugh, great stuff. Thanks so much for joining us. And don't forget to read Hugh's full story, CNBC.com. Still ahead, we'll talk more about Bitcoin's path to the mainstream when we're joined by the Chief Strategy Officer from CoinShares. Plus, Nuveen out with a new note on ways to play the economic recovery, including some under-the-radar cloud plays. And they're not Microsoft or Salesforce. We'll discuss with Nuveen's Sarah Malik in just a bit. Plus, let's check in on bonds again as we head to break, touching year-to-date highs just moments earlier, crossing 1.2% on the 10-year, crossing 2% on the 30-year.
Tomorrow is just waiting to be created, to be reinvented and redefined. And it's those who dare to push the world forward, discover and reshape markets, and embrace the possibilities of data that will reimagine our potential and transform society as we know it. With new ideas and new technology, get there with NASDAQ.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12 months.
The target is to vaccinate 80% of our population to achieve the herd immunity. So by the end of this year, 40 or 50% will be covered by the vaccine.
Why only 55%? Because that doesn't sound like herd immunity.
We have around 40 million who are below 18. Medical authorities do not recommend them to be vaccinated.
We hope to get most of our people vaccinated by the third or the fourth quarter of this year. If we get the vaccines faster, we'll be able to roll out the program faster.
The vaccine, I think, is a turning point, but don't underestimate testing. I think if we can get testing to 45 seconds, 30 seconds, that will also be a groundbreaker.
Now down 33 points. Time now for your daily coronavirus tracker. According to the CDC, the U.S. has now administered a total of 46 million doses of vaccine, with 11 million people receiving both doses. The pace of new cases is trending lower, with the total now standing at 27 million. Meantime, AstraZeneca says it is fixing manufacturing problems with its vaccine and expects to double monthly production to 200 million doses by April. And Japan's first batch of vaccines have arrived. The country expects to start giving the Pfizer shots in the middle of next week. Well,
time for a CNBC News update with Courtney Reagan. Hey, Court.
Hi, well, here's what's happening at this hour. Highway workers finishing the cleanup of the massive pileup in Fort Worth, Texas, blamed for at least 6 deaths. Over 130 vehicles were involved in accidents. Only 5 of the dead have been publicly identified. The head of the World Health Organization says a preliminary report on the origins of the coronavirus is expected next week. He says more analysis is needed before a final report can be issued in the coming weeks. Defense lawyer for former President Trump trying to turn the tables in the impeachment trial. They showed video of Democrats using the word fight in an attempt to convince senators that Trump's statements ahead of the Capitol Hill riot were no more incendiary than comments by top Democrats. Watch the news with Shepard Smith tonight for more analysis of today's proceedings and what's next in the trial. That's our CNBC News update for this hour. Back over to you, Wilf and Sarah.
Thank you, Courtney. 27 minutes left of trading. Shares of Newell Brands sharply lower despite posting an earnings beat this morning. Up next, we'll talk to the company's CEO about what's driving the move and which products in that portfolio are pandemic winners and losers. Plus, check out shares of QuantumScape and Fisker soaring today. We're going to break down the call that is charging up those EV stocks later on Closing Bell.
To build a power plant is to light up a civilization. To purify a waterhead is to last a hope. To build a trackway is to facilitate connectivity. To develop an algorithm is to offer one more possibility to the world. Shanghai Electric. Beyond Shanghai. Beyond electric.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Most countries will experience recessionary-like conditions. Is it necessary for another 1.9 trillion to be directed at the economy?
We do need some more fiscal stimulus to continue to bridge the gap, to continue to allow us to move through this tunnel and get to the other side.
It is still about crossing that bridge to the recovery, but where the journey seems to be a little bit delayed, but should not be derailed.
We want to accelerate on the vaccine because we are fully aware that there is a direct link between vaccine and economic recovery.
We're starting to see some cracks here, and the EU is just the latest example.
People are focused on right now, when are we going to get our vaccines? This next generation, which we are seeing, and I think those will be flowing quickly around the world.
The challenge will be not a global distribution. The challenge always is finally the last mile.
A courageous visionary facing tremendous odds.
I've always taught him to aim for better.
An entrepreneur with a sharp sense for business.
You just need drive and determination.
Now with a company worth over $6 billion.
We will do massive amount of business on a global scale.
Daymond John is taking the world by storm and doing it in style.
If I can do it, anybody in the world can do it.
The brave ones, Daymond John. CNBC.
Newell Brands, maker of household names including Papermate, Coleman's, Crock-Pot, and many more, recently announced earnings that beat expectations. The company saw strength in its food and commercial units, but weakness in writing as offices remain closed and Americans continue to work from home. Shares are falling today. Joining us now for an exclusive interview, Ravi Saligram, Newell Brands CEO. Welcome, Ravi. It's good to have you on the show. Just talk us through the portfolio. It felt very COVID related. What seems to be working right now for consumers and what doesn't?
Sarah, thank you for having me on the show. Yes, indeed, it was a great second half this year and a great quarter. With our sales up in the second half 6%, in the quarter 4.9%. A lot of this was we had tremendous growth in our food business. The food business was up 25% in calendar 2020. Brands like Rubbermaid, Sistema, Food Saver, Ball Jars, and a lot of this is with COVID, with the stay at home. You've gone from people who were started as hygiene related, but now have become home chefs. They're using our brands. We sold some 600,000 Food Savers. So it's just been terrific. Our commercial business, with the focus on sanitation, on washroom, sanitizers, we launched Rubbermaid stands, contactless stands, and washroom. We put 3.5 million dispensers out there that can create about 30 billion hand washes. So those two businesses have been great. The appliance business, small appliances, has been great too in the kitchen. So those were the drivers. We've leveraged the consumer trends, and our brands have been gaining market share. So we're quite pleased, and the team's done a great job.
Why hasn't the outdoor section of the portfolio done better? I'm surprised with people having to spend so much more time outdoors right now.
Yeah, that's a great question. Coleman, which is our flagship brand, actually has had a terrific year. After many years of lackluster sales, this year Coleman has really grown, both in the U.S. and internationally. It's also gained share. It's its 120th anniversary. We put out really great innovation on dome tents, refreshed our cooler business, so it's not only grown sales, but also gained share. So the Coleman part has been great, the outdoor equipment. We've had challenges in our the same business. We have brands called Contigo, which is beverage containers, which are on the go, and people are not on the go as much. And then Technical Apparel, which is our Marmot business. That struggled because the whole apparel business has been struggling. But our core business, with the predominant brand of Coleman, has been doing very well. And we've just run a campaign called Call of the Outdoors, and very positive. The other thing, Sarah, is that 8 million new campers have come in this year. Because of COVID, you had more interest, and Coleman's benefited from that as a brand that is highly trusted.
Ravi, one of the things we were talking about earlier when we were prepping was your candles business, which on one level seems to be suffering quite a lot from the past year. Why have people ceased buying candles during a pandemic?
Wilfred, actually, our candle business, our only issue was the second quarter, where there was a total lockdown in Massachusetts, where our factory is. And so other than that, so it was, and that's the quarter we actually produce to build up inventory for like the fourth quarter. But candles has actually done very well. We've gained share. We're getting distribution a lot of places. Consumption of candles is up quite a bit. We've been getting growth now, and in January, we're seeing tremendous improvements. So because people want serenity, they're lighting up candles. We've got different innovations coming out, both outdoor candles, indoor ones, diffusers, auto. But the auto is obviously soft because people are not driving as much. But the core candle business with Yankee Candle and our other brands are really doing well.
I feel like your sales haven't done quite as well, Ravi, as some of the other consumer staples during the pandemic, because Newell seems to have a little bit more of a consumer discretionary tilt toward the portfolio. And I just wonder what that means for the second half and into next year, if we get, say, a plus 5% GDP print, as a lot of the banks are expecting, what does that do for your business?
Yeah, so I think the way to think about it is, look, many of our categories and brands, we actually grew market share. And so that's a big positive. But when you have a durable, it's not like laundry detergent or dishwashing liquid where there is every week repeat, right? So if you have a food saver machine, which is like $100, people are not going to go buy it at that frequency, though we've been just amazed. With the amount of food saver we sold, there's also a consumable, which is bags. And so we expect a lot of repeat purchase on bags next year in 2021. So the one business that is more like a consumable is our writing business. And that has actually, because of the pandemic, because people have been working from home, schools have been closed. So that has had an unfavorable impact. And that's one of our biggest businesses. But what we're seeing is, starting in September, our consumption actually started increasing on our writing business. And it's continued now in January, which is a positive sign. Importantly, we launched a terrific innovation, this pen, Sharpie S Gel. Sharpie was always in markers, but we launched pens, and it has just been an amazing hit. Just in fourth quarter, Sharpie S Gel, the Sharpie pens, we just doubled our share in the gel pen market. The total writing business market share went up about 150 bips in fourth quarter, and for the year, it's grown a little. So we've made some remarkable progress in pens, and that has been a great area of opportunity, and that's more consumable type. So we think that as schools reopen next year, this summer, we think it'll be more normal back to school year. So I think that is going to be quite good. So I think we're kind of a hybrid in terms of some parts of the portfolio which are durables, some which are more consumer consumables. And the important thing, though, is where we're in many of our categories, which was not true for Newell because we're in a turnaround now, but we're actually gaining market share. And that, to me, is a very positive. Look, in the food business, every one of our brands, Rubbermaid, Sistema, Ball, they all, Food Saver, they all gain share. And we've also been launching a lot of innovations, which is very exciting for 2021. And we expect, we guided today that we'll have low single-digit growth. And definitely the first half, which we have more visibility to, we think we'll have a strong first half. We gave good, strong guidance for growth in the first quarter.
Ravi, thanks so much for joining us. Much appreciated. Thank
you so much.
Straight ahead, NVIDIA slips and EV stocks soar. We'll break down the biggest movers when we take you inside the market zone next. The S&P's up 0.3%.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
This story went from a dilapidated, rundown duplex all the way to the White House.
Mr. Haley was surprised at how easy it was to make an extraordinary amount of money by doing essentially nothing.
How far would you go? You can say
in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day as always. And today we've got Jim LeCamp back from Morgan Stanley Wealth Management. Welcome, Jim. We'll kick it off with the broader market. Major averages are on track for weekly gains. Any close higher for the S&P and the NASDAQ will be record closes. Looks like we are there right now for the S&P. The Dow's under a little pressure, although it's coming back. It's been in a pretty tight range today, Mike. What are the threads? Lack of catalyst, it seems like, has meant the market just continues higher on hope of stimulus and vaccines.
Right. I mean, it's gone sideways, roughly speaking, for 3 or 4 days, just up less than 1% from Monday's close. But still, you would say that there's really no selling pressure. There's nobody that seems to be out there actively rethinking the basic premise for why the market got here. Now, clearly somebody will. Clearly someday we can get an overshoot and it can maybe not absorb some kind of a surprise headline. But right now, I think it's COVID cases are really on the decline rapidly. You obviously see what's going on in the bond market. Treasury yields making 11-month highs. So everything is kind of rounding into place for this idea that we have this, reopening momentum. And whether we just price every market for it from the moment, at the moment it happens or not, that's been the trend and it's holding so far.
Jim, what level of yields is too high too quickly?
Well, you bring up a very good point, Wilfred, because I think the possibility of rates that rise too fast, if inflation runs too hot, and rising oil prices, that combination is usually not good for the stock market. Overshoots on interest rates and overshoots on oil prices. And in answer to your question, where does it become an issue for a market? I think we probably start talking about it at 1.25% on the 10-year Treasury, and then we start really talking about it and maybe fretting about it at 1.5%. Now, before we get to that point, though, the underlying conditions, which is what you always want to look at first as an investor, are good. I mean, when you have stocks trending higher and they're being confirmed by a rise in interest rates and confirmed by rising commodity prices, particularly economically sensitive commodity prices like base metals, copper, et cetera, all these markets are confirming to each other, and we're not having a lot of internal divergences to worry about. So these, I think you point to something that we will need to worry about. We can talk about valuations if you want to, but if we get that combination of rising rates and rising oil prices that overshoot a little bit, and we could, because some of the inflationary pressures are going to be real. Rent prices are going up, even used car prices. A lot of the measures of inflation, the inputs that we see on the CPI are starting to flare up. So it is definitely something to watch, but right now I think we're fine.
As you can see, oil really ramping as yields have risen late in the session. Oil's up 2.3% now. Energy, the best performing sector so far Today, investors piled into the stock market this week at record levels. Bank of America saw more than $58 billion of equity inflows, their largest ever in 1 week, according to the firm. And a new report finds that stocks are trading hands at an increasingly rapid pace, volume approaching levels not seen since the pandemic-induced sell-off in March. While these bursts of trading activity generally come along with higher volatility, that's not the case now, as the major averages are trading around all-time highs. Mike, clearly, particularly the inflows was a stark bit of data that was written up quite widely today. The VIX has fallen, but it still hasn't broken that 20 level, but it's much closer than it has been for a while.
Yeah, well, there's some suspense there. We'll see how it closes today. It hasn't been under there since March of last year. But I think what all these things tell you is there's a new buying urgency in this market. It probably is, it's generating a lot of calls, and it's a little bit too speculative, whether it's the huge volumes in stock options, the fact that we are seeing rising share volumes into a rising market. That is totally against the trend that's been in place for many years. And it does show you definitely, heavy animal spirits flowing through this market. So at some point, it feeds into the case that people are a little bit overconfident about the upside. But on the other hand, it does also provide a bid. The demand for stocks right now is totally outstripping supply, even though supply is rising as well.
And Jim, I guess the question is, how sustainable is it?
Well, I think it's sustainable. Anytime you have, you're coming out of a recession and you have an economic recovery, usually your new bull markets are multi-year bull markets. But in the very short term, Sarah, we have some issues where if we look at that 50-day moving average and how many standard deviations we are away from that, we're overbought in almost every sector and in almost every category. And sentiment has really gotten a little too high. So we'll probably get to a point, it may just be consolidation, maybe a small pullback. But to Michael's point, every time they try to sell this market off, and they tried to a couple of weeks ago, even this week a couple of times we had lower opens, the market's closed pretty strong. And a lot of that is we have new entrants into the stock market. This seems and feels a lot like the late 90s, which may sound off a lot of warning bells, but there was a very heavy appetite for stocks. And because of what happened afterwards, 2000 to 2003, and what happened in 2008, we really haven't seen this kind of enthusiasm for stocks since the late 90s. So it's healthy. I think it's probably multi-year, but in the very short term, we're probably a little stretched. Valuation's a little high. We might need a pause that refreshes, and I would caution about chasing things.
NVIDIA receiving new pushback over its plan to buy ARM Holdings. Josh Lipton with the story. Josh.
So that's right, Sarah. Big tech is pushing back here. Alphabet's Google, Microsoft, and Qualcomm have now asked antitrust officials to intervene here. That's according to Bloomberg, which says the companies are worried that they won't have equal access to ARM's technology, which, remember, is everywhere, underpinning all sorts of products and devices, from smartphones to tablets to PCs. NVIDIA countering, telling CNBC, we're confident that both regulators and customers will see the benefits of our plan to continue ARM's open licensing model and ensure a transparent, collaborative relationship with ARM's licensees. But Susquehanna's Chris Rowland says this news presents a challenge. He now puts the odds of this deal actually getting done at less than 50-50. Having said that, he is an NVIDIA bull. ARM is nice, but not necessary, he argues. NVIDIA remains one of the best bets for investors on AI and gaming, he says. Back to you all.
Josh Lipton. Josh, thank you. Mike, this was always going to be a question for the NVIDIA ARM deal, regulatory approval in the U.S. and in the UK and in China. Does it change anything to hear that Google, Microsoft, and Qualcomm are protesting it?
I mean, it certainly could prolong the process. Maybe it creates new hurdles for when this deal gets completed or under what terms. So I don't think the market is panicking and saying it's deal off. Of course, market loved the idea of the transaction when it happened. For NVIDIA, the stock was at a high. It's backed off 2%. Probably makes sense for the added uncertainty. It's not really a matter of betting the company, right? It's a little more than 10% of NVIDIA's market cap is reflected in the value of the ARM deal. So maybe it's going to be about exactly how they treat the intellectual property and licensing and all the rest of it, which these competitors are concerned with when it comes to ARM's, IP.
Jim, what do you make more broadly of this sector, the chip strength?
I think it's one of the really best things for you to watch. First of all, there's a shortage of semiconductors, particularly certain kind semiconductor manufacturing. But semiconductors have led this market, and they have not broken down. It's one of the best indicators that you can watch. You've got earnings there. And a lot of people have been, over the last several years, have said, yeah, too techy, this market is too techy, too tech heavy. But the reality is semiconductors are a great leading indicator not only for the economy, but for the stock market as well. As long as the stocks is hitting new highs, I think we can feel pretty good about the overall market. And look, we've had the banks, we've had the value stocks, we've had energy stocks, we've had a lot of rotation in this market, but through all of that rotation, and while we've seen some big cap names like the banks type stocks start to trade sideways, the semiconductor group has continued to set new high ground, and it speaks well for technology, it speaks well for the sector, it speaks well for the market as well.
Morgan Stanley out with a new note on electric vehicles. Let's get to Phil LeBeau for more. Hey, Phil.
Hey, Wilf, when Adam Jonas at Morgan Stanley talks, people listen, and they're listening today. Four calls here today. Let's do with the two that went higher, and that's QuantumScape and Fisker. Adam Jonas out with his initiation of coverage on both of these. He said, you know what? Overweight them, and the stocks are up more than 20% each. With QuantumScape, he's bullish on the fact that they have great battery technology, or the potential for great battery technology, and a relationship with Volkswagen that could pay off. Remember, QuantumScape reports its Q4 results on Tuesday, and then with Fisker, Adam Jonas says the asset-light approach, that's pretty attractive. Remember, they're partnering with Magna to build their first vehicle and likely more of their vehicles. So as you take a look at shares of Fisker, you see that Fisker also moving higher. None of these stocks, by the way, are anywhere close to where they were after they had their SPAC IPOs in the fourth quarter. And then on the downside, take a look at Lordstown Motors and Romeo Power. Both of those are rated underweight by Adam Jonas. He basically says, look, there's some issues there that people need to take a look at. Once again, when he speaks, people listen, especially when it comes to electric vehicles. Guys, back to you.
Phil LeBeau, thanks so much for that. Mike, take us into the internals with a brief mention of EVs and Tesla this week as you do so.
Well, interesting. Tesla's actually just gotten a bid. We got this big market on close order for a lot of the big, NASDAQ names. That's taking a positive for the day, down 4%. I think one thing's going on with Tesla is there are other options right now. It doesn't have a monopoly on the only way to play EVs. It's even being reflected in GM and Ford as well. So got to watch those relationships. Meanwhile, Tesla's up huge since November, so watch it all. The internals actually are basically mixed. We did get this little spurt higher in the market. It did turn breadth positive, 1,700 versus about 1,500 declines. So that's certainly a net positive. Taking a look elsewhere within some of the sector work that we were, I forgot what I even asked for here, guys. Let me see the next chart. It's crude oil. It's up big, another reflation trade. And all was today. We had an inventory draw. This is now at well more than a one-year high, pushing $60 a barrel. A volatility index mentioned earlier, skirting that 20 line. Nothing magic about it, except there is a sense out there. We haven't closed under here since March of last year. Actually haven't traded under there. And there's a sense out there that some systematic quant strategies will basically increase their equity exposure as volatility recedes below this 20 mark. So it's sort of another thing that ratifies the market at a high, Sarah.
Crude oil, definitely worth paying attention to, Mike, as well as some of these other commodities which have been surging. Copper is near the highest level since October 2012. Lumber is trading at an all-time high. With less than 1 minute left to go before the close, the Dow has turned higher on the session, just barely. The S&P 500 also higher. We are looking at a record close for the S&P and for the NASDAQ. And there is the Dow, and just in the final moments, got a little lift. What's driving it? Intel's the best performer. JP Morgan and Goldman Sachs are doing well. Disney, the worst performer, despite better numbers on the streaming Disney Plus. There goes the bell. All four major averages closing the session higher on a Friday and for the week. NASDAQ and S&P 500 closing out with a record high, each gaining about 0.5% apiece. Wilfred.
Record high there for the S&P 500. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen and Mike Santoli, CNBC senior markets commentator. Let's check in on where we finished. As Sarah said, back into the green for all of the major averages. The Dow had been down 83 at the low, but gaining very nicely, as you can see in that last hour or so of trade. Positive territory by the close, up 30 points, only 10 basis points, but up 1% for the week as a whole. S&P up 0.5%, 1.24% for the week as a whole. NASDAQ up 0.5%, 1.7% for the week as a whole. The Russell has been more volatile, but also closing with the week's biggest gains, 2.5%. Energy, the big outperformer today, up 1.4%. Materials, the other sector, up more than 1%. Utilities and real estate the bottom two performing sectors. Oil really surged, as Mike said, into the close, up 2.5%. Coming up, a CNBC exclusive with the CEO of GoDaddy. We'll break down the company's earnings report and how the work from home trend could impact his business. Jim LeCamp, Senior Vice President at Morgan Stanley, still with us, and Sarah Malik, Chief Investment Officer for Nuveen's $350 billion global equity division, joins the conversation. Very good afternoon to you, Sarah. Mike, I'll start with you. Broad markets, nice little ramp into the close, ahead, of course, of a long weekend, and the VIX did it at the close, just below 20. Positive end to the week, no doubt about it.
No doubt, a positive end to the week, and the fact that the market, after a 6-day win streak, went sideways for basically 2 or 3 days and most of a fourth, showed you that there wasn't really that much pent-up selling pressure out there. It's really the same story. It's basically, very loose financial conditions, credit market very, very strong. Everybody sees the trajectory of growth, steepening yield curve. So all the things you would look for to say, what's the message the market is trying to send? It's a positive one. And honestly, the same thing we keep saying, which is the only problem is once everybody believes it and bets too hard in that direction, that's the time that probably this rally is going to have to take a break, whether it's because over-aggressive flows or because, some of that speculative stuff creates a little bit of instability around the edges of the market, as we saw with the GameStop episode.
The crude oil climb, Sarah, do you see that as a cyclical explanation because the economy is looking up and we're going to get all this stimulus and that's why energy stocks continue to soar here to the top of the market?
It's a combination of better supply-demand dynamics as we reopen the economy and these companies are becoming much more disciplined with supply. But it's also a story of better capital controls and cash generation by some of the winners in the energy sector and these companies that can provide a bridge to renewable fuels. So there's going to be clear winners and losers in the energy sector like Pioneer and EQT, which are strong in the Permian Basin and also strong in bridge technologies to renewable fuels.
Jim, what energy names do you hold, if any?
Well, I like energy quite a bit, and while I agree with what Sarah had to say, she left out, I think, a fairly important point, and that is what they're trying to do with crude on federal lands. And ultimately, that could disrupt supply, or at least the amount that we produce here in the United States. Who does that hurt? Probably hurts refiners, probably hurts the service companies. Who does it help? Domestic E&P companies that are particularly confined to private lands and don't have a lot of exposure to the public land. So I like many of those companies as well as the majors. The majors are going to do very well. They have nice dividends. And when you look at a price-to-book basis on energy stocks, and you look at the dividend yield on energy stocks, you've got a really compelling story in a market where a lot of areas have really moved over the last several years without energy. So you have this rotation story going on with energy, too. So it's kind of got everything. Economic recovery, some supply constraints. And the other thing that's happening with the market, and particularly some of these areas that get hot when people are trading them, is this is a market that a lot of people are using leverage on. And I expect leverage will be used in this industry, whether it's share buybacks or leveraged buyouts. So a lot of good things going on in the energy space, particularly for domestic E&P companies.
But it doesn't have the ESG factor, which is so much in demand by funds and investors everywhere right now. And last year, when oil prices were falling, that was just added to one of the concerns for why people were taking capital out of these companies. So has there been a pivot there, or is it just not as important as we thought, Jim?
It's kind of like what happens when we have one of these mass shootings and everybody's worried that all of a sudden they're going to outlaw guns, and then you start to look at the stocks of these gun makers and they're just going through the roof. So when you limit supply of something that's still going to be in very high demand, it doesn't really matter whether it's ESG or not. Now, when you look at the majors, Sarah, you're also looking at a much broader story than fossil fuels. You're looking at chemical companies that they own, chemical businesses that they own. But the bottom line is we just can't get to wind and solar providing enough energy to where we don't need these fossil fuels anytime soon. And for that matter, you have to use them to build electric cars. You have to use them to power electric cars. So whether it's ESG or not, the story is going to be around for fossil fuels for quite some time.
Sarah, what do you make of the way in which we saw the VIX fall below 20 today just before the close? Is that bullish for equities, or do you in fact think it's just temporary and we're going to see elevated volatility for the year ahead?
I think there could be elevated volatility as the year goes on, as we become increasingly concerned about inflation and is stimulus going to be enough or too much. But for now, it's earnings that are driving these markets higher. I don't think earnings growth is completely priced into the markets. You're seeing that with these strong double-digit earnings beats across the board. The issue, though, is that earnings growth is a bit back-end loaded this year as that vaccine rolls out, the stimulus comes into play. So I think more volatility as the year goes on, but what the market's telling you right now is that the news is good and a lot of the overhangs are behind us. And that gives us more upside driven by earnings rather than valuations.
We wanted to zero in on cloud stocks. They've been outperforming the broader market this year. Sarah, you like this sector. What are your top picks?
Top picks are looking at today. So digital is going to become much more important as we exit the pandemic. And there's going to be three key factors that the winners have. One is a competitive advantage due to computational scale. Second is broad base of applications. This is not just about streaming. It goes to energy exploration. It goes to smart meters with utilities. And finally, strong backlogs. We saw that today with HubSpot. Ends the day up 15% with over 40% customer count growth. Just 2 weeks ago, this stock was at 350. Today, it's at 500. There's an opportunity during volatility as some of these hedge funds were bailing out of quality companies to meet margin requirements. Other companies we like that weren't as strong today, ServiceNow, Anaplan, which is good, strong in planning and forecasting. These are all the structural winners as we exit the pandemic in a crowded cloud sector.
Mike, I just want to circle back to one of the points we've just sort of touched on a few times today, but not discussed in detail with you. What do you make of this inflows into equities data? Is that a bearish sign, or is it bullish in the short term at least?
The answer is yes, because it's bullish in terms of showing that there is broad public sponsorship for the equity market, that there is demand out there, that essentially people are buying high and looking to sell higher, or just essentially saying we need to have a greater allocation to play this multi-year, perhaps, growth cycle. But it definitely can get overdone in the short term. When you do see these real rushes of inflows in a short period of time, you definitely have to start to think, how does it build toward a contrarian case that maybe it's going to be a negative? So, you know, I would look in particular at some of the sectors where the flows are going. I know tech had a big haul recently in this past week or so. So that sometimes does show you the ebb and flow of sentiment a little bit too much, you know, of a good thing right now.
It is, Sarah, it can be a fine line between healthy participation that you'd like to see in the early part of a cycle in a bull market and overheating and over-exuberance in this market. Where are we right now?
I think we're further from overheating than people may be concerned about. There is some risk of an inflationary overheating, a taper tantrum, similar to what we saw in 2018, where even rates started to increase. But that's probably more likely a 2022 to 2023 problem. The Fed has been messaging that they'll let the economy run kind of hot. So I think for now, what we're seeing with the VIX and strong earnings growth, that's going to be the key story that drives markets higher the rest of 2021, as long as these other things like stimulus and the vaccine stay in place and we don't get too much of risk from some of these new variants of COVID-19, which again could cause the economy to roll over again if we don't have vaccines in place to deal with that.
Jim and Sarah, we'll leave it there. Thank you both for joining us.
Thank you.
Straight ahead, Wall Street banks could be getting closer to adopting Bitcoin, but not every CEO is sold on that idea. We'll break down the future of digital banking with the Chief Strategy Officer from CoinShares. Closing bell back in 90 seconds.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
We're ushering in the year of the ox. After an unprecedented year of turmoil, we'll look at what's ahead.
The U.S. is in recovery. The rest of the world is starting to catch up.
As China marks a major milestone.
The CCP goes into its 100th anniversary feeling very confident.
And will travel finally get back to normal?
In a normal year, you will see hundreds of millions, maybe 200 million people out there on the move. But this year, probably only at 50%.
All that and more in our special Year of the Ox, Plowing On.
Corporate America may be getting closer to embracing Bitcoin. Sources tell CNBC that the big banks have been feeling internal pressure to adopt the cryptocurrency. This comes after Tesla, MasterCard and BNY Mellon all announced various programs involving Bitcoin this week. Not all CEOs, though, are ready to accept Bitcoin with open arms. Here's Affirm's CEO, Max Levchin, on CNBC earlier today.
First of all, I think I'm a known crypto skeptic, so I'm always very careful. That said, it is incredible how Bitcoin and all the cryptocurrencies have grown. And I think at some point, skeptic or not, you have to listen to the markets. If you have an asset that's growing in value as fast as Bitcoin is, I'm not sure people actually want to spend it. But if it becomes a medium of exchange that folks want to actually use to buy their Pelotons and their sporting goods and their outdoor, we will have to consider it.
Joining us now, Meltem Demirors, Chief Strategy Officer at CoinShares. A very good afternoon to you. Thanks so much for joining us. Let's pick up, first of all, on the sort of final point there that Max was talking about. How far away are we from Bitcoin actually being used to make transactions for products, it becoming a genuine currency of exchange?
Great to be here. I can't believe it's the end of another week. I'm happy that markets close at 4. Crypto markets don't close. So sadly, I've got a whole weekend of this ahead. But look, I think Max Levchin's comments are spot on. Historically, a lot of the engagement around Bitcoin has been really more around the store of value narrative and people buying it as an investment asset as opposed to a functional medium of exchange. But that's starting to change and really rapidly. On a daily basis, there are over 1 million active Bitcoin wallets on the Bitcoin network. Now, a lot of them are transacting on trading platforms and other sorts of applications more related to financial use cases. But with the advent of the Lightning Network, which is a payment network built on top of Bitcoin, and with the advent of stable coins or dollar-pegged currencies that are built on top of public blockchain networks, we're seeing a lot of activity that is more transactional in nature, and it's changing really, really quickly.
When you see more corporate stories like we saw this week, MasterCard and BNY Mellon exploring ways to at least be able to process transactions, Tesla going further, actually buying Bitcoin, do you fear in any way that marks at least a short-term top in the price of Bitcoin?
No, I actually don't feel that way at all. As Elon Musk so famously said, in hindsight, it was inevitable. Look, at the end of the day, companies are in the business of making money. And I think, again, what Max Levchin said so well is if there's money to be made here, businesses have to pay attention. One really telling market event we'll have is Coinbase will IPO in the near future. It will be, when listed at its predicted $70 billion valuation, roughly the 7th largest bank in the United States by market capitalization, despite having a fraction of the assets under management of its peers in the traditional finance space. And there is a shift towards digital. Content is king, but distribution is queen, and she wears the pants. So it's all about distribution channels. And at the end of the day, the way that financial products are distributed is also changing really rapidly. Look at Robinhood, look at new fintech platforms, but also look at Amazon and Facebook and Google and Walmart getting into the game and distributing financial services. IKEA launching a credit card. I mean, it's not just limited to financial services. This is really about a fundamental shift in the way that products and services are being distributed. And Bitcoin and digital currencies, in my view, are a huge part of that story. And we're just now seeing the beginning of this story unfolding.
When it comes to companies, Meltem, I feel like we're talking about two different issues. There are those like Tesla that are actually converting cash into Bitcoin on the balance sheet, and then others, many others, accepting it as a service, which is a difference. I don't understand why a company would do the cash thing. I get the services. They want to participate in the growth and go where the consumer's going, and if there's interest, get in on it like PayPal. But why would they actually do that to their cash assets? I mean, wouldn't that be a huge risk?
So look, I was a corporate treasurer at ExxonMobil when it was still one of the largest companies in the world. And right now we're looking at 2.6% real inflation. Rates are at 0, and treasurers need effective portfolio diversifiers that are going to drive return. As they're looking at the universe of alternatives, there are a number of options out there, and Bitcoin is an attractive one. In addition, I think the question is, what will the multiple value accretion be for people who allocate their treasury assets to Bitcoin? In the case of MicroStrategy, that's a very extreme approach to allocating to Bitcoin, but the multiple is there, and that firm and its leadership has really benefited from that move. Same thing that we saw with Square. Tesla, the reaction was maybe not quite the same, but as we see more and more examples of different firms allocating their treasury assets to Bitcoin, the real question for me is, what does that mean? Does that have an impact on multiples that investors and allocators assign to these businesses? And if there's a positive effect there, I would expect that strategy would be replicated across the entire S&P 500.
What happens if the price goes down? I mean, we saw it climb to record heights back in 2017, and then it crashed. So what happens to all of this discussion and adoption and all the things that you're trying to encourage and really believe in if we see that kind of volatility again?
That's such a great question, and one that we deal with a lot. I've been in this business for 6 years. At CoinShares, we have $4 billion in assets under management, and the cyclical nature of Bitcoin has been part of the story for some time. I think part of the conversation is around the cyclical sort of volatility of Bitcoin, which tends to operate in cycles like we see in any other asset. But if we look at the secular trend around Bitcoin and the supply and demand fundamentals in an environment where fiat currencies are being debased due to excessive QE, I think the cyclical trend may be volatile in the short to medium term, but the secular trend, which is really what we're looking at here, bodes very well for Bitcoin and gold, by the way, and other assets that are inherently deflationary in nature.
Meltem, thank you for joining us. Good luck with that weekend work watching Bitcoin.
I mean, markets that operate
watching it these days.
I mean, markets that operate 24/7, 365 are a new frontier. But in the age of all things digital, we are all online all the time, and I expect capital markets will be no different very soon, which is sad for us.
Yeah. Well, there's Forex, but it does close Friday afternoon. Thank you, Meltem. Good to see you. Up next, nearing a top, Mike Santoli heads over to the telestrator with a deep dive on a potential sell signal for the market. Plus, shares of GoDaddy are sinking today on the back of earnings, but it did see record customer adds last year during the pandemic. We'll discuss it all with the company's CEO in just a bit. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. We'll be right back.
The countdown to the close of the U.S. markets is sponsored by IG.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure we will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure it will be able to understand and to heal the growing social malaise.
Helping you navigate the new normal. Squawk Box on CNBC.
As the pandemic has unfolded, we've just seen this extra rapid pace of adoption of certain technology. Everybody had to think about grocery delivery, video conferencing, and telemedicine. E-commerce and video meetings are now part of the fabric of culture around the world. That's not going to change. At CNBC, we really remain committed to watching the data and bringing our readers and viewers the information that's most essential.
Stocks finished the day at a record high, gaining more than 1% for the week. Let's go back to Mike Santoli, taking a look at a potential sell signal for the market. What is it, Mike?
Well, Sarah, potential is a key word here. This is Bank of America's Bull Bear Indicator. It's made up of a composite of market behavioral things, actual positioning, flows, credit spreads, things like that, not just what people say, whether they're bullish or bearish. So you see here, it's actually been well on the rise. It's just below, as of today, this threshold where the firm basically says it's time to be on a contrarian basis, looking to sell or reduce risk or expect some kind of correction. I think what's significant about it is many other indicators have been in this mode for a while, showing the market to be euphoric or overheated. This one was not. So the strategy group at B of A has been saying, not yet, not yet, not yet. So maybe it's still going to be not yet, but we're not far away from there. I would point out, 2018, January of 2018 was the last time you actually crossed above that. It did coincide with a short-term market peak. You were down, you had a correction. It did not end the bull market. And prior instances were somewhat similar, where you were coming off of these massive rallies, and it was just time to consolidate, break down a little bit. So it's really a matter of, let's look at whether risk is growing because people are already very aggressively positioned or not. And I think that's pretty much where we are across the board right now, guys.
Well, I think the other question, Mike, is what do you do if we are about to see a correction? Is it a buyable? Should you buy it for the long term? Or if you're a long-term investor, should you hold on? And it sounds like consensus, and I think Bank of America in this note agrees that it's a long-term bull story that you should buy.
Yes. Basically, where we are in terms of the economic cycle, where we are in terms of, what the credit markets are saying, where we are in terms of how the Fed is postured, all those things suggest that corrections are probably not the big one. They're not going to be the major top, not going to be. But remember, we had a flash bear market, less than a year ago. They tend not to sort of pile on themselves like this. But honestly, if we keep barreling higher in this same fashion, then it's just going to raise the risk, and it's going to make that eventual correction probably more severe and more damaging than if one were to happen sooner.
Mike, looking for factors that, might say this time's different, that chart can prolong the extreme bull thing for longer. I guess we've never had any comparable example where you have stimulus checks pouring into potentially the market, but either way into consumers' hands. I mean, we talk a lot about the looseness of monetary policy. That's been there for a while already. This next stimulus bill, could that extend the extreme bullishness?
Yeah, I think so. I mean, I think the fact that you've got, whatever the number is, if it's $6 trillion total in aggregate, in terms of a fiscal push by the time this is all done, you've never really seen that. You've never seen, a market go from, and an economy go from late cycle to early cycle to recovery to new highs this quickly. So I do think that you can argue that we have to sort of maybe adjust our scales of valuation and behavior to say that maybe this can carry on for longer. But the rules of kind of market physics don't change. Human behavior is what it is. People get carried away, and it becomes too easy for a while, and then all of a sudden it becomes hard.
Mike, thanks so much. Shares of GoDaddy slipping on the back of its quarterly report. We'll discuss what the company's forecasting for the year ahead and how the work-from-home trend could impact its business in a major way. The CEO joins us right after this break.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO. Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. it's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
On the next Managing Asia, we put the spotlight on sustainability.
By 2030, we want to all abolish petrol-based virgin PET bottles. That is a huge challenge.
I'm hopeful that we'll be able to cut the amount of plastic getting into the ocean in half over the next 10 years.
The interest that Claire and I have had when we were much younger has always been about trying to make a difference in the world.
Companies doing good on the next Managing Asia.
Announcing Q4 earnings yesterday, beating expectations. The company adding 1.4 million users in 2020, nearly double the number added in 2019, for a total of more than 20 million customers. Despite the ads, the stock did fall more than 7% today. Joining us now in an exclusive is GoDaddy CEO Aman Bhutani. Welcome back to the show, Aman. It's great to have you.
Great to be back, Sarah. Thank you.
It looked like a beat across all metrics this quarter and for guidance. Did you hear any concerns from investors? Why did the stock fall so sharply today?
Yeah, we're coming off a huge week, Sarah. We closed the Point acquisition this week, and that means new commerce capabilities for our customers. A huge earnings release, like you said, we beat on the financial metrics. Huge guide for us going forward, accelerating bookings growth over the last 3 quarters. We also announced a couple of retirements later this year, and perhaps there's just a bit of nervousness around that we're seeing. But, short term in the market, we never know why the stock's moving up or down. But over the medium and long term, we know we've got fundamentals. We're going to come back every quarter, just deliver results.
Yeah, it does raise questions whenever a CFO retires in a surprise way, and also the chief legal officer. Any reason why that's all happening simultaneously?
Yeah, Ray and Naima have been close confidants of mine since I joined the company. And Naima's been with the company 18 years. She just wants to move to the next phase of life and retire. And Ray's been a public company CFO for a long time, and he also just wants the next thing for himself. So they talk to me at a personal level, and they're committed to the company. They're committed to their roles. They'll be with us. They're going to help with the transition, help with selecting new people for their roles. We have fantastic internal candidates. We're a great company. We expect great candidates externally too. So just natural course of life.
Aman, clearly the domain growth is pretty impressive. I mean, what is that as simple as people and companies that don't have a website yet are having to do that for the first time?
Yeah, you see the growth in small businesses, right? Those people are coming online with stores closed because of COVID. These folks are very creative. They moved online quickly. And you see that growth in the primary and secondary market for us on domains. More people coming in, going online, doing more online. And that's one of the reasons domains grew really, really, really well for us.
I mean, I guess a lot of people would say you are the go-to or one of the go-to people if you need a domain and you want to start setting up a website. Are you yet, and when may you be, the go-to place for a full-service offering, particularly when it comes to e-commerce? I know you're adding those services and offer them, but the likes of Shopify have slightly moved ahead and grabbed a lot of share in the last few years.
Yeah, I love the fact that we are the entrant. We're used to in the domains business, even in the website business, being the big player. And here we are in commerce, the person that's disrupting. We're creating a seamless, intuitive experience that goes across all the commerce needs that our customers have. We've done surveys with our customers. We spend focus groups with them. Our customers want the products the way we offer them, and we always back them up with guidance and care from the human guidance and care that we provide. So, we work with the micro businesses, Wilfred. They need the tools, they need them to be simple, and they want human beings to help them. And we do all of that better than anybody else.
Which is why some might be surprised, Aman, that you were able to double the customers over the last year during a pandemic where all the talk has been pain for small businesses, pressure on small businesses. They're closing left and right. So talk about where the new growth is coming from.
So, Sarah, our customers are so resilient and creative. Our churn rates are super low. They still found room to improve in 2020. And where that comes from is that these micro businesses, if they see setbacks because of COVID, they have to wake up tomorrow morning and do something. They're creative. They find a different way to do it. They come to GoDaddy. We help them get online. It opens new doors for them. I can tell you so many stories of customers who've never been online before that went online with GoDaddy in the last year. And that's what you see in the extremely fast customer growth in 2020.
And how can you further monetize that growth? Are you adding more services, adding your overall revenue per user?
Yeah, our average revenue per user today is about $160, Wilfred, but over 20 million customers, right? But that same customer base, stays with us, if you do the math, at least for 7 years. And we're offering more and more for them. We started with domains years ago. Today we have websites. Over the last year, we've been talking about commerce. And GMV on our platforms is growing very, very quickly. Just last quarter, we showed the street that we had about $4.5 billion of GMV transacting on 2 of our main platforms. That 4.5 annualized number accelerated to 7 billion just quarter over quarter. So customers are finding success on our platforms, and that gives us so much opportunity to improve our ARPU over the next few years.
Aman, what are you seeing in terms of new business formations and new entrepreneurs? Because the small business closings do get a lot of attention and all the pain that's out there, but you've seen in a recession so many new businesses are born.
Yeah, a huge number of businesses are being born. We all have that data. But one of the things we looked at, Sarah, is that we compared the 2020 data to the 2007 data, which had similar impacts to small businesses where we had the recession, lots of businesses were hurting. And what we found is that a lot of businesses were formed in 2007 as well. And then we tracked the bookings from those businesses over the next 10 years. And that cohort was a fantastic cohort for us. And when we look at 2020, it's the best cohort we've ever gotten. Yes, there's pressure on small business. Yes, we want governments to do more. Yes, we want, all the stimulus or a ton of it to go to small businesses because they make a difference in their local communities. But the fact is these folks are resilient and they will come back and they will grow their businesses.
Aman, thanks so much for joining us.
Thank you for having me.
We have a news alert on Facebook. Julia Borston's got it for us. Julia.
Well, Facebook is reportedly working on a smartwatch that it hopes to start selling next year. This is according to the information which cites sources. Now, this watch reportedly would work with a cellular connection. It could connect with fitness apps such as Peloton's, and it would run on an open source version of Google's Android software, though Facebook is also reportedly working to build its own operating system for future hardware. Facebook, of course, moved into hardware with its Oculus VR headsets and its Portal home devices. With the smartwatch, there could be privacy pushback, but it does give more insight into Facebook saying that Apple is its biggest competitor, something it put out there in its battle over Apple's operating system change. That's coming up, guys. Back over to you.
Julia, thanks so much for that. Still ahead, Robinhood makes its way to Capitol Hill. We'll tell you what to expect from next week's hotly anticipated hearing on the GameStop craze. Plus, billionaires are flocking to the Sunshine State, and that's having a big impact on Florida's real estate market. We'll discuss the big names heading down south coming up on Closing Bell.
Next, Alison Yanni, Representative Cori Bush, and Back in My Day. Plus, a closer look. And at the impeachment, Democrats showed a video of the riots and Trump's speech.
And then Trump's lawyers played the same video, but with the Rocky music over it.
This weekend.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
I want people to feel like they just learned something. I want them to feel like they understand something about their lives better than they did an hour earlier. We will sort through what's true and what isn't, and we'll give it to you straight, in context and with perspective. We will not waste your time, and we'll earn your trust. And I want them to feel like that was an hour well spent.
Time now for CNBC News Update with Courtney Reagan. Hi, Courtney.
Hi, Sarah. Here's what's happening at this hour. Maryland has become the first state in the country to enact a tax on digital advertising. The state Senate voting today to override a veto from Governor Larry Hogan. The tax is likely to face legal challenges and will also be watched by other states considering similar moves. Digital music company Spotify says it will let employees work from anywhere after the pandemic. That includes home, office, or a combination of both. The company will also allow more flexibility around locations, so employees will be able to choose the country and city in which they work. And Italy has a new government. Former European Central Bank Chief Mario Draghi has announced a cabinet filled with technocrats and politicians from across his broad coalition. The new team will be sworn in tomorrow. That's our CNBC News Update for this hour. Back over to you, Wilf.
Court, thanks so much for that. Up next, Rashawn Williams from Manhattan Venture Partners joins us next with what he's forecasting for the rest of the year and his take on the big boom in SPACs. Closing bell back in a couple.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
How inclusive is advertising?
If you're leaving out so many marginalized groups, the message that we're sending them is that they're not important.
Our industry reflects society. As a culture, the UK does have systemic racism. Our industry has systemic racism.
Why it's important for business?
Not only is it a good thing to do in terms of being a member of society, but it's good for the bottom line.
We begin a two-part special exploring diversity and inclusion on the next Marketing Media Money.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcasts or your favorite podcasting app and subscribe to the Halftime Pod today.
Diversity is still lacking when it comes to the venture capital industry. According to 2018 data from non-profit organization Black VC, African Americans made up 3% of the VC industry and Hispanics made up 1%. And in a survey of 638 firms with more than 7 investors, nearly 90% had no black investors. One investor working to increase representation in the industry is Rashawn Williams from Manhattan Venture Partners, along with being general partner of the firm's MVP All-Star Fund. He was a founding partner at Queensbridge Venture Fund, which he helped launch and manage with other partners, including rapper Nas. He joins us now. Very good to see you, Rashawn. Thanks for joining us.
Thanks for having me. Good to see you.
So what is the biggest problem? Is it a lack of investors like you, or a lack of target companies and those companies having access to capital when they're starting out?
Well, from the top down, the VC firms are used to recruiting companies from their network. So if you're not a part of the Stanford network or the Silicon Valley network or the San Francisco community, you've been largely overlooked, right? And just big pockets of African Americans just don't populate in that area like they do in Atlanta, Chicago, or New York. But from the bottom up, the real issue, and this is what most people don't understand, is that before you even get to Silicon Valley to raise a $5 million seed round, you've already put your own money in. You've raised money from family and friends. You've raised money from angel investors. And there's just not a lot of people in the minority communities that have access to people who can write a $100,000 check for their startup idea. So they wind up creating businesses and going and seeking capital at an earlier stage when other founders who have access to capital from the family and friends and angel community already have a business, already have a team, already have traction, already have revenue. So it's really a wealth gap issue from the bottom up. And then it's a community issue from the top down, just recruiting in the communities that you coincide.
Is that being solved? I mean, is capital reaching those businesses at least, even if there is this sort of valuation issue where perhaps black entrepreneurs are having to sell stakes in their company earlier and therefore at a lower valuation?
Well, I think it's important to put it in context. Less than 2% of companies get venture capital funding to start with. But here's how the problem is getting solved. I would say it's kind of 3 main things. The first thing is you see crowdfunding. So now minorities can reach out to their extended community and raise capital for these risky startup activities. And that wasn't something that was around a decade ago, right? So now you can go on social media, raise hundreds of thousands of dollars, millions of dollars from your extended community. The second thing that's happening is the rise of what I call the micro VCs. So you're seeing a lot of corporations, a lot of investors who want to solve the problem, and they're investing in these 10, 20, $50 million VC funds that would be considered a micro VC. And they're going and bridging that gap between the family and friends and the angel investors that people from poorer communities or minority communities just don't have access to. So I love to see all the activity there. And then last but not least, I can't overlook this really big thing. Beats by Dre, 50 Cent with Vitamin Water. The more popular becoming a founder and investor becomes in pop culture, athletes and entertainers, it trickles down in our community because we over-index in those particular industries. So you're starting to see a lot of interest and a lot of athletes and entertainers investing in those seed rounds where VCs won't even touch it yet because it's too early.
Like who? Who should we keep an eye on?
I'll give you my top 5. These are guys that I think are really doing the work, set up their own venture capital funds, and are super smart. Obviously, at the top of my list is probably Thaddeus Young, that plays for the Chicago Bulls. If you go to his website, reformventures.com, this guy is in every deal that top tier VC firms want to be in. And he got his MBA while being in the NBA for 15 years. Number 2, Malcolm Jenkins. He just launched a venture capital fund, New Orleans Saints football player. He's very active on the investing side. A lot of respect for him. Guys like Derek Morgan, retired Tennessee Titan, Josh Childress, Stanford grad, former NBA player. And my favorite of all time is actually Jamal Mashburn. I don't know if you guys have been following what retired NBA player Jamal Mashburn is doing, but just an amazing portfolio of companies that he's invested in, and most people don't even know about it. So I would say those are some of my favorites.
And when it comes to investing, the MVP fund, you just raised the 4th installment of this. Are you finding it harder to find target companies? Have valuations been pushed up quite aggressively in the private market, whether that's because of just generally more money coming into this area or SPACs or anything else?
No, I think the narrative is companies are staying private longer, so their revenues are growing with their valuation, right? So it's not a revenue valuation mismatch. It's more like companies used to go public after 3 to 5 years. Now they're going public after 10 to 15 years. So when we invested in Spotify back in 2017, people said it was overvalued. When we invested in DocuSign, it was around $16 a share. People said it was overvalued. When we invested in Postmates and Hotel Tonight and Wish and SoFi, the story keeps continuing. I've been hearing that late stage tech is overvalued for so long, but if you look at now the largest companies in America, they're all technology companies. They're $1 trillion+ market caps, and there's just been a huge sea change. And I think the people who really dig deep, they'll see that the majority of the revenue and profit growth over the S&P over the last 10 years has been in technology companies. So people want a part of that. So now all of the mutual funds are dipping into late stage privates. People who are traditionally public investors want to get in a little earlier because they have to wait 10 to 15 years to get a bite at the apple now.
I think one of your early investments, or one of your prior investments, was in Coinbase, which is going public. And we've been talking a ton about Bitcoin. And I was just wondering how much money is flowing there from the VC world and whether you're looking at other sorts of investments like that.
Yeah, we originally invested in Coinbase in 2013 through Queensbridge Venture Partners. The company was only valued at $30 million. And that's around the time when we were starting to get a lot of attention on digital currencies and cryptocurrencies and blockchain. Our thesis was we're not going to bet on a particular currency. We'd rather bet on the casino. So we wanted to invest in a marketplace, and billions of other capital came to the company as well. And I think everyone agrees that you want to be in a market leader like a Coinbase when you don't know who the winner is going to be in the individual currencies. Some people love speculating on the currencies, but for us, it's hard to underwrite without any fundamental analysis. So we chose Coinbase, and it's worked out really well. I think this company is going to continue to dominate.
What about Robinhood? You were also an early investor there. That company seems to be plowing ahead with its IPO. You think it can pull through, even though it's facing a wave of lawsuits and potentially regulatory action, or at least regulatory scrutiny?
I do. And I'm only laughing because half of my portfolio companies are facing lawsuits and going through regulatory changes. Think we invested in Lyft, we're invested in DraftKings, we're in the companies that are just kind of changing how business is done. So I do think in spite of the recent volatility, the business principle is the same. If you look at their user growth, you look at their revenue growth, and look at their market share compared to their competitors, they're just dominating the industry, and they're growing at 10 times the rate as everyone else that they're competing with. So we actually love Robinhood. We hope that they pull through and they find a way to work with everybody. But we really think this company is going to continue to grow and continue to dominate, just like Coinbase.
Rashawn Williams, thank you for joining us. We appreciate it.
Yes.
Up next, fleeing to Florida, the pair of billionaires who are getting a lot of buzz today for their moving to the Sunshine State. The details when Closing Bell comes right back.
Are you optimistic that Mr. Draghi can introduce changes and push through those changes that will be palatable to the broader population?
We can certainly regain for our country the respect of the European partners, and I'm sure he will relaunch the European project. We'll certainly look at the economy, we'll certainly lever on companies, on banks, but I'm sure he will be able to understand and to heal the growing social malaise.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC. In navigating markets,
green is the theme across the board.
What signs point to opportunities?
Gold hitting a near 7-year high.
In economic political crossroads,
Global slowdown grows. Central banks are feeling the pressure.
How do you brace for the risks ahead?
Debt levels in the world are rising.
Set your money on track with Nancy Hungerford and Tanver Gill. Get up to speed with the day's biggest moves. Real-time updates, actionable insights, street signs on CNBC.
Looks like Palm Beach is seeing quite the real estate boom, with some notable billionaires paying a hefty price to secure a home there. Robert Frank has more on that for us. Robert.
Hey, well, for the most expensive home ever sold in Florida, just closed yesterday. Price tag, $130 million. The buyer was Scott Scheifler. He's the head of private equity for Tiger Global. He declined any comment, but this was a property that actually used to be owned at one time by Donald Trump. It was listed just last month for $140 million. So a quick sale there at close to the ask. Less than a mile away, billionaire investor David Tepper and his wife Nicole just went into contract for a new mansion for $73 million. Unclear whether they will actually move to Florida from New Jersey. But the billionaire migration shows no signs of slowing. New contracts in January, doubling over last year, and prices for luxury properties in Palm Beach were up 54% just in the fourth quarter. There are now more than a dozen properties in contract for $20 million. And Sarah, you could say, well, who cares what a few billionaires are doing? But they pay a lot of taxes in New York and New Jersey, so it starts to add up at a time when these states cannot afford it.
I was just going to say, and Trump's back in the neighborhood. Donald Trump back at Mar-a-Lago. Robert, thank you.
That's right.
What a boom. Robert Frank. Up next, the Robinhood CEO set to testify before the House Financial Services Committee next week. We'll preview that event, what all of Wall Street will be watching there, and a big shortened holiday trading week next week. We've got some great guests. Everything you ever wanted to know about the consumer, you can find out on Closing Bell next week. The CEOs of General Mills, Kimberly-Clark, Procter & Gamble, Clorox, and Coca-Cola as the Consumer Analyst Group of New York meeting kicks off. We'll be right back here on Closing Bell.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
How sustainable is that growth in China? And is 2021 the year that China becomes the largest beauty market, passing the USA?
China will become the #1 beauty market in the world, and it will become the #1 subsidiary of L'Oreal in the world. It's mechanical. The overperformance that we were able to record last year in China is really amazing, and it was, by the way, the best that we had in 20 years.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Executives from Robinhood, Melvin Capital and Citadel Securities reportedly set to testify before a House panel next week. Kate Rooney here with a preview of what to expect. Kate.
Hey, Wilf, the hearing will be focused on the collision of social media and stock markets. Robinhood, of course, is at the center of that. Its decision to limit some trading of a few stocks a couple of weeks ago is expected to be picked apart by Congress members, as well as its revenue model of selling customer trades. Lawmakers have questioned its relationship with market makers like Citadel Securities, not to be confused with Citadel, the hedge fund, also started by Ken Griffin. Expect to hear some talk of clearinghouses and things like how long it takes for trades to settle. Robinhood has looked to shift some of the conversation around GameStop to what it calls outdated back-end systems. Guys, back to you.
Oh, sorry, Kate. My apologies. I thought it was I thought it was Sarah was picking up, but my bad. Thank you very much for that, Kate Rooney. We look forward to those hearings next week for sure. Mike Santoli, final minute or so of the show of the week. I mean, S&P up 1.2%. It felt like a bit of a bigger gain than that, but a nice ramp into the close, showing that the optimism out there.
Yeah, I mean, the real takeaway from the market action this week was that no real sellers emerged to get in the way of this trend, even when there seemed to be the opportunity. Now, breadth definitely did falter a little bit. There's a little bit of more of a mixed message underneath the surface. Also, you know, some of the real aggressive fringe parts of this market, micro cap stocks, have been flying. On the good side of that, dynamic, is that we've seen these flare-ups in the GameStop complex as well as cannabis, and they flame up and they flame out, and the overall market manages to just absorb it and go its own way. So I think all those things are net positive. As I keep saying, though, at a certain point, we overshoot. Never know where that point is.
What are you going to be watching for in the Robinhood trial?
Well, I'm hoping some illumination happens here. In other words, let's examine some of these practices. Let's have some actual smart talk about payment for order flow, which probably I think has been unfairly villainized. Also, what are we solving for right here? You had a lot of clients who are effectively complaining that Robinhood, for operational reasons, didn't let them buy GameStop at $400 a share. Look where it's trading right now, under 50.
I like how you call it there, Sarah, a trial.
Hearing, I should say.
We haven't quite reached that.
Yeah, I should have said hearing.
Anyway,
it was a misspeak.
We are out of time here on Closing Bell. Have a lovely weekend, everyone. Fast Money starts right now.
Hello and a happy new year. 恭喜發財，恭喜發財. I'm Emily Tan. Welcome to this special Lunar New Year edition of the Year of the Ox, Plowing On. Will this be the year the world finally recovers from the pandemic? We'll look at the prognosis for the global economy and markets. A big year for politics as Joe Biden begins his year will usher in new hope for recovery. The ox is the second animal of the Chinese zodiac and is known for its diligence, determination, and dependability. Traits which are going to come in handy after the tumultuous year of the rat, which unleashed a deadly virus that killed millions, sent countries into lockdowns, wrecking the global economy. But even as it roiled markets, it didn't stop stocks from tracking up record highs, extending one of the longest bull runs seen in equities. The NASDAQ was up over 45%. Chinese stocks were also up around 40%. And the Hang Seng Tech Index, where many big Chinese stocks are listed, a blistering 90%. So the question is, will we see more bullishness, or will this year be the year of simply plowing on? I put that question to my panel. Helen Zhu, Managing Director and CIO of Nanfeng Trinity, and Alicia Garcia Herrero, Chief Economist for Asia Pacific at Natixis.
Well, Emily, it's going to be a very interesting year. In some ways, it's kind of like we rewind back to January of last year, and the macro backdrop is actually quite similar. Now, we actually see that asset prices are much higher versus where we were a year ago, particularly in the U.S., and particularly in some sectors that have been more high growth and benefited from the close to zero interest rates that resulted from the coronavirus. So I think this year versus last year, even though the macro backdrop is somewhat similar, it's going to be more difficult to find areas where you can still generate great returns.
Alethea, China was the only major economy to register positive growth in 2020. Will it lead the global recovery this year?
Because of the tyranny of base effects, it's hard to lead every year because others are coming from a very low base, i.e. the US. And of course, it has a push. Of course, the US won't grow faster than China in 2021. There's a huge difference in potential growth, but say India could. for example, because it's just coming from such a low base. So the point I'm trying to make is that growing faster than China shouldn't really be the way to measure record growth, but rather the average of 2020, 2021.
Helen, following the delisting of Chinese companies from U.S. markets, mainland money has been flooding into the Hong Kong market. What investment trends can we look out for in Greater China markets this year?
China is quite worried about, asset bubbles in various parts of the economy, and therefore, I think, as people see that the monetary policy stance is shifting towards tightening, they will be looking to potentially look for better relative return opportunities, and Hong Kong is certainly one of them. I think in the Hong Kong market, in particular, because of the local stocks and local companies being negatively impacted by the COVID last year, more so than the Chinese companies, as well as, the protests and so on from 2019. A lot of these lingering effects have kept a lot of local Hong Kong sectors and companies, under significant pressure and at historically quite low valuation levels. So I think these are some of the reasons why the mainland money will continue to come this way.
Alethea, COVID was the biggest shock to the global economy in the year of the rat. Countries are still battling the pandemic. What are the biggest risks this year?
Well, the big risk is that everything we've said so far won't happen, and it is a risk. And I think the main reason for this wonderful recovery we're all waiting for not to happen, or at least not to the extent of the consensus forecast so far, is basically lockdowns, and we're already basically there in Europe, in the US, and in some parts of Asia, Malaysia, partially Japan. And of course, delays in the vaccination process, which we're also seeing. So if you look at the speed at which Asia is vaccinating, it's actually even less, it's actually less fast than Europe. So it is not as impressive as we thought it would be. So in other words, the risk I'm referring to is in the midst of happening. We really need to accelerate vaccination in Asia, and we know that it won't be easy. The other risk is basically coming from the US, and this is too much of a good news or too much of an inflation news, i.e. higher interest rates on the long end of the curve.
Helen, stock markets have continued to hit records. A resurgent pandemic did not stop that rally. Has the volatility from the retail investor, like what we saw in GameStop, emerge as a risk factor for this year? What other risks should we know about?
We are going to start to see a very low base in terms of inflation coming up in the second quarter of this year, given what a deep deflationary environment we had in the second quarter of 2020. So when you start to see that, people will start to wonder whether that is just a base effect impact or whether actually all of this money printed over the last year is resulting in structural inflation in a number of areas. So I think, going into latter part of the year when the COVID is actually properly contained and economic activity really truly recovers, then I think that's when we have a bigger risk to the overall market because of the policy stance, because of bigger concerns about whether inflation's around to stay, and what else is there to actually continue to support the markets afterwards. And you mentioned the retail participation in the U.S. as well. If people start to get back to work and have less time on their hands, is there going to be more concern about retail money potentially leaving and volatility rising as a result of that?
Taiwan registered economic growth of 2.98% in 2020, and for the first time in 30 years, it outpaced China. Countries around the world are calling for help from the island's chip industry, TSMC and UMC, to help alleviate the auto chip supply shortage. Should we be paying more attention to the rising tiger economy, especially since the island now has the firm backing of the United States?
Okay, so in Taiwan, indeed, growth was very fast in 2020, but there are very specific reasons for this. First, it's probably the shortest lockdown in the whole world, or at least in Asia. It's only 2 weeks in early 2020. So, huge mobility, no change in mobility in the island. Second, Taiwan has the right export structure, mainly semiconductors, ICT products, but also masks and other sanitary products, which Taiwan has been exporting massively in 2020. So that helps a lot. However, Taiwan's potential growth is still low. So in other words, I would argue this is an exceptional year. I think Taiwan's potential growth is probably 2%, given that it is an aging society. And thus, we wouldn't expect Taiwan to basically grow faster than the mainland for many more years to come.
Coming up, what to expect in the world of politics. Plus, we'll do a little stargazing and find out what the feng shui masters say about the year of the ox.
For the year 2021, expect the unexpected.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Russian Foreign Minister Sergei Lavrov says the country is ready to cut ties with the European Union amid a recent escalation in tensions. Lavrov said Russia does not want to isolate from global life, but is prepared for that possibility. That story is on the website now. The UK economy contracted by 9.9% in 2020, its biggest drop on record, as the pandemic wreaked havoc and forced several sectors to effectively shut down. The UK economy is set to continue shrinking in the first quarter of 2021 due to ongoing restrictions. Head online for the full story. Disney beat subscription expectations in the first quarter, reporting 95 million paid subscribers to its Disney Plus streaming platform. The media giant also reported a profit rather than the loss analysts had expected.
Will be holding elections this year, including Germany, where Chancellor Angela Merkel ends her record 16-year term in office. And in Japan, Prime Minister Suga faces the LDP leadership race by September, a lower house election by October. In China, no such contests, but it will be a big year for the Chinese Communist Party, which in July will mark 100 years since its founding, where it will hope to have put the pandemic, which originated in Wuhan, far behind it. We're joined now by Richard McGregor from the Lowy Institute. Richard, thank you very much for joining us today. China marks the 100th anniversary of the Communist Party this year. Is this significant, and how will leaders celebrate this milestone?
Well, I think it's highly significant, not just because it's the 100th anniversary of the Communist Party, and birthdays, anniversaries and the like are extremely important for the CCP. It's also important because China goes into its, or the CCP goes into its 100th anniversary feeling very confident. You wouldn't have thought that a year ago when we had lots of stories about China's Chernobyl and the like, but compared to the US, compared to Europe, compared to many other countries, China has recovered well from COVID-19. The economy is growing, and Chinese leaders, particularly Xi Jinping, feel very confident about the growing power of their country.
You mentioned President Xi Jinping, and he marks 10 years in office next year. Fighting corruption and the great rejuvenation of the nation remain top of his agenda. What other policies are you expecting from him?
Well, I think it's Chinese economic policy is very important. He's building a hybrid economy, forging a sort of compact between the private and public sectors. He's pressing Chinese engineers, scientists to build independent technological capability, so the US and other countries cannot coerce it in any way. He's very keen to expand China's diplomatic power, particularly in the Indo-Pacific, but all around the world. I think he will also, a priority for China this year is vaccine diplomacy. In other words, to use its production and dispersal of vaccines to build or help rebuild, frankly, China's image around the world.
China has maintained assertive policies towards Hong Kong, Taiwan, and Xinjiang. And its so-called wolf warrior diplomacy is well received on the mainland, but it isn't helping China when it comes to diplomatic ties. Will China continue to use this tactic?
In many respects, I think wolf warrior diplomacy is not on the margins of Chinese diplomacy now or foreign policy. It's really mainstream. As you say, it's about playing to the domestic audience. It's about Chinese diplomats proving to their masters that they're making China's case forcefully to the world. It's about pushing back against the US and the like. You might see some alleviation of it as, the US and China feel each other out in the early days of the Biden administration to see if they can reach, a different kind of relationship, which incidentally I doubt. So I don't think it will go away. It might be turned down slightly, but not entirely.
Now, this U.S.-China relationship that you're talking about under the Biden administration, Beijing has already indicated it wants to work with the new administration to get bilateral relations back on the normal track. What do you expect this to look like from both sides?
Well, the normal track from a U.S. perspective is U.S. decline and the U.S. stepping back and China stepping forward. So I don't think we're going to see a return to that. I think you'll see a less ideological tone of the kind struck by Mike Pompeo, the former Secretary of State, in other words, focusing particularly on the Chinese Communist Party. But I think you will see a very forceful U.S. administration on a number of fronts, national security, perhaps economic, technology in particular. The big question, of course, is whether the U.S. can hold its ground. They've got Joe Biden comes into office with enormous domestic economic problems. And at the end of the day, that's going to determine the U.S. ability to, re-engage in the contest with China.
Now, the Lowy Institute has its Asia Power Index, and this tracks the power in economic, military, as well as diplomatic and cultural domains. The United States comes out on top, but its lead against China is narrowing, and it's not because the U.S. is getting weaker or China is getting stronger. Do you expect this narrowing trend to continue?
I do think it will continue for the moment. It's very hard to look ahead in today's world when you see all the disruptive activities that can arrive on your doorstep without warning, such as COVID-19. But yes, I think for the moment, near term, 2, 3, 5 years ahead, China will continue to grow at a faster rate than the US. And I think China will overtake eventually, maybe earlier than we expect. The US is the world's largest economy. Whether that performance is sustainable, though, is a much more open question. But in the near term, I think China will be getting more powerful and richer, and the US, in relative terms, less so.
So what fortunes or tribulations does the year of the ox hold? We did some crystal ball gazing. The ox is known for being a hard worker, plowing on till it gets the job done. And after the major upheaval brought on by the year of the rat, many hope things will finally look up this year. And if you're a horse, monkey, rooster, dog, or tiger, it could be a good ride.
The best sign enjoying the best luck for 2021 is those born in the year of the monkey. There are many, many, many good stars in the chart for the monkey. Benefactors, helpful stars, the really powerful ones. The two particular signs that need to put a bit of effort for the year and to stay extra vigilant will be those born in the year of the goat and the ones born in the year of the rabbit.
For Chinese President Xi Jinping, it will be a big year as the Chinese Communist Party celebrates its 100th anniversary.
President Xi is born the year of the snake. He's in his what we call a good luck period for quite a while now. So in the year 2021, we expect more of the good luck for President Xi, which is good news for China.
I, Joseph Robinette Biden Jr., do solemnly swear
As for the newly installed U.S. President Joe Biden and his Vice President Kamala Harris, the fortunes are a little more mixed.
We have a pair of the horse and dragon combination. President Joe Biden is a horse and Kamala Harris is a dragon. Now, for Joe Biden, his birth chart is in for some bumpy rides. Now, Kamala Harris is a very good right-hand lady for the president. She possesses skills that are what I would call based on their birth charts. It's a very complementary match for Joe Biden.
And British Prime Minister Boris Johnson, another dragon, whose country's COVID crisis is the worst in Europe and who also has a Brexit fallout to navigate. The feng shui master says he's in for some really good luck this year, but he's likely to take a more down-to-earth, practical approach. Meanwhile, for Japan's Prime Minister Suga, who's born in the year of the rat and who will face the ballot box in September, his chart is a lucky one, enjoying the support of those around him. But his challenge will lie in being decisive. In the world of business, China's most recognizable businessman, Jack Ma, had a bit of a tough ride last year.
This is no ordinary dragon. He's a very ambitious dragon. It's fierce. He wants to make quick decisions. He does things fast. This is something that will work in his way and also will get in his way. So in 2021, we see him moderating it down.
And after dethroning Jeff Bezos to become the world's richest man, what will the year of the ox bring for Elon Musk?
Elon Musk is born the year of the pig. Now, this is a typical birth chart of risk taker, somebody who breaks the rules and is willing to take challenges head on. Now, what's very interesting in 2021, you will see, I would describe it as a bad boy gone good kind of a chart.
Coming up, it's traditionally the biggest travel season of the year for China, but this year things are looking very different. We'll talk about the outlook for a sector that's been hard hit by the pandemic. The chairman of Chinese online travel giant Trip.com joins us next.
Breaking news on what has turned into the soap opera, and that is GameStop.
We watch the internet now, thanks to the rise of social media, bring a bottom-up revolution. And now it is happening to finance. And I really do think this is really the start of a new era.
These kids have the courage to do it transparently in a forum. And I'm not saying all of it is perfect, but I think it takes an enormous amount of faith in the system to be that transparent, and then for each individual to make their own mind up, whether it's to buy and to sell.
We've gotten a lot of criticism that, maybe there should be more restrictions. So it pains us to have had to impose these restrictions, and we're going to do what we can.
This is why we need an SEC that has clear rules about market manipulation and then has the backbone to go in and enforce those rules.
The system is broken right now for certain stocks, for the heavily shorted stocks. And people are thinking somehow, well, this is a home run. Take the home run. Don't go for the grand slam. You've won the game.
How inclusive is advertising?
If you're leaving out so many marginalized groups, the message that we're sending them is that they're not important.
Our industry reflects society. There's a culture. The UK does have systemic racism. Our industry has systemic racism.
Why it's important for business?
Not only is it a good thing to do in terms of being a member of society, but it's good for the bottom line.
We begin a two-part special exploring diversity and inclusion on the next Marketing Media Money.
Parades and big family banquets are just some of the usual sights and sounds of the Lunar New Year that many won't get to experience this year. Here in Hong Kong, most of these big-ticket items have been cancelled. Over on the mainland, the New Year holiday typically marks the largest annual human migration as people return home to celebrate with their families. But for this year of the Ox, the government has been urging citizens to stay put and limit social gatherings. Joining me now is James Liang, chairman at Trip.com. James, thanks for joining us today and Happy New Year. The Lunar New Year is usually the biggest annual human migration, but in response to COVID, the government has recommended citizens to stay put. Knowing what we've known about COVID after the last year, how will this year's peak travel season be different to last year?
Well, I think people are still making last-minute travel plan. As the central government has very clarified the confusion about some of the travel restrictions. Some people who are allowed to travel, and most people are still allowed to travel and still are making travel plans. So we're still seeing, after a lot of people canceled their trips and people are starting to rebook their leisure trips and also, family visits. So we're seeing, good signs going to the Spring Festival. We're probably looking at, 50, 60% of the normal pre-COVID level.
So on those numbers, the preliminary numbers, is there any indication how many people will be actually on the move?
In a normal year, you will see like hundreds of million, maybe 200 million people are on the move. But this year, probably, it's only at 50% level. But of course, the Ctrip.com's business is looking at the high-end leisure travels. I believe this number will, we're still counting, this number will be at the 50, 60% level. Some of the very popular destinations, we're still seeing very good capacities like, Hainan or Yunnan. I think in the peak days of Spring Festival, we probably still, some selected the resorts still have a chance to be 100%.
There were signs of domestic recovery in travel taking shape before this latest wave of outbreak. Has this recovery been derailed?
Well, this, we probably, at this point, probably still, people are still a little bit wary, and this is probably the lowest point. Then going forward, just like last year, as people, getting to high season of leisure travel, like the warmer weather and more holidays, then we'll probably see a speedy recovery going forward, especially when, the vaccination is coming in and a lot of travel restrictions are being lifted. So this, from now, we'll see a quick recovery, just like last year. Last year, at this point of last year, it's like lower 20s. Now it's 50. So it's much better than last year. And last year, it took only 3 months to recover to about 50%. And hopefully we will see a very quick recovery too this year.
Airlines and hotels are now offering flexibility with the itineraries. How has COVID permanently changed the travel industry?
Well, a lot of resort hotels offer very flexible dates. We call it the pre-sale packages, and Ctrip sold a lot of that. And actually, our live stream program, I personally participated. We sold a lot of staycation packages, pre-sales packages, where you can lock down the discounts, but you don't have to specifically make a commitment of the exact traveling. And this has been very popular. And also very popular is the short excursion packages, like 2 or 3 day weekend packages. This has been very popular, especially for places like around Shanghai or around Guangdong area. Those resort hotels like 1 or 2 hours away by train or by car. Those resort hotel hot spring packages it's been very popular.
After the Lunar New Year holiday, what are people doing and where are they going? Is there any forward planning giving you any trends?
People are looking, of course, domestically everywhere, especially during the spring. There's a lot of choices. I think the most popular ones are still the ones within a 2 or 3 hour of either by train or by car. But as you know, 2 or 3 hour by high-speed railway is like 500 or even 600 kilometers. That big area, you can travel within 2 or 3 hours by high-speed railway. So people have a lot of choices. And we are also giving people inspirations through our live stream program.
Now, everybody is vacation deprived. Where are some of these top destinations that you've been talking about? And of the people that go further than the 2-3 hours, are people actually leaving the mainland and going overseas?
Right now, they are looking at domestic destinations. Well, the only the only overseas destination that are currently open, without quarantine requirement is Macau. So Macau has been the first overseas destinations that's open, and it's picking up quite nicely. So we're seeing a steady recovery. Right now it's probably 30-40% capacity.
James, thank you very much for joining us today. James Liang, chairman of Trip.com. And that wraps it up for this Lunar New Year special. Wishing you and all your loved ones a safe and prosperous Year of the Ox. 恭喜發財，恭喜發財。
I take this opportunity to wish every one of you good health, happiness, and a year full of fulfillment. Just don't work too hard like an ox.
恭喜發財. So here's a happy Lunar New Year from all of us here at Razer.
For the Year of the Ox, I hope that everyone will soon rediscover the joy of travel.
My wife has a sign on the refrigerator that says, "Be nice or leave." I smile every time I see it because for much of my life, I was a bit of a rough around the edges gentleman brawler, to put the best possible spin on it. But for years now, I've been chilling my way toward nice. I bring this up because consumers increasingly have the same attitude about the internet. They like it gentle. They like it safe. They like it nice. Which means that how advertisers will increasingly spend their money is determined by that. See, and sooner or later, what those advertisers do will affect the stock market in your portfolio. Yesterday, we learned that Microsoft might be courting Pinterest. That's that kinder, gentler social media platform for hobbyist enthusiasts. Perhaps maybe after it failed to buy TikTok late last summer. It makes sense, right? Pinterest would let them kill two birds with one stone. They can pry a cloud customer away from Amazon Web Services, because that's who Pinterest uses, and then they'd also get a ton of valuable consumer data. Pinterest stock has been a rocket ship ever since the TikTok deal failed, surging from $34 to $84, where it trades at more than 20 times sales, making it one of the most expensive stocks in this entire stock market. Less than 2 years ago, this was a $10 billion company. It's now a $53 billion company. Now, I like the Microsoft to buy Pinterest storyline, even as I find it hard to believe that CEO Ben Silbermann would sell. More importantly, though, Silbermann's he actually really does personify the be nice or leave attitude that's sweeping the nation. And that's one of the many reasons why I like him so much. Right now, the whole country, the whole world is moving toward a kinder, gentler internet, thank heavens. We've gone through a horror show of a moment in America. Just watching those videos from the Capitol riot, it feels violent to me. The reaction? Well, people are migrating to the sites that create a sense of community. It's not just Pinterest. TikTok's on the sweeter end of the spectrum, too. And that's something Walmart would like to have. They have a big analyst meeting next week. So would the advertisers. Or how about Twitter? When they banned Trump, a lot of us thought that it would cost them some money. But ever since the crackdown on their more inflammatory users, the stock has roared higher, not going lower. At the end of the day, Twitter's about interaction, not incitement. Relying on a conversation is a better business model than relying on arguments and rage clicks. That's what people want now. I know I sure try to give it to them, and I didn't get my 1.5 million followers by screaming and yelling at everybody. It's okay to say nice things and be gracious. It was incredibly telling that another sweeter site, Snap, saw a decline in ads around the time of the failed putsch because traditional consumer product companies pulled in their horns. Be nice or we leave, I guess you could say. Snap snapped back the moment the failed rebellion was in the rearview mirror. Right now, when I talk about these social media sites getting more friendly, the big outlier is Facebook. See, they want lighter moderation there, but that means you end up with some really ugly stuff. I like Facebook's small and medium-sized business initiatives. I've made no secret about that. They're the real deal. I think Zuckerberg's he's a great businessman. Let's give him that. At the same time, though, the lack of moderation is costing the trust of many, and earning that trust back could be difficult, if not daunting. Wall Street increasingly understands that this is a be nice or leave moment, so advertisers won't pay as much for the users of Facebook as they will for the users of Pinterest. Spend your money on Pinterest, your ads might appear next to what? An ugly quilt square? Spend your money on Facebook, there's a real risk of advertising next to the blood sport of contemporary politics. These days, that's a good enough reason for the food, drug, cosmetic, restaurant, and beverage advertisers, the big money guys, to pivot to the kinder, gentler internet. Same goes for the travel and leisure ads. They're about to come back in a big way, and I think they're going to go to kinder and gentler. Keep in mind, sometimes the stock market can be an incredibly astute judge of the actual world, not just its prices, but the world. And the fact that buyers would rather pay 21 times sales for Pinterest than 24 times earnings for Facebook pretty much tells you all you need to know about this moment. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.